everyone. I would like to call the Board of Administration Offsite meeting to order, and the first order of business is roll call. Mrs. Hopper, please.
Henry Jones,
Here.
Margaret Brown, You're muted, Ms. Brown.
Margaret.
Rob Fector,
Good morning.
Frank Ruffino for Fiona Ma,
Good morning.
Lisa Middleton,
Present.
David Miller,
Here.
Stacy Oliveris,
Here.
Nicole Griffith for Irene Ortega,
Here.
Ramon Rubicava,
Here.
Teresa Taylor,
Here.
Shonda Wesley,
Here.
Betty Yee.
Here.
Mr. President, all is in attendance.
Okay, did Miss Brown ever get connected?
I'm here. Can you hear me now?
Okay,
Yes,
yeah,
thank you, Ms. Brown.
Thank you.
Okay, thank you. Okay, so now we'll take time for the Pledge of Allegiance, and I've asked Ms. Middleton to lead us in the pledge. Ms. Middleton, please.
Please stand. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you very much, Ms. Middleton, and good morning, everyone, and welcome to the Board of Administration and Executive Team virtual offsite meeting. I'd like to especially welcome all of our stakeholders and members of the public who have tuned in today. We have a full agenda in front of us over the next 3 days. The annual meeting is designed to provide the board and our stakeholders with in-depth education and updates on the organization's priorities. The education is fundamental to enhancing our understanding of the work before us and supporting our ability to make well-informed decisions in the best interest of our members and employers. We welcome board members and stakeholders to actively participate in the discussions and public comment sessions with the goal of broadening our thinking and foster collegiate dialogue. After each of today's sessions, we'll open our phone lines for public comment. Anyone who wants to address the board will have 3 minutes to speak. I look forward to our discussions and conversations. And with that, I'd like to turn it over to our CEO, Marcy Frost, for her opening remarks. Ms. Frost.
Thank you, President Jones, and good morning, everyone. As President Jones indicated, we will begin our second virtual offsite today with a focus on the asset liability management process, and then as well as look at capital market assumptions and how those are established. We'll also look at the framework for portfolio allocations, and then also the regulatory and market policies that are really beginning to reshape corporate reporting, and that will be facilitated by Ann Simpson. These are likely some of the most important and informative presentations that you'll receive during the ALM process. We'll start with a panel discussion featuring Makita, Wilshire, and JP Morgan, and they will really provide you with their own independent perspectives on the capital market assumptions and market outlook. And what that really is intended to do is to provide the context for the assumptions that we will use on the ALM process moving forward through the fall. Sterling Gunn from our investment office will then take you through 2 separate presentations or sessions. And the first will be to look at the role capital market assumptions play for long-term investors like CalPERS in determining the level of risk that the board will be comfortable taking over the next 4 years. He will then lead you through a review of the framework that will be used to develop the candidate portfolios that we will bring back to you in September. And then we'll finish the day with a session on corporate reporting and the changing policy landscape that helps all investors better understand the risks that we're taking as we invest in public companies. And as I indicated, Ann Simpson will moderate a discussion with 3 experts about the new regulatory and market practices that favor disclosure of financial, physical, and human capital factors. And as you know, we believe that long-term sustainable value creation requires effective management of those 3 forms of capital. and that investors like CalPERS need strong corporate reporting so that we can fully understand those risks. So let me turn over to our preliminary fiscal year returns. Like so many investors, we benefited from the continually rising financial markets, the strength of which would have been hard to fully appreciate or even predict just a year ago when we were still deep in the middle of the pandemic. And while we are very pleased with these earnings and the performance of the portfolio, it's also important to note that we never lose sight of the fact that we are long-term investors and with an investing horizon that really stretches out years and even decades to come, and that we don't make decisions based on any one year's returns, whether those are good or bad. Our focus will continue to be on sustaining and delivering those benefits over several lifetimes, and that we can do that across generations. So as of June 30th of 2021, our investments for the fiscal year 2020-2021 earned a preliminary return of 21.3% with assets over $469 billion. With this return, our funded status is estimated at 82%. The 5-year return on the portfolio is now at 10.3. The 10-year return is 8.5, and the 20-year return is 6.9. Over the past 30 years, the fund has an average return of 8.4% annually. And now let me break that down by the asset classes. So again, these are preliminary returns. Public equity is at 36.3. Private equity is at 43.8. Fixed income is a negative 0.1. Real assets is 2.6. And liquidity is a positive 0.1. And an important note, returns for both real assets and private equity, as you know, lag by 1 quarter. So these valuations are through March 31st of 2021. Since this year's return is above 20%, which means that it will trigger the risk mitigation policy that the board put into effect back in 2015. And remember that that policy requires that the discount rate be lowered in years when our investment earnings outperform our growth assumption. This is the first time the policy has been triggered since that approval date back in 2015. And remember, this policy had been in suspense while we moved the discount rate from 7.5 down to 7 over a 3-year period of time. What this means now is that the discount rate, which currently stands at 7%, will drop 0.2% to 6.8%. That would modify the funded status from 82% to 80%. Because of the year's strong returns, the drop will not add to the contributions that employers pay toward the unfunded actuarial liability. However, it will affect the pension contributions that many PEPRA employees pay. This Thursday at 9 a.m., we will be holding an updated webinar for stakeholders on the funding risk mitigation policy and the discount rate. And I encourage anyone who may be interested in attending that event to just simply go to our website and register. And with that, I'll turn it back over to you, President Jones.
You're on mute, Henry.
Okay, thank you. Yeah, thank you very much, Ms. Frost. And I was on mute. A number of the board members are indicating, and I also heard shuffling of papers. So if you're not speaking, would you please mute yourself so that it's clear for the speaker? Okay, thank you very much. Okay, so this, now we will join, and by the way, thank you for that positive information, Ms. Frost. That's very, very, very positive information, and that's going to help us going forward. So anyway, back to our process here. We will now join into closed session for the agenda item regarding the strategic plan for real assets. The board and approved staff will log off out of the public meeting and into our closed session. We'll return to the public meeting at about 10:30 a.m. So with that, board members, if you now log off for this meeting and join us in closed session. In the public, we'll see you later.
everyone back to our open session. And we're going to go ahead and start our investment agenda. I think everybody's online. Oh, I see Ramon connecting. Hold on. There he is. All right. So welcome everybody. Good morning. And we are going to go straight into our investment agenda today by hearing from our Chief Investment Officer, our Interim Chief Investment Officer, Dan Bienvenu. Thank you.
All right. Thank you, Ms. Taylor. Let's see. Yes, it looks like we're getting the slide deck up. So, and as both Marcy and President Jones mentioned at the beginning, we've got a full agenda before us today and focusing on some really critical topics. So I will keep my comments brief. The main area of focus for today does continue to be the asset liability management work, digging into the capital market expectations, methodology, and surveying, and then a panel toward the end where Ann will walk us through some more sustainability topics. Also in the ALM work is discussing some of the portfolio preferences and balancing risks of potential candidate portfolios. So before I get to that, though, we did have a request in April to discuss possible global offices as something to consider. And so Mr. Jones made that request. So before we move on to the agenda, I thought we would go through that quickly. And, you know, consideration of potential global offices is something that has come up not infrequently. This was, as I mentioned, this was something that Mr. Jones raised in April, and we got direction from you, Ms. Taylor, as the IC chair. So I thought we would cover that briefly today before moving on to the agenda. And as I say, this comes up periodically, which is expected as the world continues to become more and more interconnected and financial centers and opportunities evolve around the globe. And really, I think that, can we get the next slide, please? I really think that the decision to potentially establish global offices would really best be considered in the context of CalPERS' overall investment strategy, and specifically in the execution of that strategy. And factors that would contribute to the need for the establishment of global offices would be things like more international assets, especially in emerging markets where local expertise is more differentiating, more private assets where exposures take significant time to both enter and exit, and therefore need very careful consideration and potentially local knowledge. And then finally, more exposure to relationship assets, where in some cases it's as important who you know as it is what you know. Next slide, please. So given where we are currently, however, I think we want to see a few imminent things fall into place before getting right to strategy execution. First, I think we want a permanent chief investment officer in place, as this is the person with primary responsibility for setting the strategy, working through that strategy with you, the board, and then executing on that strategy. Second, I think we want to complete the ALM process that we're currently in the middle of, where the board works through CalPERS' risk and return appetite and selects the policy portfolio that best supports that appetite. And then finally, following the selection of a new policy portfolio and with a permanent CIO in place, I think we want to review the current portfolio strategy to ensure that we are all on the same page and continuing to row in the same direction. Next slide, please. From there, once a strategy has been settled, I think that's when we would want to move on to the implementation plan for that strategy. And it's at this point where I think we want to review really all aspects of the business model that supports the strategy, including such things as our org structure, our staffing and our resource allocation, technology and data architecture, as well as consideration of global offices. So I guess overall, I would say that your management team definitely thinks that global offices should be considered at the right time. I just think that we believe that the timing would be better if taken up as a consideration after the overarching investment strategy is refreshed, which would take place upon the hiring of a permanent CIO and completion of the ALM process. So that's our current thinking on the topic. Definitely, we wanted to be responsive and happy to take feedback or discuss further, but that's our current thinking. And as I say, happy to take any questions before moving on to today's agenda.
Thank you, Dan. And of course, I don't see any questions here, but of course, in our consideration, we would have to look at costs as well, whether those costs are prohibitive, or return on investment is worth it. So I still don't see any questions. I was sort of giving people time, but don't see any. So go ahead and move along.
All right, perfect. So let's see if we could please get Fritzi Archuleta. If we could please get Steve Foresti from Wilshire. If we could please get Steve McCourt from Makita. And our final panelist is our representative from JP Morgan. If we could please get all of our panelists for this first panel brought forward into the attendee queue, that would be great. I see Fritzy, I see Steve, see the other Steve. Just need Tiska. I don't see Tiska yet. All right, there we go. All right, thank you. So this is our first panel for the day here in open session, where you're going to hear from, of course, your two independent board consultants, Busher and Makita, as well as JP Morgan, to talk through how capital market assumptions are both set, the methodology for setting them, and then kind of where they're looking right now. So we have Fritzy Archuleta as our moderator. Fritzy is the Deputy Chief Actuary of Special Programs. So with that, I will hand it over to Fritzy to take us through this panel. Fritzy, over to you.
Thank you, Dan. Good morning, Fritzy Archuleta, CalPERS team member. I'll be moderating this session. As you know, we are in the middle of an ALM year. With today's market volatility, one of the biggest challenges the CalPERS team faces is assigning long-term values to our asset classes, as there are varying methodologies and trends to consider. I am joined today by 3 experts in the field who have graciously offered to share their opinions on the matter. They are Thushka Maharaj, Managing Director at JP Morgan, Steve Foresti, Chief Investment Officer at Wilshire Associates Consulting, and Steve McCourt, Managing Principal at Makita Investment Group. They will each have a few minutes to give their opening remarks and introduce themselves, and then we will go into a Q&A discussion. We will start with Thushka. Good morning, Thushka. I should say good evening for you, since it's 7:30 over there, I think.
Yes. Hi there. Hi, everyone. Thanks for having me on, Fritzy. I hope you can hear me properly. We're just having a bit of a rainstorm here at the moment. But anyway, I'm going to plow ahead. So who am I? I am a global multi-asset strategist within our multi-asset solutions business in asset management at JP Morgan. I've been part of our long-term capital market assumption committee for the last 5 years, building out, very focused on the fixed income side, but also looking across asset classes, across the capital stack to look at our long-term returns. And before joining JP Morgan, I was on the sell side as a fixed income strategist at an investment bank. So I was going to spend my sort of few minutes speaking about what our long-term assumptions are, what are some key takeaways from the current rounds of the LTCMAs, and a bit about our ethos, which I'm sure we're going to follow up more in Q&A. So our LTCMAs, long-term capital market assumptions, are forecasting across macro variables, growth, policy, and inflation over a 10 to 15-year timeframe. We look at this time horizon to capture at least one business cycle. We actually lengthen the period of time we look at LTCMAs after the last business cycle that we've been through, from 10 years to a formal 12.5-year window. So trying to bridge between 10 and 15 years. And the aim is to capture a whole business cycle across the global economy. We've been running the process now for 25 years in different guises. It's evolved through time. And in the current iteration, it's over 16 different currencies and 200 assets. So it's quite a broad range, which means that we are trading off the depth versus the breadth. And in most cases, we try to optimize across those two axes. There are 2 main sort of anchor points for these long-term capital market assumptions. One, our macroeconomic framework, which is across growth, inflation, and policy, which we use to define the environment we're going to be in over this 15-year period. And then the second anchor point is our equilibrium market assumptions, whether that's equilibrium bond yields. We call these equilibrium, but they basically our long-term trend rates. They're not some measure of R star or some measure of the economy in balance. It's basically our long-term convergence levels. So these equilibrium assumptions for us are what we consider consistent with that macroeconomic framework, and they govern our asset market returns across fixed income, equity markets, and then private assets. And I'd say the main ethos for these long-term forecasts are essentially using a building block approach that looks across different drivers for return and try and make those building blocks as transparent as we can. Talk about where the qualitative input comes in, but try and be as transparent as possible on where the sources of return are. So for example, in our growth forecasts, we look across the labor market and population growth, we look across capital stock growth, and we look across total factor productivity. So those are the three main building blocks for our growth assumptions, and we translate that across other asset classes. Some key takeaways in my last sort of 2 minutes, some key takeaways from our current round, which was run at the end of last year. These are annual publications. They were published in November last year. Basically, we are expecting a changed policy environment where we're seeing more active fiscal and monetary policy coordination, which for us doesn't necessarily change the growth picture, but changes how we think about inflation risk premia. And even this year, we went so far as to actually change our base case for the inflation outlook, not just in the US, but across developed markets. The other sort of broad brush thematic takeaway is we're seeing this theme of winners and losers, or this theme of dispersion, both within an asset class, but also inter-asset class developing. So we think about the last 10 to 15 years post the global financial crisis, we saw a lot of convergence, a lot of liquidity sort of masking and papering over differences between assets and lifting all boats. But now with this reemergence of fiscal policy as an active tool, we're expecting more differentiation or this idea of dispersion within assets, whether that's coming out of the COVID recession, whether that's through climate adoption policies, whether that's fiscal implementation and effectiveness of fiscal policy over the medium term. And for us, that is a key difference to the last 10 years. The other is a theme that we've had for a while, focus on international equity market exposure for US-based investors, partly because of valuations, but partly to get access to these key themes that we think are relevant over the next few years. The final thing I'd say is, something we've all talked about, and not necessarily a surprise, but we spent a lot of time in the last year talking about alternatives, moving from optional to essential in portfolios, whether that's for alpha generation, whether that's for income substitution from public markets, or whether that's diversification of existing portfolios, because crucially our public market return numbers have come down pretty substantially and remain much lower than what we've seen over the last 10 years, and therefore using alternatives more actively to replace that is a key theme. I'll stop there, Fritzi, and happy to follow up later.
Thank you very much, Lishka. Next, we'll go to Steve Foresti for his opening remarks.
Thanks, Fritzi. Good morning, everyone. Steve Foresti from Wilshire. I serve as CIO of Global Asset Allocation and Research, and then responsible for overseeing Wilshire's process of developing capital market assumptions and in fact, the entire asset allocation process that uses those assumptions as inputs. I'll try to start at a high level here and then try to navigate my comments around to hopefully not be too repetitive. There's quite a bit of overlap between what you just heard and the way Wilshire goes about it. But I think it's important to start out with just setting a framework and an understanding that in the end, while there's a whole body of work that goes into developing forecasts, studying markets, and trying to understand not just what the expected returns are, but what the risks are around those returns and how they combine within a portfolio. In the end, these are forecasts, and they're notoriously difficult. There are certain places where I think our level of confidence is much, much higher. I'll point to high quality intermediate bonds where we can just observe market yields, and that tells us quite a bit about what our expectations might be going forward. But then you get into asset classes that have lots and lots of volatility around the way investors are going to price that asset. And that can change very abruptly and is what makes certainly short-term forecasts notoriously difficult to capture. So kind of stepping in, it's interesting, this weekend I was on the Bloomberg terminal. I think there was an appropriate quote. They always have a quote of the day, and it was Peter Drucker, the kind of famed corporate consultant, author, educator. And it was essentially, the quote was, the one thing we know about the future is it will be different. And while that might be a little bit of an overstatement, I do think there's observations we can make, and there's some, I mentioned the point about certain pockets of the market, we can have more certainty than others. In the end, we are trying to quantify what the risks are that drive that uncertainty. And just because it's challenging to do, doesn't mean it's not an important exercise, because there is a tremendous amount of understanding that we can get from markets, not just looking at these historical relationships, but the way they're priced in by markets today. And in the end, these are just going to be inputs that go into a process of asset allocation that's going to seek to build diversified portfolios. It's that diversification on its own is essentially the statement of this uncertainty and how to manage the uncertainty around asset classes. Last point I'll just make about how our standard assumptions are 10-year forecasts. So very much what you heard about JP Morgan's process, we're looking at making sure this is kind of business cycle, goes across market cycles and captures general relationships. We do also maintain what we refer to as equilibrium assumptions, a little bit different than the JP Morgan definition. In our case, these are long-term, essentially, infinitely long kind of expected premia that can be collected from markets that are completely independent of what today's valuations are. We use those to combine with our 10-year assumptions to derive assumptions for 20 and 30 years. And I think in past work we've done in supporting CalPERS, you've probably seen some of our 30-year numbers and some of those equilibrium numbers. As to our shorter term, and by shorter term here, I'm talking about 10 years, very much consistent with this expected low return environment. Why do you hear that from many advisors? From us, you'll hear it from Makita, I'm sure. You've just heard it from JP Morgan. With all this uncertainty, how can we all kind of uniformly believe that the future is kind of anchored to an expectation of somewhat muted low returns? One of the places where we have the most certainty around our assumptions is in the area of high quality bonds, and we can just observe the yield, which essentially in certain cases, when it's high quality, very low chance of default, and the reinvestment uncertainty is low, that yield is essentially your destiny as an investor in terms of return. And I've shared charts in the past with the committee in terms of showing the relationship between that going in yield, I'll refer to it as, and then the subsequent 10-year return that's realized. And it's a really strong relationship. So it all starts there. Asset classes then compete for capital and have to have some idea of a being kind of hinged together, much like what you heard from JP Morgan. Our process does that through an economic factor approach that looks at growth, looks at inflation, understands how those factors are delivered through different asset classes, and then probably more importantly, how those economic factors impact the risk of asset classes as markets adjust to new information, whether it be about growth, inflation, or something else. So looking forward to the discussion, and Fritzy, I'll leave it there and look forward to the Q&A.
Okay, thank you, Steve. And last but not least, we have Mr. McCourt.
Great. Thank you so much, Fritzy, and nice to see everybody. I can't wait to see you all in person sometime soon. Stephen McCourt, Makita Investment Group. I have been involved at some level in developing capital market assumptions for Makita and its clients for the last 26 years. And over that time, there's been a lot of changes in how the industry has thought about forward-looking return expectations. Today, we look at capital market expectations at least once a year, sometimes more frequently when capital markets are changing quickly. And we're helping all of our clients in various degrees with asset allocation decisions that are based on those capital market assumptions. I won't eat up more time explaining our process for doing this. I think a lot of that will come out during the Q&A. What I will like to start with, though, is reinforcing part of what Steve Foresti had highlighted on, is having a bit of humility with thinking about forward-looking return expectations. To state the obvious, none of us knows what the future will bring. There's a very unfortunate term in our industry called the expected return that you will see, I'm sure, throughout our presentations and future presentations as you go through the ALM process. Using the term expected return gives one the sense that there's some expectation that we have about the future. And if we know anything at all about the future, is that if you have any expectations, you're more likely to be disappointed than happy as the future unfolds. I would encourage you to think about the expected return of asset classes or portfolios, not as an expectation, but rather as an objective midpoint of what asset classes or portfolios might produce for returns over the next 10 or 20 years, whatever the time frame is. I think all of us on this panel do our best to be objective, to be thoughtful, and to provide non-biased forward-looking estimates for all of the potential asset classes and strategies that institutional pension funds would invest in. But I would hesitate to call them expectations because I think that probably imbues a level of knowledge about the future that we simply don't have. So with that, I will hand it back over to Fritzi. And thanks again.
Thank you, Steve. I can certainly appreciate that. With the actuaries too, it's like all of our assumptions. We have assumptions, but they hardly ever pan out. So I get what you're saying. Thank you. Okay, so we'll go ahead and start with the Q&A. These first few questions are circling around methodology. So we'll go with Steve Foresti first. This question's for you. What are the key factors long-term multi-asset class investors should be thinking about when investing globally?
So I guess, and thanks for the question, Fritz. I'll start with something I mentioned in my opening remarks around diversification. I think the obvious place we all talk about diversification is around asset class diversification. Some combination of stocks, of bonds, real estate, private equity, private debt, and trying to put a portfolio together that balances risk across those asset classes. I think as you look at a global portfolio, and indeed a world that over the last several decades has benefited from lots of globalization and integration of markets, I think arguably that might have slowed down here a bit. And another place where the future is uncertain in terms of the pace of that globalization or potential retreat. But another important part of diversification is global diversification. So not just diversifying by assets, but within assets and having regional. So if you think about the global equity market, you've got the US component, which is a bit more than 50% by market capitalization. And there's not just a big world out there, but a big list of companies that operate all across the globe. You've got developed markets in Europe and Asia Pacific. You've got emerging markets. And there is a benefit to diversifying regionally across these assets. I think that level of diversification is one that in the short term has become very challenging for a lot of US-based investors to appreciate and stick with. Because in fact, the one other thing we know with certainty around diversification is there will be winners within that diversified portfolio. There will be losers in terms of whatever backward-looking period of realized returns we're talking about. And one of the pockets of a real strong winner in recent years, and indeed the entire past decade, is the U.S. equity market has just dominated from a returns perspective. And as investors look at their global diversification, it's easy to look at that and start losing some of the faith, some of the knowledge, and some of the wherewithal to stick with that diversification. But if you just look back in time and you see various leadership changes through time on a regional or a country basis, and this could be over decades or it can be even over a much longer period than that, I think you start appreciating what that global diversification can do. And much in the comments that Shushka made in terms of non-US versus US. We too, at the moment, on our 10-year assumptions, do look outside of the US and see a return premium of about 1% for both the developed and emerging markets over the US markets. Now that's not a heroic assumption of some huge amount, but it does suggest that these relationships are not stable, and there are benefits to having and maintaining that global portfolio. Just as I wrap up, one comment, because I forgot to mention in my earlier comments that we do update our assumptions on a quarterly basis. So typically they're not going to change much. I will tell you though, in the last 18 months, so the last, call it 5-6 quarters, we've seen some pretty significant adjustments in those assumptions, and that's again tied to the pricing environment. You can imagine coming through March of 2020 and then into the recovery in the middle and back half of 2020, how much those assumptions may have changed. So with that, Fritzi, I'll pass back to you. Thank you.
Thank you. Do either of the other panelists have anything to add to Steve's answer?
I guess the only thing I'd add in terms of what are the factors, I think in a way the separation of the cyclical from the secular drivers of the return are quite important. Steve mentioned the US equity market as a key example where the last 10 years it's dominated the environment. But over the long term, we want to focus on what are those drivers for that secular return, and just trying to, as far as possible, abstract away from that cyclical starting point. I think that's quite an important consideration when investing. And the last thing I'd say is, I agree with all the other panelists. One thing we know for certain is our forecast may not, is unlikely to realize. But one thing it does force us to do is that systematic discipline on how we derive those assumptions. Why are we adding this new variable? Why is this important today? And I think just going through that systematic, sort of unbiased process does force that thinking in terms of focusing on what's cyclical versus secular. Thanks.
Mr. McCourt, did you want to add anything, or?
I think I got the next one. So why don't we just skip to that one?
Okay. All right. So question number 2, how do starting point and horizon influence estimates of CMAs? Why do they change so much from quarter to quarter, especially now?
Great. Thanks. I think this is really important to recognize, and provide some insight on how those of us involved in modeling CMAs go about the technical work of developing the forward-looking estimates. I'm sure each of the panelists today have somewhat different methods for developing forward-looking risk and return estimates, but all of them likely boil down to a few common factors. And those common factors, generally speaking, relate to the current valuation or pricing of assets. Are assets expensive or cheap relative to history? The discount rate, which is typically based off of an interest rate that you discount future cash flows off of, and the growth rate of those cash flows over time. Almost any asset or asset class can be reasonably modeled based on those underlying assumptions. The reason that the starting point matters, even when you're smoothing out these changes over a 10 or 20 or even 30-year time frame, is that you can have very significant changes in interest or discount rates in these models from year to year, or as Steve highlighted, even quarter to quarter recently, that can really move what the models express as the intrinsic value of asset classes, and therefore the forward-looking returns. So just by way of example, if you have interest rates, the risk-free rate fall by 1 percentage point, you're likely to see forward-looking, all else equal, forward-looking equity returns fall by as much as 1% a year for the next 20 years. So there's a lot of leverage built into these models, the outputs of the models based on these few inputs that we use, and these inputs change fairly regularly. The sort of trillion-dollar question in these models is, to what extent are the inputs and the initial conditions of these models a temporary phenomenon or not? And as we've highlighted before, and you've heard before from other presenters, when if interest rates normalize and recover over the next several years, one can make a case that longer-term return expectations will migrate back towards more normal levels as that normalization process happens. But if you have interest rates, and particularly real interest rates, that are more or less permanently much lower than they have been historically, the models generally express a much, much lower forward-looking expected return. Likewise with growth rates, which are based generally on assumptions of global economic growth, which today is lower than it has been historically for a variety of reasons. So I'll conclude by drawing an analogy with respect to the time horizon and the influence of your starting point in these studies. The studies themselves can be thought of as a race, and the race will have a distance to it. It could be a 100-meter dash or a marathon. And obviously with ALM studies, we're looking at marathons. We're trying to project forward-looking returns over the longest possible time frame. The current positioning in the business cycle, or the interest rate cycle, or the valuation cycle in the markets can be thought of whether or not you're running that race with a headwind or a tailwind. And right now, with interest rates at historic lows and valuations at historic highs, it's clear to anyone looking at models of the future that there's a headwind. Now, that doesn't mean you can't run a really fast marathon over the next 26 years, but it does mean that you're much more challenged in putting together a good time in that marathon than you would if there were a tailwind over that time period. So Fritzi, with that, I'll hand it back over to you and the other panelists.
Steve or Thishka, did you want to add anything to that answer?
I'm happy to. It's kind of a metaphor I'll throw out there that I think is helpful in thinking about the horizon issues that Steve talked about. And the way I kind of like to think about this, whether it's going from quarter to quarter, or year to year, as the assumptions changes, there's new information that comes into the market. And let's think about a pebble dropping into a pond, and then a ripple effect. And the ripples early on where the pebble hit are going to be larger, and they start to dissipate. And kind of think about that input as you get farther out, maybe from a 1 to 2 to a 3 to a 10-year assumption to a 20, that eventually those get very muted the further you go out. So I think the instability that Steve talked about absolutely attaches to horizon. Sometimes those pebbles are different sizes. So think about the COVID situation that we've all gone through. Instead of a pebble, that was a big rock that hit the pond, and then you have these large, almost waves instead of ripples that have a larger impact. So I'll kind of put that picture in your mind in terms of thinking about how new information would hit forecasts over different horizons. And then the last thing, maybe just I pulled up some numbers here, and these are numbers we put together each year, just in terms of you think about forecasting predictiveness. Forget about even a forecast. If you just look backwards at the relationship between some of these major asset classes, we're investing in stocks, for example, because we expect a premium for taking the risks that are embedded in equities. And if you just look at winning percentages on an annual basis between just stocks against bonds and cash, just over 1 year periods of time, stocks win about 2/3 of the time, 64%. This is over the last 100 years or so. Not bad. It's better than 50-50, but not a ton of confidence that risk taking is paying off in a dramatic way. As you stretch that holding period out to 5 years, that turns into 73%. So nearly 3 out of 4 years, stocks are going to win in that competition. You stretch it out to 10 years, you're now up to just about 80% at 79%. You stretch it out to 20, 96%. So the reliability, and this is one of the huge advantages of a long-term investor like CalPERS, is just this time horizon and managing through the noise. And you have to survive the short term, obviously, to collect those premia. But in the end, it's about putting a portfolio together that's well positioned to try to convert risks into returns and really take advantage of that long-term advantage.
Okay, thank you. Dushka, sorry, did you want to say something?
I just had a very brief comment. This point about starting point today is a big challenge for us. We're going through our annual process at the moment. And just to give you an example for the US large cap market, knowing what we consider to be the secular starting, what's a normalized price to earnings ratio today is extremely hard to be modeling. And it's always hard to do this every year. I'd say the current environment is extreme. It's added more complexity to this issue of what we as investors should be willing to pay. And I think that will reverberate across all our equity assumptions this year.
Okay, thank you very much. Okay, this next question is for you, Dushka. Asset class labels can sometimes be too generic, with underlying assets differing in type, region, and risk. How do you address this problem when developing CMAs?
Yeah, thanks for that, Fritzi. I was thinking through this, and for us in public space, it's easy for us to delineate across region and market cap and capital, capital size of structures. In alternatives, clearly, that's where we find the issues. And basically, the constraint is the data. So, for example, even though we'd like to be granular on in terms of the smaller components of private equity or the smaller cap parts of that market, we have to be guided by what we consider to be reliable data sources that give us long histories to build that. And so the way we deal with this issue on data limitations is to focus on what we consider the industry composite. So for hedge funds, for example, using HFR data, for private equity, using data we have from known trusted sources, but also at the same time being as transparent as we can be about those building blocks that go into building those expected long-term returns. So, for example, when we're looking at our private equity assumptions, we use firstly our beta assumptions for public markets, add on our alpha contributions per region, as well as across the capital market size or the market caps. And that in this way, at least we are providing the starting point for those discussions with our clients, but also discussing the limitations of data. And the final thing I'd say in the private space where this challenge is clearly limiting is to focus in real asset space on differentiating across the risk spectrum, core versus extended parts of real assets, focusing on in core space those existing or visible or known cash flows that we are comfortable forecasting. So in a sense, the main ethos of why we focus on those building blocks is showcased by this question you asked on what how can we be granular across asset classes by being as transparent as we can on the inputs and the building blocks is the easiest way for us to talk about the uncertainty in these forecasts, but also to highlight the areas where we think we have reliable data sources that are usable or trustworthy enough to use for forward projections. I'll stop there, Fritzi.
Thank you. Other panelists?
I would just highlight from Makita's standpoint, we end up modeling roughly 90 sub-asset classes within each asset class. So even though our asset allocation policies with our clients may only contemplate 6, 7, or 8 large asset classes, we're looking at a level of granularity that's pretty significant beneath each of those, and that allows us to sort of customize the CMAs based on the specific investment structure within each asset class.
And then maybe I'll kind of echo that. Steve, we're not at 90, but we're probably somewhere in the 70s, and we very much look at these as ingredients almost of all these sub-asset classes. And if we need to put together a custom assumption, it would be essentially combining those underlying risks and the expected premium for taking them together. So you can work from those 70 to a much bigger list. But I guess just to underscore the earlier points, I think in the end, it's about defining as precisely as you can that market segment that you're trying to model, and whether that's in the public markets or the private markets, it really comes down to, what is the object we're trying to understand, and then what are the underlying characteristics that drive both the risk and the return.
Thank you. That's very helpful, actually. Okay. And this one's for Steve Foresti. What role do currencies play in your long-term CMAs? Are emerging markets and currencies qualitatively different?
Currencies are a routine part of the modeling that we do across many of the asset classes. In the end, when you're investing outside of your home market, so as a U.S.-based investor like CalPERS, to participate in the rest of the global equity markets, essentially you are exposing yourself to currency risk to purchase those assets. You're converting dollars to a foreign currency and then purchasing those assets in that foreign currency. So you have both the embedded in that or packaged together as effectively exposure to the assets you're buying, those foreign equities, but you also have exposure to the foreign currencies. And that can either be just accepted as part of that package, or there's ways to potentially hedge some of that risk if it's undesirable. So in our kind of world, and I'll just use global equities as an example, in addition to maintaining regional assumptions for the developed ex-US markets and emerging markets expressed in US dollars, we also maintain assumptions that are assumed to be hedged. And the consequence of that is you compare US dollar-based returns and risk to hedged returns and risk. From our perspective, over the very long run, we're expecting currencies to wash out. Now, that view could change over particular periods of time, but generally speaking, we're looking for currencies to wash out. Now, in fact, the risk or the volatility that currency fluctuations are going to add to your investments doesn't really wash out. So it does increase. If you just look at, like an IFA developed market exposure, you're probably looking at historically be something like 2.5% higher risk. The currency risk is actually much higher than that, but there's a bit of a diversification effect in those two things you're getting, the currency risk and the underlying equity risk. But it does increase the general volatility of the investments. You think about the emerging markets, it might be a little bit more than that, maybe a 4% difference between the volatility of a US dollar-based investor and then the volatility if you hedge out, it's about a 4% difference. But currency does come into play. I think the impact I just described in the equity markets is a bit subdued versus if you were to compare high quality bond investment outside of the US with and without currency hedged. Suddenly currency is a huge contributor to the risk because you're now taking a more volatile asset, i.e. the currency, relative to the asset that you're purchasing. And so you can really, in a hedged approach to bonds that are denominated outside the US, you can really have a material impact by hedging that currency risk out. But it's a natural part of the assumption suite in terms of where there's exposure to these currencies and what that risk is.
Thank you. Other panelists?
I would just summarize our approach to currencies is that we do model them and put a high degree of confidence in the volatility or risk that you're exposed to when you're invested in foreign currencies. And we put a very low degree of confidence in any headwind or tailwind in returns associated with currencies. They are famously challenging to predict the returns of. So currently our models do express that the US dollar is somewhat overvalued. So part of the return advantage, modest return advantage of equities outside the US is driven by currency, but we really limit what the models are telling us because currencies are just very, very challenging to predict.
Yeah, I guess the only thing I'd add to that point about are EM and currencies qualitatively different, EM assets versus the EM currencies. We can debate the point about China, but for certain currencies that are pegged or managed, we do see big differences between how you would express a view on that emerging market, whether you use the currency or not. And then the second point I'd say is that there are certain companies listed in equity markets in EM that have general or global revenue streams. So they're not only dependent on the underlying domestic growth picture, and there we would see differences between the underlying EM asset and the domestic currency. And then China is the other part of this equation. Accessing secular growth stories in that market outside of the currency do look like attractive opportunities for us. In our currency forecasting framework, which we do across 16 currencies currently, in DM space, it's about inflation, long-term inflation differentials. So we're using a PPP, purchasing power parity framework. For emerging markets, we add on top of that our assumptions about the convergence to the technological frontier per currency, and that is implying the same as what we heard from a fellow panelist about the dollar being modestly overvalued, but equally we see quite a strong dispersion across emerging market currencies currently. Confidence levels may vary across those markets, but that's the underlying theme.
Thank you. So that concludes the methodology questions. It's a good time, I think, right now to have a break and ask any of the board members to have any questions or ask any questions if they see fit.
I don't see any questions, but I'll ask a question. So I just had you guys said it more than a few times. I just kind of want to reiterate that we are in this territory of, making these capital market assumptions. And I just want to kind of reiterate that we're sort of still kind of doing guesswork here. I hate to call it guesswork, but how often have we been on target, for example? I don't know if this is a Dan question or one of our consultants, when we've made these assumptions in the past.
Maybe I'll take a first stab at it, but then I'll look to everybody else to throw in. I would say it depends on how you define on target, Ms. Taylor. It's a terrific question. I would say that when we're trying to get a point estimate for returns, for volatilities, for covariances, we're going to be wrong. We're trying to pick out 20 years. And so if we're trying to actually hit a specific target, I would say we'll never be on target. We know that. But I think it was Steve McCourt that mentioned that a lot of it's about coming up with sort of a probability distribution around where that is, and then a set of paths that can get us there. And that's so much of the modeling. And you'll see Sterling cover quite a bit of that in the 2 afternoon sessions where we'll talk through that. So we're more confident in our ability to predict risk than we are returns. However, even within that, I would say that to nail a target for either risk or return is highly unlikely, but our ability to, just say predict sort of a probability distribution and then a confidence level around that distribution as well as some of the paths, those are some of the things that we want to walk through, because it's really about those assumptions and then sensitivities to those assumptions in terms of how wrong you can be. That is where all of this, this forward-looking, portfolio management and strategic asset allocation work, really, that's where the magic lies.
Steve or Steve?
I might just add one thing, which is important because it's easy to focus when you're talking asset allocation on the expected return of an asset or the portfolio. But really, one of the primary purposes of doing an asset allocation study is to measure and determine the amount of diversification benefit you can get by allocating assets across a wide range of asset classes. And to Dan's point, when you look back over time at anyone's ability to predict the returns of stocks or bonds over a 20-year period, it's not perfect. I would argue it's been, for the last couple of decades, directionally correct for most people, but you're not going to get the number spot on. But I think what's equally important is that the models have done a fairly good job of expressing the relative returns of stocks versus bonds versus other asset classes over time, and that allows you as a board to confidently make judgments on allocating assets across a variety of asset classes and benefiting from some modest diversification benefits in doing so.
And if I could just jump in at Sterling Gunn here just for a second. I think everyone here is kind of seated, like predicting and projecting returns is a very tricky business, and there's a lot of noise and uncertainty. So you'll see in the ALM, a lot of what we do is to try to explore, actually, as we've talked about in the past, the range of outcomes, which is sort of a way of preparing ourselves for what could happen once we choose a portfolio. And we try to better understand, like, just, are the range of outcomes for a portfolio actually acceptable to us or not? If they are, that's great. But if we see a portfolio where, you know what, under these circumstances, we can't tolerate that, then that's probably a portfolio we have to reject. So it's very much about preparing and less about actually predicting or projecting.
Thank you. I do appreciate that. I know it's difficult. I had two more questions. One was, and Mr. McCourt, you brought it up, the diversification. And I thought it was interesting that because U.S. equity has dominated for over the last decade, that are we looking at, or are you folks looking at diversifying us a little more into global assets outside of the U.S. because of that? Because we've already had this 10-year period of really good dominant U.S. equity. So are we saying, okay, now let's hedge our bets and go elsewhere?
I think there's an aspect of the response to that question, Ms. Taylor, that will be more of a tactical judgment from staff than an asset allocation judgment. But to the extent that the models will direct you towards an asset allocation policy, they may, at the margin, as we may get into, much of what drives the relative risk and return of these asset classes is the initial valuation of the asset classes. And because U.S. stocks have performed better than international and emerging market stocks for over a decade now, fairly consistently, their valuations are a bit higher. So it wouldn't surprise me if at the margin, the return assumption for assets outside the U.S. is somewhat higher than it would have been in the last cycle. And that may cause a modest shift as you look at as you look at asset allocation policy. But that being said, I would highlight that the U.S. equity market is still by far the largest equity market in the world. It doesn't include the explicit currency risks that non-U.S. markets have. And so these models will always point you to a lot of allocation towards U.S. stocks as a U.S. institution.
Okay, great. I appreciate that.
Ms. Taylor, maybe sorry, Mr. Maybe
Go
one
ahead.
point to add, just to point out and note that it probably needs or benefit from highlighting that CalPERS maintains a very globally diversified portfolio, more so, I think, than if you look at the average U.S.-based peer, with a globally diversified equity program, for example. So I think you've got the global diversification built into your portfolio at the moment.
So I appreciate that, you guys. And it's interesting because I know that I remember getting people kind of saying, why are we, I think at the time we had lower than 50% US equities or something. And people were asking, why are we doing that when they're doing so well? Dan, I don't remember if you remember that. And I don't know if we changed the mix.
No, I do, and this speaks to what Mr. Frusty was saying, what Steve was saying, is that CalPERS went to a global cap-weighted portfolio over 10 years ago, just believing that was the most diversified, and that again, that it's very difficult to predict, countries or even regions. Many of our U.S. peers have a home country bias, so they're maybe 2/3. Because previously we had been 2/3 U.S. domestic, 1/3 ex-U.S. And, so, as I say, ours is a very broadly diversified portfolio. We are going to look at this very topic as we go through, and we'll have some discussions. And this is definitely on the radar for Sterling's team as we go through the ALM process, is to look at that. But I do think that underscoring what Steve Frusty had said earlier, this potential for when you drop a pebble into a pool, and then the ripples go out. When we're talking about forecasting, and Marcy spoke to it earlier, that forecasting over a very long horizon and decades and generations, we think that one of the few free lunches that you get in the investment business is diversification, and that's one of the reasons for the move to really a global cap-weighted portfolio and very broadly diversified.
Great, thank you. And Henry, I see you. I had one more question. I will turn it over to you. And we have a question in the chat.
You can continue on, Ms. Taylor. Continue on until the break.
Okay.
Okay.
So my last question, and thank you very much, Dan, for that answer. Basically, as we're doing these capital market assumptions and with our consultants and everyone else, do we take in our market risk considerations, like the environmental risks right now that are really big, actually, when we look at wildfires, the heat waves, et cetera, geopolitical risks? Is that all into consideration along with the basic market valuations and stuff?
I guess in a word, the answer is yes. Yes, all of those are part of our forecast. All of that is integrated into the set of things that we consider as we look at all of our market expectations on a go-forward basis. And then, as I say, we come to a point estimate. We have to, but then to what Sterling said previously, really importantly, we come to then a set of sensitivities around that, a distribution around that, and then a set of paths that the various portfolios could take, on the way out that sort of 2-decade time frame, and then looking at are there aspects of that we just can't live with. But yes, that was in a word, the answer to your question is yes. That's definitely part of the.
No, I got it. It was a long answer, but I got you. And then that's it for me. But I do have a question from Ms. Middleton.
All right. Thank you. This question for any of the panelists. I really appreciated the comment about the need to diversify, both in terms of asset classes, but as well as diversification regionally. And I also appreciate the comment that you believe our portfolio already is reasonably well diversified on a global basis. But I'm still struggling to understand what kind of benchmarks we should be using in making an assessment as to whether or not we are appropriately diversified on a global basis. And that question, the question is, what benchmark should we be using?
maybe I'll start. I don't know, Dan, if you want to make comments there, but I'll just attach to a point I made earlier about being precise about the thing that the segment of the market that you're attempting to understand in terms of its risk characteristics. So CalPERS has various equity benchmarks, kind of traditional cap weighted, and that would be the appropriate benchmark to measure what the underlying risks are. And by the way, cap weighted benchmarks going to change over time as a country like China, for example, becomes a bigger and bigger component of not just the emerging market, but the global market. The risk characteristics of that benchmark itself will change over time. It could get more or less diversified with those pockets of growth. We've certainly seen that, in the US as you get big sector shifts. And maybe Ms. Taylor, this attaches to your question about, environmental risks, right? At one point in time, the energy sector was a much bigger component of the U.S. equity market. In fact, the global equity market now, it's a much smaller component. So these things change over time. It's important that the benchmark is appropriately capturing those changes, but you also have other styles of investing within equity and have identified appropriate benchmarks. And there's a whole governance process around making sure that those benchmarks are appropriate for the risks being taken. But in terms of the I'm not sure how to come across the point of, is there enough global diversification? I think those are the portfolio trade-offs that Sterling mentioned. And while you're unlikely to see 50 different portfolios to choose from, those characteristics, those trade-offs are all part of the process of combining assets and trying to really get an understanding of, is the diversification that comes from that global exposure worth the incremental risk? I talked about currency being one of them. Emerging market risk is another, geopolitical. So the flip side of the diversification is you've spread your risks out, which is good. If something pops up, it's less likely to create a major problem for the portfolio. Now, the flip side of that is the more spread out you are, the more likely you run up against a problem. It just hopefully is a very small problem, right? So it's that sort of breadth in diversification is nice, but it means you're constantly wondering, oh boy, I read something about this happened in this pocket of the world. Do we have exposure there? And the chances are the answer is going to be yes when you're globally diversified.
Thank you.
I would just highlight that within asset classes, particularly public market asset classes, there are very well established benchmarks and global benchmarks that provide a really kind of clean expression of a theoretically diversified portfolio based on the underlying assumption that stock and bond prices are reasonably efficiently set by the market. What's potentially more interesting is, is there a benchmark for diversification across asset classes in a multi-asset class portfolio? And I would argue there's really not. The judgment of how much to invest in stocks versus bonds versus other asset classes is really the outcome of ALM processes just like this. And I think one of the interesting components of this to think about as you go through it is the most long-term investors in defined benefit plans, by their nature being long-term, accept a large amount of equity risk in their portfolios. It's both the most well-compensated risk in a portfolio over the long term, and also a risk that long-term investors are able to accept. But as you move to riskier and riskier portfolios and take on more and more equity risk, the portfolio by its nature becomes less diversified across asset classes. There's less available to invest in bonds and other diversifying categories. So it's worth kind of thinking about the trade-offs between higher equity-oriented portfolios and the ability to diversify risk away by allocating across multiple asset classes.
In the general literature over the last year or so, there's been an awful lot of media conversation around the global supply chain and the risks that COVID has exposed for all of us because of the global supply chain. Do you see that as having any impact as we try to invest globally over the next 10 years? And aren't we looking at increased risk in global markets because of increased tension between on a geopolitical basis?
So I think we had this as a question, but maybe I'll just take it right now. And I think the short and most accurate answer, Lisa, is yes. There's a lot of risk in the world today. Certainly, coming out of a pandemic and a global economic shutdown, which we witnessed over the last year, is nothing that global capital markets have been through before. So the most honest answer that any investor would give is we don't know how the global economy will react to all of the various issues that arise from the pandemic. I would highlight that most of the expectations that are built around risk and return, whether someone acknowledges it or not, are based on underlying assumptions of how the world will unfold over the next several decades. It's hard to look at forward-looking expected returns without acknowledging some baseline assumptions of how the world economy will operate. And I think right now, those underlying assumptions are appropriate to consider, and they in some order of importance sort of hit how fiscal and monetary policy is set in the major economies of the world, which right now investors are presuming now and forever extremely favorable fiscal and monetary support for the capital markets. The markets are assuming continued progression of global trade and globalization, which has been one of the key underpinnings of why capital markets have returned as much as they have over the last 30 or 40 years. They are assuming that geopolitical tensions, while they might remain, they will also remain fairly contained over time, since it's in everyone's best economic interest to continue to allow GDP growth to grow in the aggregate. So, and many, many more, of course, but all of these are expectations that markets have and market participants have in pricing assets today. The biggest risks to forward-looking returns may not be risks that we're not thinking about today. They might simply be risks that those underlying assumptions don't play out the way we think they will. And I think you highlight, one of those ways in which the underlying assumptions could simply not be correct. If supply chains are built back up by corporations to include much more redundancy, that means much more costly supply chains that reduce corporate profitability, that all else equal will result in lower returns for equities. If supply chains are not allowed to be as global as they have been historically because countries continue down the path of nationalism, that will result in higher cost inputs to corporations and lower profitability. So there's a host of assumptions that investors make when they buy and sell stocks and buy and sell bonds that are worth acknowledging. And I think those are two really interesting ones.
Stephen, thank you. That's really helpful. And I'm certainly not arguing that we retreat from the global market, but how do we assess the risks that we've got in that global market? Last question, looking at our portfolio today and the capital market assumptions that you have, going forward, what kinds of changes, if any, should we be prioritizing in terms of our current portfolio?
Maybe I'll take a first stab at that, Ms. Middleton. So it's a terrific question. I would say that there are a handful of things that we're looking at. One is, first of all, more private assets. We know that, to your question on diversification, we know that private assets bring diversification, both in terms of being in different parts of the market, but then also just in an accounting diversification, which is actually helpful when we think about volatility around contributions and the like. So more private equity, more real assets, exploring an allocation to private debt. I think those are the things that are really critical. Another one is, and we talk about diversification, is potentially thinking about how we look at our the global nature of our portfolio and considering, would we want to take more of, some other aspect of that. And then I would say the final one is leverage, looking at the strategic use of leverage. When you have a positive assumed rate of return set of assets for a portfolio, having leverage, having more of those assets will give you a higher assumed rate of return. However, it will also give you more volatility around that return because you've got more assets for a certain amount of net asset value, so to speak. So all of those things are some of the things that we want to look at as we walk through this ALM process to say, how do we, what should be the next step of the evolution of our portfolio? And I think I would be remiss if I didn't mention this, and you've heard this from me before. One of the things that's worth noting is that all of those areas where we think that potential returns are good are areas that can also bring, number one, risks, but then also, number two, noise. They just happen to be kind of noisy parts of the market. So private equity, we know, tends to have, high costs and have noise. Private debt, emerging markets, you name it, your leverage. So it's balancing all of, this is the work for this year. And again, it's, probably the most critical body of work we're doing right now, balancing our appetite for those risks, for the returns, for the noise, all of those things that come with it. That's exactly the work with the board, is to develop an understanding of what is the board's appetite for all of those various risks relative to the returns that are associated with them.
Right. Jan, thanks.
Thank you, Lisa. Yes, I do have one more question. Mr. Jones?
Thank you, Ms. Taylor. Yeah, this question goes to this whole body of work, risk and return, recognizing that there's not a lot of moving elements in reaching our ultimate decision of determining our discount rate. And when we get those candidate portfolios ultimately, where we have to make a decision, go with candidate A, candidate B, candidate C, we're looking at the risk and return of those different portfolios. And so I'm wondering whether or not there's a mechanism or a tool to evaluate risk, what risk units relate to the return. In other words, how much of additional unit of risk we take will correspondingly produce an additional unit of reward. Are there tools or processes to can help us, when we get to that point, of course, to evaluate, looking at those candidate portfolios to make that decision?
This is another one, and I'm sorry, Steve, you mind if I take a quick stab?
Yeah, no, I was gonna point to Sterling, which is, I'm guessing, where you're going too, because I think these risks are part of what you'll see this afternoon. Yeah.
Absolutely. So this is another one, again, that the short answer to your question, Mr. Jones, is yes. All of those things are the things that we'll look at, and Sterling is going to start introducing that topic, and I'll let Sterling answer more deeply after this. But Sterling's going to start introducing that topic about portfolio sensitivities in the, not the very next session, but the third ALM session of the day, the 2 o'clock session. And that's exactly what we want to walk through, is to give the board various different portfolios, and each of those will have a different set of characteristics in terms of return, in terms of risks, you name it, and then let the board really, work through their preferences for the risks and the appetite for those risks and the returns, and then and that'll be again introduced today, brought back to more deeper discussion in September. To really just start getting a sense of the board's appetite for those, and then with the plan being to be able to adopt a portfolio sometime in that November timeframe. But Sterling, I'm guessing you have some to add to that.
Not a lot. You've captured the salient points. I think the one other part I would mention, though, is our risk analysis looks not just at the portfolio, but the plan overall. So we look at how the choice of portfolio affects the risks related to funding the plan, so like the funding ratio, and we look at contribution rate risks as well. But you've raised a really good point, the marginal benefit of increasing risk. At some point, you just don't get a lot more benefit for increasing risk, and you will see that. We'll talk about some ways of visualizing that and quantifying that later on this afternoon. And then we'll, of course, come back with real numbers and real portfolios for you when next we talk about the candidate portfolios. It's a crucial question.
Thank you.
That's it, Henry.
Unless Steve or...
I'm sorry, I muted myself.
No, I just said that's fine, unless Steve or the Steves have a comment on that.
I don't have anything to add to that.
Okay.
Okay, great. Ms. Archuleta, I think you can move on.
Thank you very much. The next set of questions are around long-term trends. I think we've touched on almost every single one of these questions, but we'll just go through them anyways. This next question is for you, Steve McCourt. Are the forward-looking trends for expected returns and risk materially different than those in the past? And if so, why?
Yeah, they are, and I think you'll see that in the presentations today. In terms of the reasons that forward-looking returns are somewhat lower than they have been historically, it really boils down to two things. One, the level of interest rates today is historically as low as they've ever been, and the level of valuations across equities and other risky asset classes are as high as they've ever been. So if you think back sort of in our lifetimes, the other period we had very lofty equity valuations was the late 1990s. But in the late 1990s, we had interest rates at 6%. 10-year treasury bonds were up around 5 or 6%. So you had a challenging forward-looking environment for equities, but at least interest rates and fixed income oriented assets were expressing strong pricing. You really have to go back to the 30s, 40s, and early 50s to find an interest rate environment that matches or close to matches what we have today. And for most of that period, equity valuations were much, much lower than they are today. So we're sort of in a unique position where both bonds and stocks are priced to perfection, and there's really not much room left for upside surprises in those areas. So you'll see that expressed in almost every model. It doesn't mean that that there's bound to be a bear market tomorrow. It doesn't mean that returns are bound to be awful for the next 20 years. But it does mean that, again, that midpoint of all the possible return outcomes for the next couple of decades is likely to be somewhat lower than it has been historically.
I guess a few things to add to that in terms of what can be different across both return and risk over the next 10 to 15 years. This question mark about redistributive type of policies. We spent, the last 10 to 15 years where the capital share of income was about, it was rising and is currently, in above 50%. It's closer to 60, 65% in the US. Are there any secular changes? It's a question rather than a statement. Are there going to be changes in that in the mix of the compensation to labor versus capital in the economy? The other areas of uncertainty, I think Stephen McCourt already mentioned this. We've borrowed a lot of future returns and brought them into the present, and therefore our expected returns over the future are more constrained. But what could be different is the growth of alternatives, the possible mainstreaming of this asset class as it grows in size. I'm not saying this is turning into a liquid asset class, but can its liquidity premia and its visibility and footprint in global markets change through time? And then the two final things that are, I would say, are different, and we actually did talk about this. One, the focus on ESG and sustainable investing is a different focal point to what we've had historically. Yes, it's been growing through time, but the rewards that investors are willing to pay for that are different and something we need to account for on a secular basis. And the last, I think someone mentioned globalization already. Between the 1990s and the early 2010s, we had global trade being 2 times global GDP. It's now converged back to 1 time, so it's in line with GDP. And the mass acceleration we had in trade because of the inclusion of China in WTO arrangements, we've seen that impact being fully baked into asset markets. So we're not expecting a turnaround or a massive change in globalization, but have we seen the huge impact on the good cycle that came from what happened in the early 90s? Have we already seen that impact in markets, and therefore will have different implications for where our sources of return are over the next 10 to 15 years is also another consideration.
Okay, thank you. Next question, and this is for you, Tushka. What do you see regarding the trends between private and public assets? Will markets become more efficient? And if so, continue to compress the spread between public and private?
Yeah, thanks for that. I guess we split it across the income sources within private versus the capital growth assets within the private space, and we do see on the private debt side a huge, a significant compression in the premia for those private assets relative to their public counterparts. Basically, the injection of liquidity, the search for yield, the low yielding environment we have in government bonds that we've already highlighted has led to a compression in that risk premium on the private debt side. And we are now starting to see a bit more concern on our side on the underwriting standards for this asset class, looking at it from a top-down perspective. There clearly are opportunities here, but in aggregate, we are seeing underwriting standards starting to fall given the huge amounts of liquidity we have in financial markets. But where are the opportunities, where we see the persistence of the spread between returns between private and public is more on the growth asset side, so private equity. And I'd say a few points here that underscore the persistence or substantiate why we think that premium remains a persistent theme. One, the ability to access certain themes is kept private for longer. So the IPO cycle is pushed out later. So for example, access to certain technological innovations, whether that's data logistics or warehousing, we're seeing being kept within the private market. So basically, the ability to access certain beta is not even possible outside of the private space, and we see different structural differences in the makeup of the underlying asset. The second is this idea of what is the role of these private enterprises when they are engaging in buyouts or investment. And what we've seen recently is the disruptive opportunity set that's available to the private equity landscape, that's available to those parts of the economy that are on the private side, that disruptive opportunity, that those agents for change, we still, we see these as being key sources of substantial alpha, or at least persistent alpha sources in the private space relative to public markets. I think, if I had to think about the value creation proposition that we have within private equity, we actually see that as being a more valuable resource than we've had over the last 10 years, and looking ahead over the next 10 to 15 years. So something we are considering within our own LTCMAs today is whether we increase our alpha contributions that we are getting for the median manager in private equity. It's currently around 2.5% in our long-term capital market assumptions. There is discussion at the moment of upgrading that closer to 3%. It's the first time, I would say, in the last 10 to 15 years, we're actually thinking about increasing our alpha contributions from private equity. Thanks.
Okay, we'll go on to the next question, and this one's for Steve F. What do you see as the distinguishing features of emerging markets? Are there preferred asset classes for entering emerging markets? And what factors influence these preferences?
Well, I think we've kind of touched on this one a bit earlier in the conversation in terms of a global approach. I mean, the obvious, the biggest impact asset class would be within equities. Emerging markets as part of that global portfolio are somewhere around a 15% weight within that global allocation. That's a rising, growing percent. You think about China within there. Emerging market debt, again, getting back to the comments about asset class diversification along with geographic diversification, even within pockets of asset classes, and I'll just point to diversified credit being one, whether it's high yield pairing with emerging debt. These are the places where there are opportunities. One of the attractive features, and there's risks that we've talked about that come along with the emerging market exposure, but one of the attractive features when you compare it to the developed world is a more positive demographic sort of environment in terms of younger population and the growth engine that could fuel. You also have a rising middle class. So where there's been, historically complete or large dependence of the emerging markets on the developed markets. And I think, Ms. Middleton, this attaches to the question you were asking about with supply chains. There's a lot more internal fuel, if you will, of that rising middle class consuming product and driving growth within the emerging region itself. So I think that's, it's emerging for a reason, and it becomes much more developed as time passes. But I think those are the obvious one is within the global equity market and that emerging piece that fits into a diversified portfolio. But I think there's opportunities across other asset classes as well.
Thank you. Do we have anything else from the other panelists for that question? Okay. We'll take this opportunity then to have another break for the board to ask any questions.
I don't see any more questions right now.
Okay, with that, I think we're actually right about time. I do want to thank the three panelists for your answers and insights. That was pretty awesome. And I will transfer it back to Dan.
Thanks, Fritzy. And I just would agree. Definitely appreciate all of our panelists, the two Steves, and then especially Tuska for joining us from, I believe it's Paris. So it's evening time out there. Thank you for staying into the evening to join us. And then also definitely want to thank, absolutely. And then also really just want to thank Fritzy also. We, notice Fritzy's from our actuarial department. This kind of reflects our sort of one team approach to this ALM process where we bring the actuaries, the investment part, and then of course all managed under the leadership of the finance office, Michael Cohen. But really appreciate the teamwork by Fritzy for joining us and moderating. So with that, Ms. Taylor, I'll turn it back to you to take us into the break.
All right. Thank you. That was a great presentation and a great panel and lots of great information and whew, can't wait. So I'm going to move us into break, and I cannot, let me look real quick to just make sure, are we scheduled to resume at 1? So I want to make sure. So we will see everybody back in open session at 1 o'clock to talk about our asset liability management, market assumptions, some more.
reconvene our offsite meeting. I hope you had a nice lunch. And we're going to move further into our asset liability management process with a review of the capital market survey findings and discussion on how those factors will impact our own decision-making process. Here to lead the discussion is Sterling Gunn, CalPERS Managing Investment Director. Mr. Gunn, the floor is yours. You're muted.
There we go. Is that better?
That's better.
That's better. Thank you very much, Mr. Jones. Good afternoon, committee members. Sterling Gunn here. This session is part of our ongoing asset liability management process. It's the second of today's 3 sessions related to asset liability management. We'll be reviewing the results of our ongoing survey of capital market assumptions provided by external experts. And we'll also discuss our internal methodology for developing CMAs. We're not asking for approval of CMAs. Before I start, I would like to thank the many CalPERS team members in the Investment, Actuary, and Financial Office who are contributing to the CalPERS ALM process. This ALM process is a team effort, and it truly does represent our one team, one fund approach. I'd also like to thank our external partners who regularly contribute to our surveys. Without their participation, we really would have far less insight into the potential for the markets. And finally, I would like to thank the 3 participants from this morning's panel discussion. They, along with Kareem Raymond, who spoke to us in June, have provided excellent insights into their CMA methods and CMA trends. And if I just speak a little bit about their methods and trends, I think overall there was general agreement regarding the factors influencing future returns. That include things like market valuations, demographics, regional variations in interest rates. We also heard that our current circumstances are somewhat unique, with high equity valuations and historically low interest rates suggesting low returns in both asset classes. We also heard there's heightened uncertainty in return outcomes. Factors contributing to this uncertainty include the potential for increasing geopolitical tensions, the potential impediment of globalization, future effects of climate change, and potential changes in trends for fiscal and monetary policies, which may diverge from what they've been in the past. They also reminded us that a disciplined and systematic approach to estimating CMAs not just gives us the values, but also reveals the strengths and weaknesses in our understanding of the return generation process. We also heard, not surprising, there's a lot of noise and uncertainty in projecting returns, and that's often easier to think about risk rather than to just project returns. Now, though our panelists agreed on the major trends and issues confronting investors today, the survey results still have a diversity of opinion regarding the actual values of return projections. And so at the risk of potentially boring you, I will be taking you through the results of that survey in some detail. But I'd also like to say that in order to acknowledge that diversity of opinion, I think Mr. McCourt alluded to this. When we think about the range of CMAs, we focus on the median values. Now, the median values represent the middle of the distribution. Unlike an average, the median value is not sensitive to the value of extreme outliers. Much of what we've discussed today and in this session support 3 key messages. Looking forward, medium and long-term returns are likely to be lower than they were in the past, even the recent past. Looking forward, the expected volatility of medium and long-term returns, particularly in the most scalable asset classes, has increased. And finally, in February and March of this year, we discussed the need to accept uncertainty into our analysis, and we will hear that message again. Now, the first part of the session uses the survey results to illustrate these messages. And the second part summarizes our own CMA methodology and how CMAs will be represented in the ALM process. Can we go to slide 3, please? Now, over the last year and a half, we have conducted 3 surveys of capital market assumptions. And this slide summarizes the participants in the surveys and also the results across 11 broad asset classes. The first survey in March 2020 The second was in December of 2020, and the third in March of 2022. Now, the 11 survey participants are listed on the left side of the slide and represent a cross-section of respected external managers and consultants. Now, in the survey, we actually asked participants for their views on 48 asset classes and sub-asset classes. And I think we heard a little bit of that from some of our, I think it was Theshka, who talked about the level of granularity, but also as it become more granular, you lose data. So I won't go into the details of the 48, other than to say that really the intent there is to provide more granularity into the 11 broad asset classes that we will talk about today. Now, some of these asset classes are used in the current perf and the affiliates. And as I said, the others are really here to understand a more granular level. So today we focus on the 11, and each survey we ask for capital market assumptions over 2 or 3 different investment horizons. The first survey focused on 10 and 20-year horizons, and all our 11 participants responded. The second and third survey asked for CMAs over 10, 20, and 30 years. Again, all 11 replied to the December 2020 survey, while 6 replied to the March 2021 survey. And I'll come back to the significance of that later on. Now, as part of our ongoing process, we are conducting a survey for June 2021, and we expect to have those results sometime in August. So if you look in the table, you can see we've summarized the levels of responses. You can see respondents did not provide values for all the requested asset classes, nor did all respondents provide CMAs for all the investment horizons. Look at the 10-year horizon in the March 2020 and December 2020 surveys. They've received the most responses, while the 20-year and 30-year survey horizon in March 2021 received the fewest responses. Now, we do believe the 20 and 30-year responses are most relevant to determining the discount rate, while the shorter horizon is important to understanding how portfolio performance may differ between the medium term and the long term. And we'll discuss that a bit more in the session later this afternoon. Now, there is some indication that the 6 respondents in March 2021 as a group are slightly more optimistic than the 11 overall. And again, that's something I'll return to in a little bit. Now, our next 2 slides compare the results of March 2020 and December 2020. These are the more complete surveys. So let's look at the 10-year results first. If we could go to the next slide, please. All right. This chart compares the March 2020 and December 2020 survey results. The asset classes are listed across the horizontal axis, and to the left, we see the equity classes, followed by fixed income and bonds near the center, real estate, and then liquidity. And on the far right, we have inflation. Now, on the vertical axis, we have 10-year geometric expected returns. And you'll note that in this 10-year survey, the range of returns starts at -3, and that's because some of the survey respondents felt long treasuries would have negative returns over 10 years. Now, the horizontal black line you see represents our current discount rate of 7%. So let me walk through some of the features in the material here. The dark gray boxes represent the range of responses for the March 2020 survey. The green box highlights either existing asset classes with returns exceeding 7% or new asset classes that may be considered for inclusion in our asset mix. So let's look at global equity cap weighted at the very left of the chart as an example. We see the March 2020 responses, the dark gray box, range from 3 to 8%. Now, from our table, we know there were 11 responses within this range, and one extreme outlier led to the bottom of the range. If we excluded that extreme outlier, the range would actually be 5 to 8%, but still quite wide. Now, a note about outliers. We're actually hesitant to completely ignore values when they are outliers. We cannot easily judge which experts are better than others. In addition, a manager may create an outlier in one asset class, but not in others. So not inclined to downplay the responses of individual managers. And as a starting point, we take the survey results at face value. So let's just go to the chart again. Now, if you see the white dots represent the median value for the March 2020 survey. Unlike the median is not sensitive to the values of outliers. It's more of a typical value. So let's return to our example, the global cap weighted equity, where we see the median value for March 2020, the white dot, is around 7%. Also, since there were 11 responses, and given the location of that white dot within the gray box, the dark gray box, we know there are 5 responses above and 5 below. But the white dot is not in the center, it's actually towards the top. Because the median is closer to the top of the range, there really appears to be less certainty about downside risk than there is regarding the limited potential for upside. And that's sort of consistent, excuse me, the lights went out here, with some of the messaging we heard earlier about there's really not a lot of upside left in the market, but there can be quite a bit of downside left. Now, the light blue boxes represent the range of responses for the December 2020 survey. So again, let's look at our example, the global cap weighted equity at the left. We see the light blue box ranges from 4 to 7%. The same 11 respondents contributed to this range. And this range is 3%, is narrower than the previous range of 5% from the March 2020 survey, suggesting some uncertainty has been removed from the estimates here. Now, the green diamond represents the median value of the December 2020 survey. And again, if you look at our example on the left, we see the median value for December 2020 is around 5.5% and is close to the middle range. That median value has dropped from the 7% in the previous March. Let's look at the trends now and the overall results. So first, size of the dark gray and light blue boxes tells us expert opinion is diverse regarding 10-year CMAs. And with a few exceptions, this diversity has not changed dramatically. We do need to be mindful that the response rate varied by asset class. High yield, for example, has a relatively low response rate. And this low response rate could have affected the reported ranges. In general, however, green dots are below white dots, which means median returns dropped from March to December of last year. In addition, while in March, private equity and emerging markets equity had median returns over 7%, by December, only private equity had median returns over 7%. Now, both surveys indicate there is potential for 10-year long-year treasuries to have negative returns. Just to conclude on this page, at the very right, we see inflation estimates stayed the same at just over 2%, but notice the March survey indicates risk to the downside, while the more recent December survey indicates upside risk. Okay, let's move to the 20-year results, again from March 2020 and December 2020. Next page, please. Now, while the 10-year returns tell us something about the path that we may experience over the long run, the 20-year return assumptions are relevant to the discount rate. The boxes in the 20-year results tend to be shorter than the 10-year boxes. This may be because any transient factors, recovering from the COVID shock, for example, would be more influential over 10 years than over 20 years. You may have heard the panelists talk about the difference, of course, between the sort of cyclical or transient aspects versus the more secular and long-term aspects. Now, it's also worth noting the range for long treasuries no longer goes below 0. Finally, the median values represented by the white dots for March 2020 and the green diamonds for December 2020 dropped over the 9 months. Most of the 20-year median returns in both March and December are higher, though, than their respective 10-year returns on the previous page. And again, just to summarize, in March, you can see 4 asset classes had median 20-year returns over 7%. Now, by December, only private equity has a median 20-year return over 7%. And with only a few exceptions, the light boxes tend to be smaller than the gray boxes, indicating the range of opinion narrowed during the same period. And finally, looking at the very right, we see inflation had continued to hover around 7% with medians in the center of the range. Next, let's look at the median return results for all three surveys, coupled with expected volatility estimates. Can we go to the next slide, please? Now, the novelty in this chart is not just the inclusion of the volatilities, but also the inclusion of the March 2021 survey results. Remember, those results are based on 6 respondents, while the March 2020 and December 2020 surveys had 11 respondents. This chart presents trends in returns and expected volatility over time, as represented by the 3 survey results. Let's look at the chart details. First, the horizontal axis measures expected volatility as an annual percentage. Expected volatility is an imperfect proxy for risk, which we now know is multifaceted. Expected volatility, for example, does not really account for illiquidity, while the expected returns may indeed have a premium for illiquidity. Still, expected volatility is a common proxy for risk, and we use it here. The vertical axis measures the expected geometric 10-year return. Again, we see, with some exceptions, that as expected volatility increases along the horizontal axis, expected returns increase along the vertical axis. The upper sloping lines indicate returns tend to increase with risk. Each survey is actually represented by a line and data points. The black dots and black dotted line are results for the March 2020 survey. The blue squares and dashed blue line are results from the December 2020 survey. And the amber diamonds and the dot dash line, amber colored, are results from the March 2021 survey. For each asset class, the results are grouped using a box, so we can more easily see how the risk return for a specific asset class evolved over time. Looking at the bottom left corner, for example, we can see the 3 points for the liquidity asset class. And the legend on the right provides the actual number. Now, there are some overall trends, some of which we've already discussed. Generally, there was a lowering of median returns and increase in expected volatility, represented by movement right, which is the increasing volatility, and down, declining returns. Let's consider some specifics. The median returns for 8 of the 11 asset classes, including our most scalable public equity, declined from March 2020 to December 2020. And you see that going from the black to the blue line. And while median returns did trend down, expected volatility in 7 of the 11 asset classes increased. These 7 included, again, our most scalable asset classes, public equities and long treasuries. There was then a slight recovery from December 2020 to March 2021, though the most scalable and rewarding asset classes did not return to the original March 2020 levels of last year. Let's look at an example at the public equity cap-weighted asset class, which is box number 1. There we see the March 2020 survey, which is the black dot, indicated a 10-year median return around 6.7%. And expected volatility around 16%. In the December survey, the blue square, the median return had dropped to 5.6%, and expected volatility had increased to 17.5%. And finally, by the March 2021 survey, which is median return, was around 6%, and expected volatility had increased slightly higher again. The overall effect in the trend was a lowering of expected returns accompanied by an increase in volatility. Now, there were a few exceptions. Asset classes not seeing an increase in risk include liquidity, high yield, emerging market debt, and private equity. Now, with the exception of liquidity, 3 other asset classes are less liquid. And so though they may appear more attractive, they are more difficult to acquire in scale. There are also 3 asset classes that stand out, being quite a distance from the actual trend lines themselves. Now, if we look at the case of the long treasuries, which is box 7, we see that it really this is a function of the current low rate environment. And with the likelihood of rates increasing over the coming years, this puts downward pressure on long-term treasury returns. In the case of the emerging market debt, which is box 6, local returns are attractive, but we need to convert to the US dollar. And as we heard this morning, foreign exchange risk is usually uncompensated risk, and the conversion to US dollar increases expected volatility while not increasing returns. So that's probably moved it off the line. Now, in the case of private debt, which is box 5, it's above the line. And the reason for that is the returns likely do include a premium for illiquidity. And since the expected volatility doesn't really measure liquidity risk, the risk is likely understated, and that raises that result above the lines. Now, as mentioned earlier, the response to the March 2021 survey was lower than the other 2 surveys, 6 rather than 11. And the respondents tended to be more optimistic than the past. If this relative optimism continues in the March 2021 survey results, those results may be skewed to the upside, at least on a relative basis. And if this were the case, then the amber colored data would actually move down if we tried to correct for that being overly optimistic. Let's just look to the 20-year data, please, on the next slide. Now, going over the slide in detail actually risks belaboring the key messages, so just let me summarize. 20-year median returns are slightly higher than the 10-year median returns, and the changes in 20-year volatilities are the same as those in the 10-year volatilities. The overall trend across the 20-year surveys is lower median returns and higher expected volatility. The long-term treasuries continue to lie well below trend lines. Emerging market debt has moved closer to trend lines, and private debt continues to be above the trend lines, all for the same reasons mentioned when discussing the 10-year returns and risk. So this is a good place to discuss the implications of these lower returns and higher risk. And to do that, we use our current policy portfolio to sort of summarize the risk and return. So if we could go to the next slide, please. The 10 and 20-year returns are represented by the upper and lower panels in the table. Each panel has 3 rows for returns, risk, and the risk-return ratio. The columns provide the original portfolio values from 2017, along with the results for each of the 3 surveys. Let's look at the 10-year returns first. In the original 2017 ALM, the expected 10-year portfolio returns were around 6.1%. By the time of the mid-cycle survey, March of 2020, median return was just 5.7%. 9 months later in December, in the depth of the COVID problems, the median 10-year return drops to 4.9%. And then 3 months later, that same median return moves to 5.3%. 20-year portfolio returns experienced a similar outcome. In the original 2017 ALM, returns started at 7%. Through the cycle, they went down to 6.6% and then 5.4% in December. By March, returning to 6.2. Still 80 basis points than where it had started, 80 basis points lower. Risk for both the 10 and 20-year portfolio returns started at 11.5. And though risk had declined by March of last year, estimates have since risen, and risk is now at roughly the same level as that estimated in 2017. So the overall effect of the lower returns and similar risk is straightforward. With the same portfolio, we now get less reward per unit risk. If we want more returns, we need to construct a better portfolio and/or take more risk. Constructing better portfolios will be the subject of coming sessions, starting with the one later today. One final note, I mentioned the 6 respondents in the March 2021 survey tended to be slightly more optimistic than the 11 in total. So as an example, if we were to isolate the 6 and use their December 2020 results, that portfolio would be about 20 basis points higher than is reported for the 11. Now, at this time, we don't have sufficient data to know if that difference is actually just random or if there's actually part of a trend. That's the kind of thing you learn, over a long period of time working with people. Now that completes the section on survey results. Let's move on to our internal methodology. Next slide, please. Now, as I mentioned earlier, we need to do more than simply collect survey results. We need to understand them. So to this end, we have our own CMA methodology. And as I mentioned at the beginning, we have developed our own CMA process. We did not do this because we believe we have a comparative advantage relative to other market participants. We did this because doing so deepens our understanding of the factors driving the survey results and aids our identification and understanding of market opportunities. Our framework starts by modeling key economic variables such as GDP and inflation. We heard about that this morning, about equities participating in growth, about inflation and its influence on long-term interest rates. Our CMA framework ensures our assumptions are consistent across asset classes and across an ALM process. Basically, I'm saying we don't estimate the CMAs for each asset class independently, but we understand and try to model the relationships between them. So that means factors such as inflation play a role in both liabilities and asset returns. Consistency makes sure the liability and return relationships are sensible. The next few slides illustrate our building block approach to developing CMAs. It may not be exactly the same as our participants in this morning's panel, but as they did mention, having a disciplined and systematic approach is one way of improving our understanding of how the world works and our assumptions on how the world works. Can we go to the next slide, please? Now, I mentioned at the beginning, I'd thank many CalPERS team members who contribute to the CalPERS ALM process. And this is an area where we have team members that are specialists in economics, in equities, fixed income, and other asset classes. And this is where their work shows up. Without their expertise, we would be challenged to develop our own model and far less capable of understanding and interpreting the survey results. This slide provides the building block models for our two most scalable asset classes, public equity and public fixed income. These two classes share common factors through the linkage may not be immediately obvious. Public equity returns are a function of dividend yield, the price effect of net share repurchases, real earnings growth, inflation, and changes in valuation. Our public fixed income return is the combination of starting yield, the roll return as the duration shortens, valuation changes, and possible credit losses. So let's consider how inflation and GDP influence both these asset classes. Public equity and fixed income are both exposed to inflation. We model the public equity dependence on inflation explicitly. The public fixed income dependence on inflation is indirect through the valuation changes caused by changing interest rates, which are linked to inflation, and to the roll return, which depends upon the term structure of interest rates, and hence to some degree inflation. So as an example, over the long run, increases in inflation should lead to increases in interest rates. And those increasing rates decrease bond prices and lower returns. Public equity and public fixed income also have an exposure to growth, though again, the relationship is not direct. Public equities provide us exposure to growth directly, which we model through real earnings growth. The public fixed income is exposed to growth, but through the credit loss factor. Specifically, if all else remains the same, a decline in growth is a decline in revenues, or at least a slowing down in revenues, and that in turn diminishes a firm's ability to service its debt. So as a result, the potential for credit loss increases. So sort of the inverse to well, not really. Let's go to the next page, please. Here, our private equity model starts with public equity returns, and so has all the factors inherent in public equity. We then adjust private equity to account for its distinct features. These features may include more leverage than comparable public equity, less liquidity than public equity, and being smaller than the firms in most public indices. And I believe it was Mr. Forrester that mentioned the same kind of approach in their view on private equity earlier this morning. Now, private equity managers also claim they improve firms' operational efficiency and hence provide an operational premium. To some extent, we heard about that earlier as well, where they were reviewing the alpha in private equity. At JP Morgan, they thought it might go from 2.5 to 3. Still a subject to review, But clearly, it's this operational component that at least contributes to that source of alpha, although the other factors may as well. And finally, we have to adjust private equity returns for fees. The amount of fees depends very, very much on the form of implementation, whether it's by funds or through co-invest and so on, but we still have to account for that. And it's an important differentiator. The real asset building blocks start with income, which is the capitalization rate, less capital expenses. Anticipating growth in net operating income, changes in valuations, changes in leverage, and when a manager is involved, deductions for fees. And again, inflation through nominal interest rates likely influences the cap rate, net operating income, cost of leverage, and fees. Some have a positive sensitivity to inflation and others negative, so the overall impact would depend very much on the specifics, but overall we tend to view real estate as being positively related to inflation. So overall, we see there are economic factors common to these four asset classes. And in a global environment, through the analysis is more complex, the overall framework is the same, it just may become country specific. And where the size of an opportunity is justified, we may need to consider, again, the factors by country, as well as the foreign exchange rates that were discussed this morning. Let me return to a subject that I mentioned earlier, the types of factors that are influencing medium and long-term returns. And this was also a subject of part of the conversation during the panel. Next page, please. Here we're just illustrating economic shocks and the surprises come in different shapes and sizes. Some are short-lived and though large, do not persist and have little effect on an economy's long-term growth prospects. These transient shocks are likely to influence returns over the short term, but have little lasting effect on long-term returns. Other shocks may persist for a long time and materially change the economy's long-term growth prospects. Now, the panel on the left shows projected real GDP over time. The baseline is represented by the black line labeled potential GDP, and you see it steadily increasing. Four scenarios are illustrated in the panel. Two are short-term, causing the real GDP to temporarily move away from the base case, and two are persistent, causing real GDP to move away from the base case and not return. Now, in the right panel, we show the growth rate for each of the scenarios. And again, the base case, the black line, the growth rate is constant. It's a horizontal black line. In the right panel, the line labeled permanent positive shows GDP growth above that base case. And though it declines somewhat, it always remains above the base case. This scenario results in the corresponding line in the left panel. In that left panel, the line grows faster than the base case and remains above it for all time. The permanent negative scenario is just the converse. Now, if we look at the temporary negative GDP growth scenario in the right panel, the dashed blue line, it starts with a growth rate below the base case, then returns to and rises above the base case before finally returning to the base case, sort of a round trip. That pattern is not dissimilar to that of a recession followed by a recovery. Looking at the left panel, we see in this scenario the GDP does drop below the base case line, but the drop is temporary, and the scenario eventually returns to the base case. The temporary positive scenario is just the converse. What's the point of all this? Well, we see temporary scenarios will influence returns over the short term, but will not likely affect returns after these events have died out. Long-term returns will be less sensitive than short-term returns to transient shocks. So that's something we also heard this morning. Now, it's challenging to know with any certainty if the events we experience today are transient or persistent. And this lack of certainty contributes to the diversity of expert opinion. Though we don't know for certain, it is likely that the high returns of the past year are the result of a transient shock and not a persistent shock. If so, then these returns are likely to be offset by lower returns in coming years. And again, one of the panelists sort of mentioned that the high returns of this past year borrowed returns from the future. So I'd like to conclude by moving to the last slide, which summarizes how all this information will be put together. So uncertainty leads us to consider not just expected outcomes, but the range of outcomes. As we discussed in February and March, rather than relying on a single prediction or a single projection, we need to understand how our portfolio performs in different circumstances. Basically, we need to be prepared and not just predicting. Our starting point for preparing is the creation of multiple scenarios, which collectively represent a range of outcomes. And each scenario has all the information needed to perform a complete ALM analysis. So what will we find in a scenario? Well, we start with distinct views of the economy. In the example on the left, we have 3 distinct views labeled base case, upside, and downside. In this example, each scenario is specified by real GDP growth and an inflation rate. These are fairly simple scenarios. As I mentioned earlier, we can become more granular when we look at countries, and we may look at other economic variables, but the theme is still the same. So returning to our example, based on the economics, we develop capital market assumptions. And the CMA survey results are a key input into the development of the scenarios. These assumptions may be as simple as long-term expected returns and volatilities. More complex features would include term structures, country-specific CMAs, and fat tails. The purpose of introducing additional complexity, though, is not to increase precision, but to better understand which of these things are actually important and influential and which are not. Finally, based on the economic and capital market assumptions for each scenario, we create 5,000 simulated paths. Each path specifies returns for each of the asset classes. These paths are used to construct candidate portfolios, which is the first step towards understanding the trade-offs between the many risks we must manage, and also including selecting a discount rate. We'll discuss those trade-offs, those risks trade-offs, in our next session. So let me conclude my remarks with this summary of some key messages, all of which have a bearing on the construction of our candidate portfolios. The survey results indicate medium and long-term returns are likely to be lower than they were in the past. Survey results indicate expected volatilities of medium and long-term returns have increased. Survey also shows that expert opinion is diverse, which reflects the uncertainty of projecting future returns. And that to address this uncertainty, we construct multiple scenarios. So our ALM process will consider a range of outcomes rather than relying on a single prediction. We try to prepare rather than predict. I thank you for your attention, which was probably a pretty dry presentation, and I'm available for questions.
You're on mute.
Ms. Ortega.
Thank you. Thank you, Mr. Jones. I had a question going back to slide 3 and just the responses on the survey. And I wasn't clear if you addressed the drop off on the kind of out year. I think it's the asset classes where there are fewer responses on the specific classes. And if you had an idea of why that is. So, as the numbers go down under the 1231 response and the 331 response. So you get fewer data points in the 30-year.
Right. So we heard in the panel this morning, oh, excuse me just for a second. I think I was muted there. Some institutions focus only on, say, a 10-year horizon or 10 to 15. And so we do tend to see the 10 years are more heavily populated than the 20 and 30 years. So I think that's part of the answer. I think the other thing is not everyone focuses on all the different asset classes. They have their own areas of comfort. And so we heard this morning, I think JP Morgan said they covered 200, Wilshire 90, 70, and Makita 90. That doesn't stop them from considering others, but in the survey, they reply where they have something readily available. I guess that's the answer to that question.
Okay. And do then, as part of the contribution of our resources, is that sort of how you fill in that information in terms of thinking that longer term horizon that we're looking towards?
So our focus of it, if I understood your question, is on the 20-year. The survey is more lightly populated there, that's true. And so we do need our own process to better understand what's going on and make sure it is appropriate. It doesn't stop us from using the medians as a starting point.
Okay. Can you say a little more about what our process is for adding in that information on the 20-year then?
Right. Often it's a matter of, excuse me again, of interpolation. So we do have our own building block process, so we can actually use develop our own estimates. But we're more likely to take what's offered in the survey. And so long as our understanding is consistent with close to the median, then we stick with that.
Okay.
But it is sort of a fundamental analysis and making sure we understand it, even though it may be a little less well populated.
Okay. And then just a second question on a different topic, and it's sort of using the metaphor this morning of the pebble and the water and the ripples.
Yes.
In your slide, you had a section talking about shocks or surprises.
Mm-hmm.
Can you say a little bit about the philosophy of the approach to making adjustments or to revisiting the CMAs as part of the process? I know there's a check-in period, but I've always been a little unclear as to what a board should actually do. Like, what is a shock or a surprise that actually, triggers a deviation from an ALM that's already been approved in a prior process?
Okay, so we have, I guess there's a couple of different processes here. So one is just the ongoing monitoring of the CMAs to see what's going on. I don't know if you're asking if we identify them as persistent or not. We don't really get to do that. We do, however, when we look at an environment with high valuations, you have to believe that will affect returns adversely. In terms of our other processes, I guess we do have like the risk mitigation strategy, for example. If there's an exceptional return, that does ask us to review the portfolio.
Okay, thank you.
Okay, are there any other questions from any committee members? Okay, seeing no further questions, I guess I have a couple, Sterling. One is when you, I think it's kind of related to Ms. Ortega's question. In terms of getting your survey, and you say you do produce your own information, do you show anywhere where there's a comparison of what the survey shows and what staff's interpretation is of those elements to see what the variance is and why?
We haven't done that here. No, we could. Like I said, really, this was mentioned this morning as well. Really, it's the important part is going through that process and coming to get a better understanding of those areas where we have a deep understanding, whether it be around the building blocks, and trying to strengthen the areas where maybe we know less. In general, we tend to be close to the medians with only a few exceptions. So
for example, in the GDP best case or upside, etc., those numbers, you ultimately will be using that data as opposed to your independent data on those assumptions?
We help use, so the GDP work we use to create the three scenarios, and then we calibrate that with the return data from the survey. So we actually blend the two. We have a third-party tool. So we take the base case, and the base case is calibrated to the survey results. And then we use the economic tool to build the upside and downside, which gives us sort of relative returns to the base case.
Okay. Then my last question is return paths. You mentioned the 5,000 candidate portfolios. Mm-hmm. Is that where we would get an answer to that question? What additional unit of risk I'm taking for the additional unit of return, or is that coming later?
Well, that is coming up in the very next session, which hopefully is a little less dry than this one. This is mostly just budget. But yes, We'll certainly address that question in the next one. But we use those 5,000 paths to do that.
Okay, thanks. Okay, Ms. Middleton?
Thank you, Mr. Jones. I'm looking at the page 8 of 13, the 10 and 20-year expectations, and which I think is a very good chart. What you're telling us is the level of risk that we have currently taken on is not going to be, has to be increased if we have any hope of getting back to a 7% rate of return or something close to a 7% rate of return over time. What I'm struggling with is one, how much more risk do we need to take on? And how do we quantify the relative risk that we are taking on in comparison to benchmarks, in comparison to other pension fund organizations?
So the answer to the first question, how much risk we will have to take, don't have that answer readily available. That's the work we're actually engaged in right now in preparing the candidate portfolios. The good news is, and this was mentioned this morning by Mr. McCourt and I think the others, that we can use leverage to actually improve the diversification in the portfolio. So that will help us mitigate some of the risk increases. So it's not just a simple scaling up of the portfolio that we see here. It actually should be better than that. In terms of the comparison, I have none readily available. The simplest comparison would be looking at the overall equity exposure from one portfolio to the next. We actually, later on today, we do that as an example. And when I say equity exposure, it's not necessarily just public equities and private equities. Other asset classes can act like equities, particularly under stress. And so we'll see an example of that in the later presentation.
I think those are some numbers when it comes to comparative risk that we are being asked to take on that we're going to need. As I try to talk to stakeholders, and I'm sure all of everyone else is, that issue of how do we know what the appropriate level of risk is and that we are acting responsibly is, I think, a fundamental question. And most educated observers would realize that taking on no risk is dangerous, and taking on too much is also dangerous. So it is a balancing, and I'm going to be looking for some numbers that will help me know we're getting the balance right.
That's very, very good. Yes, we can do that. I would point out that when we talk about risk later on this afternoon, we do talk about the risk in the portfolio, but we also talk about the risk in the plan. So it's a little bit bespoke the way we've framed it, but we can certainly find information about the portfolio and portfolio comparisons.
All right, thank you.
Henry, you're muted.
Oh, thank you. Can you hear me now? I was muted. I said we'll now, I see no additional questions from board members, so we'll see if there are any questions from the public. Mr. Fox, do we have any requests to speak on this item?
Mr. President, there have been no callers yet today.
Okay, thank you. Okay, so now we'll move on to the next item. Mr. Gunn, you're on again.
Okay, just give me 1 second here, please. Oh dear. There we go. Okay. So this is obviously the third last asset liability session for the day. In the ALM process, is intended to assist the board in its selection of the policy portfolios, discount rates for the PERF and for the affiliates. And to support that purpose, we'll develop candidate portfolios, each distinctly balancing the returns, contributions, and liabilities. So that actually goes back to Ms. Middleton's question. We'll compare the different risk and performance characteristics of the candidates, and based on our preferred balance of risks, choose the policy portfolio. Today, I'm not going to be discussing specific portfolios. We'll be doing that in the next session. So today is about the framework for developing the candidate portfolios, and we'll discuss the multifaceted nature of risk and share some examples of tools that we think will be useful for visualizing the risk-return trade-offs. As I mentioned earlier today, the ALM process is a collaborative process involving investment, actuarial, and financial offices. And let me start off, though, by mentioning that the CalPERS total fund investment policy requires the board to review and then to either affirm or amend CalPERS investment beliefs. So today, we'll review those beliefs and we'll ask for the affirmation at a later meeting. If we could go to slide 3, please. So regarding our investment beliefs, the first, regarding the influence of liabilities on the asset mix, our ALM process does ensure that funding and contribution risks are an important part of the portfolio choice. CalPERS is a long-term investor, and our ALM process focuses on investment returns over longer horizons. Our choice of asset classes balances the need for long-term returns against the needs for liquidity and the desire to add value through opportunistic strategies. The ALM process, through a series of meetings, we have been engaging with a range of stakeholders, and we also review the ESG implications of the candidate portfolios. Regarding the 3 forms of capital, these are reflected by our choice of investments, by incorporating ESG factors into our portfolio assessment, and by considering the internal and external capabilities needed to implement the investment strategy. Regarding objectives, they are very clear on our process: minimize costs, maximize returns while minimizing the potential for losses, and pay benefits now and in the future. These objectives are at the core of our portfolio selection process. Our strategic asset allocation does dominate our overall risk and return performance. There's not much more to say about that. We consider only asset classes we believe will deliver appropriate risk-adjusted returns or beneficial diversification, and that will contribute positively to overall portfolio performance. And we agree costs do matter. And we assess the balance between planned costs, net returns, and planned risks. And we will see our risk assessment is indeed multifaceted. It includes asset risks, contribution risks, and funding risks. And finally, in terms of being team-based, this ALM process is a collaborative effort of the 3 offices that I mentioned. So let's look at the ALM process in some greater detail. If we go to the next slide, please. So the ALM process has several components represented here in a cycle. In practice, although it is a bit of a cycle, it's actually quite iterative, so we may bounce around a little bit. But let's start today with the macroeconomic scenarios at the 2 o'clock position in the cycle. And we did discuss these slides just 20, 25 minutes ago. It is worth just repeating a little bit here to understand the role that the macroeconomic analysis will play in our ALM process. So these economic scenarios are the foundation of our understanding of the economic factors driving asset class returns and liabilities. And the complexity of the scenarios depends upon the problem at hand. For the ALM process, we are using a widely accepted third-party model to develop economic scenarios with country-specific details. We do that because, of course, we are a global investor. The model could address factors such as demographics, productivity, fiscal debt, interest rates. And as we discussed earlier, the model can include both transient and persistent shocks. We use this model to estimate the effects of those shocks on asset returns. If we go to the next page, please. As I mentioned, each scenario represents a possible future of the economy, and our base case scenario is representative of what is probable. The upside and downside scenarios are representative of possible deviations from the base case. We don't actually assign probabilities to the scenarios. Rather, we're going to use them to sort of test again and be prepared on sort of a what-if basis. Once we have the economics, each scenario is then calibrated to include our capital market assumptions. And this calibration process results in each scenario having its own expected returns and risks. And then finally, for each scenario, the return assumptions are used to simulate return paths for all the asset classes. And when built, each scenario has a view of the future economy, its own CMAs, and its own 5,000 paths of asset class returns. And all of that we will use to build portfolios and to do risk analysis. So at this point, let's review our criteria for choosing which factors and asset classes are included in the scenarios. Now, there are three broad categories of selection criteria: qualitative, quantitative, and also implementation features. The qualitative analysis begins with the investment thesis underlying the asset class. As an example, equities are expected to participate in economic growth. At the same time, returns on equities create exposures to systematic and idiosyncratic risks. Examples of systematic risks include variations in overall production and interest rates, inflation, exchange rates, country risk, and so on. The idiosyncratic risks are very firm specific and tend to be mitigated by holding a diversified portfolio. Environmental, social, and governance risks can have both a systematic and an idiosyncratic component. We tend to focus more on the systematic components of those. Fixed income products, on the other hand, are expected to be a source of income, diversifier relative to equities. Fixed income products also have systematic and idiosyncratic risk factors. Now, our qualitative analysis leads to the assignment of a benchmark to each asset class. Benchmarks are our best representation of the asset class's overall systematic risks. Benchmarks are used in many of our processes, including the development of our capital market assumptions, strategic asset allocation, and our ongoing measurement of risk and performance. The benchmarks are used to quantify the risk factors mentioned above, as well as the potential for diversification and income generation. Now, we review the specifics of asset class implementation, as asset class returns need to be attractive net of implementation costs. Given the large size of our portfolios, the implementation must be scalable. We also ensure we have the capabilities, either internally or externally, needed to manage the asset classes. Let's return.
Excuse me, Mr. Gunn, but are you on, I think you're on some other charts than what's showing here, are you not?
Am I? I was looking at the three boxes, choosing asset classes. Is that not?
Yeah, I think we were hung up on that other.
My apologies.
Yeah.
My apologies.
I think you were on page 7 now, right?
I am on. Yes, it does look like page 7. My apologies. Okay. I can't see the screen and my documentation at the same time. My apologies for that.
All right. Thank you. Yeah. Okay.
Thank you. But that is a good reminder then that I've gotten to a point where we should move on to the next page, I guess. Let's see here. I am going to skip to slide 10, though. I did change the order just slightly. I thought the flow might work a bit better. So if we go to slide 10, which discusses candidate portfolios. Let's take a peek there. This chart illustrates typical risk-return trade-offs for a portfolio. The portfolios use the same asset classes and differ only by their asset mix. And that's an important feature when we do an analysis like this, is that the opportunity set is the same for all the portfolios. And I should mention that the board's decision to govern leverage at the total portfolio level will be reflected in the asset mix. And just foreshadowing some of the results, the value of that decision will become very apparent when we discuss the candidate portfolios at our next session. As we were talking about earlier, The use of leverage does a lot to improve the diversification within the portfolio and help mitigate risk. Now, if we look at the left panel, at the left axis, the expected risk is plotted along the horizontal axis, and geometric returns are plotted along the vertical axis. And in general, every portfolio will have its own expected return and expected risk. Many different portfolios can and will have the same expected return while having different levels of expected risk. And in theory, our job is to find the portfolio that minimizes expected risk for a specified target return. In practice, because of the uncertainty we've been talking about today, we look for portfolios actually that have good return to risk trade-off. Because really finding the theoretical optimal portfolio is a bit of a pipe dream. But we want to find ourselves very good portfolios that we believe will achieve our ends. Now, the blue curve, called the efficient frontier, represents portfolios having the least expected risk for a given expected return. All the other portfolios will have poorer return to risk and lie below this line. So consider the green dot. It's an example of a portfolio on the efficient frontier. Any other portfolio with the same expected return will have higher expected risk. Those riskier portfolios are represented by the red line. Now, as I mentioned, the efficient frontier is built from portfolios using the same asset classes and differing only by their asset mix. So it's a fair question to ask, actually. How many asset classes should be included? And the question is important because if we are missing an important asset class, we will miss out on the opportunity for better returns or better diversification. However, if we have too many asset classes, we may be introducing complexity without materially changing total portfolio returns or risk. So the choice of asset classes is really about striking that balance, the balance between total portfolio return and risk against the costs and risks of managing an overly complex portfolio. Now, once the asset mix of a candidate portfolio has been set through our analysis, the portfolio is subjected to further risk analysis, including stress tests, to performance analysis and upside and downside scenarios, to liquidity stress tests, and to sensitivity tests. And I'll return to those in a few minutes. However, if we, with our portfolio at hand, let's move on to the actuarial analysis. And if we could go back to slide 8, please, which I believe should be illustrated, illustrative cash flow projection. Now, this slide illustrates the relationships between returns, contributions, and benefit cash flows. And these relationships form the foundation of the risk analysis we discuss later on. Looking at the left panel, the vertical axis is the percentage of payroll, while time is plotted along the horizontal axis. The black line represents benefit cash flows forecast out 30 years. Light bluish gray represents employer contributions. The dark bluish gray represents employee contributions. And the light green represents the investment returns. And if we add up all the cash flows over the 30 years, contributions and returns, then each stakeholder's share of the total is represented by the percentages. In this example, the investment returns are 61% of total cash flows over the 30 years. This is basically our pension buck. If we look now to the left, we have a slightly different path where returns are 50 basis points lower. Peak cash flows are now a bit higher in the medium term, but do eventually drop to levels comparable to those of the first path. You also see a slight shift in the stakeholder shares. What these two examples do is illustrate how our models link portfolio returns and contributions. And as you will see, our risk analysis looks at the returns and contributions on each of 5,000 paths that are created for each scenario. So just to make this a bit clearer around the scenarios, let's return to a slide that we discussed in March, which does use a scenario analysis to understand risk. So if we go to the next slide, which is page 9, returns and discount rate, examples from March presentation. As you remember, the top left panel plots contributions over time. Each line in that panel represents one of the scenarios listed in the right table, or the right-hand table. The bottom left panel plots funding ratio over time. And again, each line represents one of the scenarios listed in the table to the right. Looking now at the 4 examples, you see 3 of them. The discount rate matches the long-term expected returns. And in these 3 examples, long-run contributions become lower and the plan becomes fully funded. It's example 3, represented by the green line in each of the panels, where the discount rate is higher than the expected returns. And in this example, future contributions will end up being higher than expected, and the funding ratio will not reach 100%. And it's this scenario that illustrates the importance of using scenario analysis to understand the risks created by the uncertainty of expected returns. We use our 3 scenarios, the base case, upside, and downside, to better understand the consequences of return uncertainty. And in general, a portfolio designed for the base case will do better than expected in the upside scenario. And if portfolio returns are better than expected, contributions will be lower, and funding is more likely, full funding is more likely to be reached. And the converse is true in the downside scenario. And so we will use these 3 scenario analysis to help us analyze portfolios and prepare for and potentially recognize when such mismatches occur. Now, I should note these 4 examples are extreme, since the portfolio mix and the discount rate are held fixed for over 30 years. In practice, we have our ALM review, and we review the portfolio mix and discount rate regularly. And we would adjust both as and when needed. At this point, I just want to comment, there are a lot of moving parts. Economic scenarios, CMAs, simulated paths, optimizations, more simulations. And frankly, most of us don't need to know the gory details. What we do need to understand are the key results and their implications. So the next few slides demonstrate visualizations for comparing contribution and funding risks of candidate portfolios. So if we skip to page 11, which titled Return Paths Lead to Variability of Contributions and Funding Ratios. Now in the left panel is the plot of 5,000 paths for just one scenario. Each path has annual values running out to 30 years. So in total, there are 150,000 data points, each of which can have information about portfolio returns, contributions, funding ratios, or any other variable of interest. We are, frankly, rarely interested in what happens at each and every point. We are interested, though, in patterns. And in this example, we are interested in the range of outcomes at the end of the 30 years. The middle panel is a histogram of the 30-year outcomes. The histogram results are summarized by the green box in the right panel. We call that a whisker box. Now, the top and bottom whiskers mark extreme upside and downside percentiles. The green rectangle marks the probable range, usually the 25th to 75th percentiles. And the dot marks the average value. So the whisker box offers a quick summary of the 5,000 paths and the 30-year outcomes. We could, of course, have built a whisker chart for any year. We just chose the last year for this example. So in the next page, we'll use whisker boxes to visualize contribution and funding risk. So if we could go to the next page 12. Now, in this example, we are going to consider a single plan along with its policy portfolio and discount rate. And the focus here is on the form of the visualization, not any specific numbers. We will have very specific numbers, obviously, when we present candidate portfolios. The idea here is we want to summarize and compare the performance of this portfolio plan pair in the 3 scenarios. The panel on the left plots the relationship between contribution rate and funding risks. The horizontal axis plots the probability of the funding ratio dropping below 50%. That is one of the metrics that was adopted by here at CalPERS. The vertical axis plots contribution rates. And the scenarios are color-coded. The baseline scenario is yellow, downside scenario is red, and the upside scenario is green. Each of those scenarios has 5,000 paths, each path having all the cash flow information we need for portfolio returns, contribution rates, and benefits. And we use our whisker boxes, in this case, to summarize the contribution rate results for each of our 3 scenarios. So let's look at the base scenario, represented by the yellow whisker box. First, if we look along the vertical axis, we can read the contribution rate for the lower whisker. We can also read the probable range and the upper whisker and the expected value. Now in this example, the lower whisker is very close to the bottom of the box. And that reflects the fact that there is a lower limit on contribution rates. The upper whisker is quite visible. It's telling us that there is potential for contributions distinctly higher than the probable range. Looking along the x-axis to below the yellow whisker box, we could read the probability of the funding ratio dropping below 50%. And if we'd marked that tick value, you would see that value is about 24%. So that means there's a 24% probability in the next 30 years that this particular portfolio could drop below 50% funding ratio. Now we have similar whisker boxes for the results in the downside and upside scenarios. Now remember, this is the same plan with the same candidate portfolio and the same discount rate, but in different scenarios. The downside scenario, whisker box, is to the right, indicating increased funding risk in the downside scenario. Conversely, the green upside whisker box is to the left, indicating lower funding risk in the upside scenario. Very intuitive, makes sense, but we are now starting to quantify our intuition. So let's compare the whisker boxes. All 3 have the same lower contribution rate. Again, the result of having a minimum contribution rate. And as we move from left to right, from upside to base case to downside, we do see increases in the extreme contributions, represented by the upper whiskers. We do see increases in expected contributions, represented by the dots, and we do see increases in the range of probable outcomes, represented by the boxes. And again, we are now quantifying the risks and starting to see the kind of patterns that result from taking more risk. The trends are pretty straightforward and intuitive. Worsening economic conditions lead to increases in contributions, increases in the ranges of contribution outcomes, and increases in funding risk. More than trends, however, the whisker charts do quantify these trends and include the differences in costs, expected costs, and risk across these scenarios. Let's now compare the results if we have one plan, but 2 possible candidate portfolios. Let's go to the next slide, please. So again, we have a single plan. Now, however, we have 2 funding options. Each option has a portfolio and a corresponding discount rate. In this example, option 1, when compared to option 2, has lower expected return, lower discount rate, and lower expected risk. The panel on the left plots the 2 sets of results for each of the 2 funding options. The results for the funding option 1, the lower risk, lower return portfolio, are plotted using speckled whisker boxes. The results for funding option 2 are plotted using striped whisker boxes. The funding risks, measured along the horizontal axis, are notably different for the 2 options. The option 1 funding, the lower risk, lower return funding, those results are all to the left of those for option 2. This means in all scenarios, option 1 funding risk is lower than that of option 2. The second difference is in the location of the bottom of the boxes. As mentioned, the bottom of the boxes tend to be constrained by a minimum contribution rate. The box bottoms are higher for option 1 than option 2, and that's because option 1 has a lower discount rate, which led to higher costs. Now, if we compare the results by scenario, meaning comparing boxes with the same color, we can see in each scenario, option 1 has a higher expected contribution rate than option 2. And that's consistent with option 1 having a lower discount rate. Scenario 1 also has a narrower range of outcomes than option 2. And that's consistent with option 1 having expected risk lower than option 2. So our risk box charts help us see the salient features of our risk analysis and helps us compare the risks and expected costs of funding alternatives. Now, the remaining slides that I have here illustrate additional risks and risk measures to be included in the analysis, but which don't show up in the whisker boxes. If we go to the next slide, please. So most of us do have memories of past crises, and historic stress tests have the value of placing a portfolio in the context of events that we've actually experienced. Now, this example compares the P&L of a single portfolio in 3 different historic contexts. I should mention that in 2 of the 3, the global financial crisis and the COVID drawdown, all the asset classes lost value. That's different from the 210 European bond crisis, where we saw income P&L is actually above the line while the others dropped. That's just a case of basically a flight to value. Thus, stress tests can identify both the downside and upside potential of different asset classes. Now, though we don't know the probability of such events occurring in the future, stress tests estimate what would happen to our portfolio if history did repeat itself. Now, we're fortunate, frankly, that there are not enough historic crises to test all the possibilities for extreme losses. So if we go to the next slide, you'll see we also use hypothetical stress tests. Now, a stress test can be really simple, as we have in this example, where we just specify a change in a single variable. Exhibit on this slide is an example of this simple type of stress test, plotting the perf P&L response to 3 different changes in interest rates. The causes of the interest rates aren't specified. It's really more of a sensitivity test. It does show that it's the income assets are the primary source of P&L loss to this type of shock. Now, we can also use transient shocks in our economic models, and that's another way to create hypothetical stress events. And that approach would model the impact of the shock on some, many, or all of the asset classes. Next page, please. This exhibit compares the performance of different portfolios to the global financial crisis. I think this came up in an early question from Ms. Middleton about comparing, I realize with peers, but this is also a way of just comparing the performance of different portfolios. And the left panel shows the response of 5 portfolios to the GFC, and the portfolios are of different mixes of equities, bonds, and real assets. And the general trend is very clear. The more equity exposure, the greater the losses. What might be surprising, though, at first glance, is the performance of the real assets, which in this crisis acted just like equity. So you can see this if you look at the 70% equity, 20% bond, and 10% real asset portfolio, and compare that with the 80% equity, 20% bond portfolio. They almost lie on top of each other in terms of the results of the stress test. So though we look to real assets as sources of both income and diversification, this stress illustrates a circumstance where there are times when our diversification assumptions will be challenged. Now, the right panel plots a longer period of history, showing the history preceding and following the GFC. Overall, portfolios with higher equity mix outperform portfolios with a lower equity mix. Despite the losses inflicted during the GFC, coming out of the GFC, holders of growth assets were rewarded. And to this point, we have discussed portfolio risk, contribution risk, and funding risk. A less obvious but still consequential risk is failing to follow our strategy. And I will use private equity to illustrate that risk. If we go to the next page, please. So in general, policy portfolio allocations are expressed as a percentage of total portfolio value. Part of the total portfolio strategy is to regularly rebalance to restore those target percentage allocations. And rebalancing results in the purchase of underweight assets and the sale of overweight assets. The private equity strategy, on the other hand, is opportunistic and managed in dollar terms. Private asset teams make dollar commitments to external managers and invest in assets less liquid than most public assets. These strategies create value by the managers deciding when to buy and when to sell. These two strategies, total portfolio rebalancing with its calendar-based buying and selling, and the opportunistic private equity, are very different. And if the two were poorly implemented, will potentially conflict with each other. Let's use events in 2020 to illustrate how this conflict could arise. The panel on the left plots the dollar value of CalPERS asset classes through the COVID crisis. Public equity market value, in orange, fluctuates noticeably over time, dropping from $200 billion to $150 billion before returning to pre-COVID levels. The private equity values, in blue, are far more stable. The panel on the right plots private and public equity as a percentage share of total fund value. The left axis in orange plots the global equity percentage. The right axis in blue plots the private equity percentage. Public equity, as a percentage of total funds, starts at 52%, drops to 45%, and then returns close to its starting value. And that percentage change reflects the market value changes in public equities. Private equity, as a percentage of total fund, starts at 6.5%, rises to over 8%, and then drops back to 6%, even though private equity valuations had changed very little. This fluctuation is driven mostly by the changes in the public equities and not by changes in private equity. Returning now to the potential for conflicting strategies. Extreme fluctuations in public valuations could drive the private equity percentage far above its target. If we were to strictly adhere to the total portfolio rebalancing strategy, that would force us to sell private equity, even if doing so was damaging to the private equity strategy. Our current rebalancing practice avoids this conflict by using public equities as a private equity proxy. By doing so, we avoid interfering with the private equity strategy while still managing total portfolio risk. So our candidate portfolio risk analysis will include estimates of the variability of private equity as a percentage of total portfolio value. And we will do this for stress cases so that this way the board will be prepared for the potential swings in private equity share, even if and when private equity values aren't changing dramatically. And this is actually important because in a downturn, the private equity percentage could pop up quite significantly for the same kind of phenomena that we're talking about here. And in a downturn, it's probably one of the best opportunities to be engaging in private equity. If we were to adhere to a fixed percentage, we would probably lose that opportunity. If we can go to the next slide, please. Discuss an additional risk. So one of our objectives is paying benefits now and in the future. We also have other cash flow obligations, such as those related to financing. So to meet these objectives, candidate portfolios must have sufficient cash on hand to meet current obligations and the capacity to generate cash to meet future obligations. So we have a liquidity management process that includes tests to ensure we can meet our cash obligations. These tests will be used to assess the capacity of each candidate portfolio to meet our current and future cash obligations. Next slide, please. CalPERS also has a leading role improving the awareness, assessment, and management of environmental, social, and governance factors and risks. The left panel, for example, plots emissions and emissions intensity for our portfolio. Overall, emissions have varied around the same level. Emissions intensity, which is the ratio of emissions to portfolio value, has declined. That decline is primarily the result of the increasing value of our portfolio and not a decline in emissions. emissions. The middle panel shows the regional sources of our portfolio emissions. We see a meaningful decline in emissions from the US, somewhat steady emissions from developed countries, and increasing emissions from emerging markets. And finally, the panel on the right has two stacks. The leftmost stack shows sector exposures as a percentage of portfolio value. The right stack shows 86% of the emissions in our portfolio are generated by three sectors that account for only 12% of our portfolio value. So why mention all this? Well, despite these observations, emerging markets do have attractive return opportunities. And an increase in exposures to emerging markets could be accompanied by an increase in exposures to emissions. So the risk analysis of each candidate portfolio will include an assessment of ESG factors, such as emissions, to clarify the potential trade-offs between higher returns and exposure to ESG risk factors. Next slide, please. Finally, we know the financial circumstances of our stakeholders vary, and the analysis of each candidate portfolio will therefore include information on the range of stakeholder outcomes. Just in this exhibit, we have a histogram of employer contribution rates, and each portfolio would have its own set of histograms quantifying the frequency of any extreme outcomes. So all this to say, we really will try to present the multifaceted nature of risk for each and every one of the candidate portfolios when we bring them to you. So if I could just quickly conclude, key takeaways. First and foremost, CalPERS ALM process supports the board in its choice of policy portfolios and discount rates. This support has two important components, including the development and risk analysis of distinct candidate portfolios and a framework for comparing the relative merits of those candidate portfolios. Second, the ALM process is aligned with CalPERS' constitutional objectives of maximizing returns, minimizing risk, minimizing costs, and paying current and future benefits. Third, the risk analysis of candidate portfolios will address a wide range of risks and explicitly link portfolio risks with the contribution and funding risks of the plan. And last, we discussed several tools that we believe facilitate the comparison of candidate portfolios and their risks, and specifically the whisker charts and some of the diagrams we use for the stress tests. With that, I conclude, and I thank you for your time and for your attention.
Thank you, Mr. Gott, for a very comprehensive report. A lot of good information that will be of value to us as we complete this process of our ALM process. We do have a question from Ms. Paquin.
Thank you, Mr. Chair, and thank you, Mr. Gunn, for the presentation. I had a question about the information on slide 9. We're looking at the emissions in global equities portfolio and how you incorporate that into the risk analysis. And I was curious, you know, as we start to look toward implementing steps to get to the net zero pledge that CalPERS has made, is this the right approach to look at this as far as setting interim targets, or how does that, how would that work?
So I don't think we're talking about the slide that I see up at the moment. You were asking about the emissions, is that correct?
Yeah, so slide 19.
Slide 19. So I'm sure that Ann Simpson could give you a far more detailed answer than I. But in general, we'll work with Ann's team. And I think there's a few pieces to this. One is just measuring the emissions in the portfolio itself. The risks associated with the emissions obviously would be if, well, a couple. One would be if there were in the future prices imposed on, say, carbon. So that could obviously influence the value of the assets. In terms of the other aspects of ESG, it'll be less of a quantitative risk assessment. It may very well be qualitative, where we try to identify the differences, the implications driven by particular portfolios.
So would you incorporate some kind of a carbon budget in the analysis to weigh different portfolios?
I wouldn't call it a budget, but we would try to assess the amount of carbon. So rather than setting a carbon target, we would lay out the implications of if you chose one portfolio over another, how that would influence the carbon emissions associated with the portfolio.
Okay. And then I'm just curious, some funds have started to set interim targets in order to reach their net zero pledges. Would CalPERS be using this ALM process to affect something along those lines?
Not this year. I think I mentioned earlier, our focus is on the constitutional objectives, on the objectives of maximizing returns, minimizing risk. But we would work with Anne and Simpson to make sure that where we could, those activities where they're return maximizing would be reflected in the portfolio.
Okay, all right,
Ms.
thank you.
Paquin, maybe I'll ask if Anne can add to some of that. So let me ask Jared, if you can please pull Anne forward into the presenters queue. I know a lot of the answer to your question, Ms. Paquin, especially as we triangulate towards that sort of 2030, 2050, has to do with engagement on our work and helping the entire market get to a net zero, as opposed to focusing on tilts in our portfolio. But like I said, let me see if we can get Anne forward, and Anne can give a deeper answer to that. And I will say that a lot of that sustained there is a unit of the research team in Sterling's team that is entirely focused on the sustainability topic, and we are certainly intersecting that work into both our CMA and our asset liability management projecting and work. I don't see Anne yet, but I know she's available.
One thing I will say then,
Anne popped up.
And gets found?
I see her name. She said, "I'm here."
All right, Sterling, go ahead. And Anne, if you want to, while Sterling's speaking, if you want to enable your camera, there we go. Perfect.
Yep. One thing I would say is with the diverse, public equities and as well as the even the private assets over time, as the regulatory environment changes, those changes will be reflected in those indices. And so our portfolio will evolve with the changes in the indices. So I'll step aside and let Anne provide better details.
Yes, thank you very much. And good afternoon to board members. This afternoon, we are going to look at one of our important tracks on human capital management, financial, and also climate change. And we're looking at the evolving regulatory agenda because exactly as Sterling says, what we're seeing is the market is coming to demand the information that it needs to start pricing climate risk. And at the moment, we're really fumbling in the dark, trying to work out quite what's going on. We just don't have the quality to build decent data sets to analyze these risks and the opportunities. And that was very much reflected in our extensive TCFD report that we produced last year. On engagement, as Dan rightly pointed out, what we've done is identify what we're calling the systemically important carbon emitters, and the sectors I think are well flagged in Sterling's slide. And this is really where Climate Action 100 Plus comes into play. So CalPERS isn't just engaging on its own with these companies. We do note that this cohort of just over 100 companies accounts for the third largest source of emissions globally. In other words, the first is China, the second is the United States, and the third is this group, a relatively small group of companies. However, the engagement challenge should not be underestimated. We're really talking about a transformation of the big, heavy industry that's dependent currently on fossil fuels. So about 80% of the world economy is dependent on fossil fuels at the moment. So the start we've made is to build a benchmark, a net zero company benchmark. As Dan says, our goal is transformation in the real economy. It's not about greenwashing the CalPERS portfolio. It's about actually getting this job done in the real economy. That was rolled out at the beginning of this year. And you'll see very importantly, and a number of big oil companies, BP as an example, have begun to align their CapEx with that 2050 transition. This in turn means their customers have got to be able to continue in business using alternative sources of energy or getting to the position where they can offset hard to abate emissions. And we're talking about industries, as Sterling shows on his slide, utilities, obviously manufacturing, and this is involving transportation as well. What's happening with cars, with aviation, with shipping, also steel manufacturing, cement, and more. And also, these companies are operating with global supply chains. So we're touching many other sections of the economy, even though we're focusing on this relatively small number of companies. So those twin tracks of our advocacy work with regulators we'll go into in more detail this afternoon. And on engagement, I think we had a good update for the board at the last meeting when we were able to close out the 5-year strategic plan on sustainable investment, where this engagement strategy really is at the heart of what we're doing. I hope that is helpful, and if I need to cover anything else, please let me know.
No, I think that's very helpful, and I really appreciate all the great work of the staff and all the achievements of Climate Action 100. Just a little curious, though, is if we do move further into emerging markets, and I would imagine they would be much more difficult to do engagement work with, perhaps to advocate with foreign regulators. So we don't have to have that conversation today, but just curious in the future how that would work as we take on that sector.
Yeah, I can make a brief comment on that. We are acutely aware that corporate engagement is difficult when you're a minority shareholder and where you're with companies that may be controlled either by other companies through a Korean tribal arrangement, for example. It might be a family, often the case in continental Europe and in Latin America, or the state, as you say, Ms. Paquin. That is a very common, dominant form of ownership, certainly in Asia. So what we've done at Climate Action 100+ is actually build out a strategy around state-owned enterprises, which, as you rightly say, requires us to work in a very well-coordinated way with regulators and also the government bodies that are directing investment for these state-owned enterprises. So our strategy in those circumstances is somewhat different, but the ambition, the goal is identical, which is to get these companies to net zero by 2050. Thanks.
Thank you very much.
And maybe I'm sorry, Anna, maybe I'll jump in really quickly too, just to reiterate what I had said earlier. This is exactly what you'll see in the candidate portfolios as we come back in September and then in November. These are exactly the set of risks we need to triangulate around is how much return seeking. And sometimes the return is in places like emerging markets where we take on new risks, right? One of CalPERS investment beliefs is that risk is multifaceted. So we've got to think through the lens of ESG risks and the like. We've got to think through the lens of return seeking. We've got to think through the lens of contribution volatility, contribution level, all of these risks that we're going to look to balance. And as I mentioned earlier, there's that concept of, some of the assets are just kind of noisier, right? And when I say noisier, I mean, they just generate more noise in the portfolio. And that's one of the other risks that we're going to ask, we're going to bring candidate portfolios that we'll ask this board to balance. How do we want to think about balancing all of those risks around ESG, noise, private assets, leverage, you name it, with the seeking of returns? And that's not a right or wrong. That's a preference, and those are the preferences that we're going to need to balance as we work our way through this process.
Thank you. I really appreciate that, Ms. Newman. Thanks.
And if I could mention one other thing related to this, I guess, the ALM is sort of the broad strokes for the portfolio. It's the systematic risks that we will take over a long time. Obviously, overlaying on top of that are the more active aspects. And what Anne is describing is a very active engagement to try to improve the returns in the companies that we do find in that passive exposure. So there's a combination of activities, the long-term passive exposure where we believe the indices will reflect the regulatory environment and will improve on these things over time, combined with the more active engagement kind of strategy that Anne's pursuing. All these things add up to, I think, trying to address some of the questions that you've raised.
Thank you. Ms. Melton?
Thank you. I'm looking at page 16 of 21. And both of those charts were very interesting. what I would like to be able to have, if possible, is where CalPERS actually fit in comparison during those timeframes. I don't think we quite need with the chart that compares back 50 years, but certainly back 20 years, it would be really interesting to know what was the targeted asset allocations for CalPERS, what was our actual, and how did both our target and our actual compare to the real results that that were out there. So, is that a realistic request, or is that asking for too much work?
Ms. Middleton, that is a very reasonable request, and I was sorry it took me a second to come off mute because I was making a note of it, but I think that's something that we actually have to hand somewhere, and we'll see where we can dig it up.
I think it'll really help us as we're trying to identify where we want to go and why.
Okay, so that's a follow-up then, Mr. Dan and group, okay? Ms. Taylor.
Thank you, Mr. Jones. So, Sterling, thank you for really wide and extremely in-depth look into our ALM process and what we can be looking at. I like Lisa's comment about what we can look at from further back even and see if what we came up with and where we actually landed. I do know, and I don't know how far back this was, that we were not in stocks, but it was in the 80s, I thought, or that we didn't start getting into stocks until the 80s sometime. So yeah, that would be an interesting scenario to take a look at. I also had a question for Anne, and I kind of wanted to make a little commentary around this. I think it's important that we understand that Anne isn't just doing engagement, that CalPERS for years has looked to the integration, but also partnerships to change governmental structures around, such as going to the SEC, et cetera, around climate, because we are in a dire scenario here. So I don't consider it noise or a choice. I think if we don't start looking at our 2050 assets, you know, what part of our portfolio could end up being stranded because we have to meet the 2050 Paris Accords, and then what's the halfway point look like before, you know, so say 2035 or something, what's that halfway point look like for us in terms of those fossil fuel assets, and how do we avoid losing a ton of money because we're not meeting that goal? And we have to, because we're, you know, we started, you know, Climate Action 100 Plus, Net Zero Alliance. These are our programs. So I kind of wanted Anne to kind of talk about that and whether or not we should make that part of our ALM, because I feel like if we're even just in the next 4 years that our ALM lasts, we need to be talking about the risks and opportunities like you talked about, Anne, but the risks if we don't start looking very seriously, this isn't noise or choice, very seriously at the climate and how we, and what we hold in our portfolio. So that's my first question. So Anne.
Thank you. Thank you very much, Chair. You're really putting your finger on such an important issue, which is 2050 feels as though it's quite a long way away, but we're not going to get there in one leap. We've got to be able to demonstrate the steps we're taking consistent with the risk-adjusted returns that we need to pay pensions. We need to map that as we go forwards. Now, a critical part of our work here, and I go to the net zero company benchmark that we've developed to assess where companies are, to give us a baseline, and then to mark the progress, we're asking each of these companies to give us a short, medium, and long-term path, all the steps along the way at 5, 10, 15, and the ultimate 30 years horizon to 2050. So that's important. We've got time-bound targets and the benchmark. Secondly, coming back to this critical issue of CapEx, this ties directly into the quality of the financials in the company. What we're doing now is working on accounting standards, both internationally and in discussions with the SEC. I'm going to give you an example. If you think about the value of an asset, how does it get stranded because of climate change? Well, this is what happens. You might say, okay, we've got a plant or some assets, and we think they've got a 60-year life. Now, that's not uncommon to have auditors signing off saying, and then what you do is you amortize that asset. You sort of, expect it to last for 60 years, a bit like a mortgage payment. Think of it that way. Nobody can pay their mortgage off in 1 year, but over 30 years, you'll end up paying off your mortgage. Well, this is the life of the asset. Now, if we take a different approach and say that asset should no longer be in use after 30 years, not 60 years, then the amortization has to speed up dramatically. And amortization is just one of those geeky little accounting things that have to be done, when audit committees and auditors are signing off on valuations. There are other elements in accounting that are really relevant as well, concepts like impairment. We've seen some of the companies that we are engaging through Climate Action 100+, taking very significant impairment charges. We're talking tens of billions of dollars, not small change. So getting the accounts lined up with sustainable assumptions, in other words, ticking tie Paris into the audit, you're going to get some very different financial numbers. Now, if companies achieve this goal by simply shedding assets, and they just disappear from view, or we hand them off to other investors, we're not in a position to transition those assets, which is what we really need. So the next big thing in the benchmark is going to be accounting. And that then, on engagement terms, puts us in a position to start talking with audit committees and also looking at our votes on audit committees and our votes on auditors. So that is a topic that's under discussion at the moment. But that is the way that we're actually going to get the sort of wish list and reality tied back into the balance sheet of these companies. And ultimately, I think, unless we can get that accounting in place, we do run these risks of stranded assets. Now, the good news for those of you who are looking at what came out of the G7 meeting, the G7, this is the 7 largest economies, have supported, as has the G20, that we need to have mandatory risk reporting. This is huge. That's going to make a big difference. And secondly, saying we've got to get carbon pricing, because if we don't start dealing with the incentives that are misaligned, carbon gets a free ride. It's not priced, it's an externality. Bringing what's off the balance sheet in terms of risk onto the balance sheet gives us this idea of double materiality, as it's called. But really, who thought that accounting and audit could be so central to a global systemic risk? But it really is going to play a critical role in the transition to net zero.
Well, that's another example of the role that CalPERS plays in getting these things accomplished, right? Getting standardized accounting standards and the TCFDs, et cetera, standardized, so that and carbon pricing. And I know this is all going to be brought up later, so I'm going to wait for some of the stuff. But you actually, I feel like we're on the same wavelength there, because you talked about transitioning. That was my second question. Transitioning those assets out of their portfolio so that then it just disappears. But that doesn't help us. That with us being a universal owner, that's just another part of our portfolio now. So we have to be very mindful of those assets. And I know that has been a problem. I've read several articles where companies are just offloading the dirty fuel part of their assets so that they can meet the Paris climate. So I was going to ask you that question, but you kind of answered it. If you wanted to talk on that a little more, I think it's real important that we continue to follow those assets if we can, or talk to those companies that are thinking of doing that to meet their TCFDs or whatever, that we should be engaging with those companies to not do that, to change their business model.
Yeah, that's exactly right. Out of sight is not out of mind. If those emissions continue to, come out, global warming continues to rise, and CalPERS assets are then exposed to risk. We look at what's been happening with the extreme heat in California. My air conditioning broke down at the weekend, so I've had a few days of understanding what is it like trying to live in 111 degrees heat. Human life is not itself sustainable, never mind a sustainable investment portfolio. So these physical impacts are real investment risks for us. And I would say that this issue about the regulator getting a market-wide line of sight into emissions is something that we've been discussing with the SEC. We're very grateful that Gary Gensler is making himself available to investors. I think we've had now 5 meetings with the chair to cover this broad range of different issues that the regulator is looking at in the United States. We've had a one-on-one discussion with the chair, Gary Gensler, and participated in several meetings with small groups of investors. And if you look at the CalPERS regulatory priorities, you look at the RegFlex agenda that the chair at the SEC has mapped out, you'll see that we've mapped actually 23 points where the SEC planned schedule of work speaks directly to CalPERS priorities. So we really see tremendous opportunity ahead.
Right, and I just want to congratulate you on being asked to talk directly with the regulators. So that's really, really good work, and it shows how forward-thinking CalPERS is when they go to us always. And
all credit to the
congratulate
team.
you.
All credit to the team, Teresa. There's a lot of people who make that all happen. Thank you.
Thank you.
Thank you. Okay, so that, thank you for the presentation. And now we'll ask Mr. Fox whether or not there's anybody from the public who wish to speak on this item.
Mr. Chair, Mr. President, there are no callers.
Okay, thank you, Mr. Fox. Okay, so we will take a break before we get to our last item on today's agenda, and let's return at 3:05, and we will then embark on our last item for today. Okay, thank you.
Thank you, everyone.
Welcome everyone back, and we'll turn our attention now to sustainable investment strategies important to help investors manage risk. This will be a panel presentation moderated by Ann Simpson, Managing Investor Director for Board Governance and Sustainability. So Ms. Simpson, please get started.
Well, President Jones, thank you for that warm welcome for this session. This is a topic which has just come up in our prior session, looking at asset allocation and the asset liability modeling. But this session is really to give us a chance to look at what CalPERS has been arguing for with regulators to make good on our understanding that long-term sustainable value creation is not created by just paying attention to financial capital. CalPERS investment beliefs, which were adopted in 2013, make clear that we know human capital and physical capital have to be managed in a holistic way with financial capital in order to both manage risk, but also to find the opportunities and the returns that we need to pay pensions. That understanding, that insight, really then led us to realize that, as in our strategy, there's three things we can do. And we just touched on this in the ALM discussion earlier. The ultimate goal is, of course, that we can integrate our understanding of risk and return around these three forms of capital in order to make better investment decisions, to be better informed, to have different lines of sight into opportunities as well as risks. But our three channels to get us to that point of integration are to make sure that we're using our ability as a capital allocator, where we have voting rights and we can engage companies. But the other important role that CalPERS has is as an advocate. And our advocacy role with regulators, both in the United States and internationally, is a critical part of our strategy. So what we're going to do today is hear from three leaders in the field who we've been working with very closely in this these priorities that we've developed for CalPERS to support our investment goals. The order that we're going to go in is we're going to talk about the agenda around financial capital first, and Ty Galash will take us through that. We're then going to turn to Professor Fairfax to talk about human capital, and then we'll wrap up with Bob Littman, who will take us through the emerging regulatory agenda on climate change as a key part of our concern with physical capital. So I just want to make 2 points before we begin. CalPERS' agenda on the regulatory front is driven by two ideas that are very familiar to everyone on this session. The first is that markets need information. Market efficiency relies upon a flow of information, and thereby data and corporate reporting are the lifeblood for the financial markets to work effectively, both in capital allocation, also in guiding stewardship, for example, through engagement. But it's not just the disclosure agenda which CalPERS has been arguing for. We also know that markets don't work efficiently if incentives are not aligned. And at the macro level, that's the reason that we are calling for the removal of fossil fuel subsidies, which are running at hundreds of billions of dollars every year, and also that we have a price on carbon. And it was perfect timing this morning to see that the carbon pricing agenda is being endorsed by not just the European Central Bank, not just important other bodies, but the G20 as well. And this is something that we'll be able to come back to in the session. The other thing I think which is very important to recognize is that 5 years ago, when CalPERS developed its strategic plan on sustainable investment, and we boldly put up a priority on data and corporate reporting, I think we all felt, well, that is not for the faint-hearted. How are we going to transform accounting and audit and corporate reporting across the global markets where CalPERS invests? That was a very bold ambition. But I think we've made steady progress in preparing the way, preparing our thinking around the concepts of materiality, double materiality, integration of these factors into financial reporting. And we've moved from the world of best practice measures and now into a dialogue internationally and in the US about mandatory reporting, which can be done with minimum standards and with flexibility. So this really reflects the work that we've done patiently over many, many years, and many people have been involved. Our participation representing CII on the IFRS Advisory Council, where James Andrus currently serves, our role at the SEC Investor Advisory Committee, also at the PCAOB Investor Advisory Group, and James also sits on the FASAC, which is the body which oversees FASB. So we certainly have put time, thought, and effort into this agenda so that we can develop not just a well-articulated agenda to support our fiduciary duty, but also so that we have built an understanding of the complexity of this whole arena of data and corporate reporting. So with that, let me, as just a scene setting for what CalPERS has been doing and why we've been doing it, let's begin with Ty. And just while Ty finds the button for unmute, it's always a challenge on these video links, let me just say a word about Ty. Ty's the executive director of an organization called the Healthy Markets Association. This is a partner of CalPERS. Don Ponce, my colleague, sits on the board of Healthy Markets. And really, Healthy Markets Association has been a thought leader in the field of financial market regulation. Ty himself, in addition to all the experience he brings to the Healthy Markets Association work he does, has an exceptional background understanding the complexities of the federal agenda. He was former counsel in the US Senate, and he was also formerly counsel to the then SEC Commissioner Cara Stein, who has really been a champion of all this good work over many years. He also has a storied career in private practice, so very much to draw upon. So Ty, with that warm welcome, we're looking forward very much to your remarks. And Ty has some slides to take us through what he sees as the direction of travel with the SEC on financial capital reporting and other measures. And here we have your slides. Thank you. So Ty, over to you.
All right. Well, excellent. I really appreciate the kind remarks and introduction. And just to start by saying it's an honor to spend some time with you today, and certainly highlighting some of the work CalPERS has done, and frankly, a lot of work to do. So we're going to start. The goal of this, I think, the first 15 minutes really is to give you an overview of what's actually on the regulatory agenda in DC and how that actually really does align with the agenda that frankly CalPERS has had for now many, many years, and how this is actually a touch point. This is a turning moment in change of the overall agenda. If we could move to slide 2. And I think what we're going to look at is the commission has frankly now, when I say the commission, I'm going to refer to the SEC, which is the primary regulator for both broker-dealers and investment advisors, but also companies that are seeking to go public or issue securities into the marketplace. And so essentially obviously stocks, when we talk about stocks, they're going to often be regulated by the SEC, but also private offerings are in a regulated space by the SEC, i.e. they're actually saying we aren't going to require disclosures and information related to that. So what we're going to spend a lot of time talking about is how the SEC has really shifted, frankly, very, very quickly. And so the SEC, what we're going to spend the next few minutes talking about is 3 real things. One is, what did the SEC's really focused on because of the Biden agenda, sort of political, what is the president from president on down? And I know Marcy had the opportunity to be on stage just recently talking about some of the really big picture ideas. What does the president on down want to do? What are the things that the SEC, that Gary Gensler, the new chair of the SEC, what are the things that he knew and the commission knew kind of going in to his tenure there that the commission has to address? And then lastly, the things that I think are new because of market events. And we've all heard about meme stocks and Archegos, Capital, and sort of new things that get thrown on the agenda that can actually sort of derail what we thought we might want to focus on and what the SEC might want to focus on. So I'm going to start with, so those are going to be the three issues we'll talk about in more detail, and I'll turn it over to Professor Fairfax and to Bob in a moment. So first, the SEC has really spent, frankly, 40 years really thinking about how can we make it easier for companies to raise capital, and not really focusing on, hey, as Ann alluded to earlier, hey, this capital market system works best when investors have information and can make informed decision about what's riskier. And so the SEC has really said, hey, how do we make it easier for companies? What that often means is say less, have fewer requirements, right? And so if companies have fewer obligations and don't have to say quite as much, let's say do a private offering, then it may be easier for them to get capital from investors and provide on an ad hoc basis. Maybe CalPERS investment professionals would require more information than, say, Colorado's investment professionals or some other investor, and try to piece it together that way. Well, this commission is sort of turning that sort of what I will call issuer focus, investment banker focus, on its head and saying, look, we really need to restore focusing on investors and the other market participants, the people who lend money, the workers who work at companies, the people who are supplying the companies, those other market participants. So we're going to see a sort of a focus, not just on the investor protection, is there fraud here, but how do we promote more fair, orderly, and efficient markets? And that's where I think the comments that are going to come from Lisa and Bob will really come into play. So not just the capital formation element, and then obviously also protecting the public interest. The federal securities laws were created in 1933 and 34, not just to say, hey, we want to prevent fraud, but because there was a massive misallocation of resources. Without a federal disclosure regulatory regime, they thought, hey, people wasted a lot of money. A lot of investors lost a lot of money on really, frankly, dumb ideas because they didn't know what they didn't know. And that's where things like human capital risk and climate risk are really going to come into play. If we could move to the next slide, please, I'd really appreciate it. So as I say, it's really been 2 decades of issuer and intermediary primacy. I would actually go all the way back to 1982, but we'll start with the last 2 decades. So now that we're focusing on investor and sort of stakeholder primacy at the commission, we can see that sort of come about in really 3 ways. One is just who do they hire to do things? So Chair Gensler has started with hiring his policy director, which is a new job, never created at the commission before. He started by having as a policy director someone many of you may know, which is Heather Slavkin-Corso, someone who is the policy director, the U.S. head of policy for the AFL-CIO, as well as the United Nations Principles for Responsible Investment. And along with her, he's hired a team of folks in DC who are consumer investor oriented. He does not yet have a division of investment management director. He does not yet have a permanent division of trading and markets director. He now does have a permanent director of the division of corporation finance, which is extremely important because that's the division that will require or not disclosures of companies and disclosures of private companies as well, if they so choose. And so that's one, it's just who do you hire? The next is what are the rules? Conveniently, since being asked to give this presentation, the SEC has released an agenda that's 49 items long. 4 items are in the pre-rulemaking stage. 3 dozen are in the proposing a new rule stage, and 9 are in the, hey, we're going to finalize this rule we've already proposed. But that rule was proposed likely by a Trump appointee, so it might not look the same as it would have had it been finalized 6 months ago or a year ago. And then there's obviously the enforcement agenda. All of these things are going to be materially touching CalPERS. And the reason why I say the enforcement agenda, and I'll just use an example. there's a division at the SEC that's focused on compliance. So they examine broker dealers and investment advisors. And one of the things people have talked about in the climate space over years is, hey, there's a lot of investment advisors who say they really care about various issues, and they factor these in to their voting decisions and their investment decisions. And one of the things that the commission has highlighted in both its examination priorities for this year under acting chair Lee, but also for the Division of Enforcement, a new task force on climate that they've created, is what are investment advisors doing with respect to their proxy voting? So when they're voting, when you're voting, when they're voting shares for people, what are they choosing to do? And that is going to be an enforcement priority for the commission. If we can move to the next slide, that'd be great. All right, so let's start with the three missions. I said one is trying to translate the president's Build Back Better agenda, and what does that mean into SEC speak, for lack of a better phrase, and we'll start talking about the other part. So the first is, he mentioned over and over and over again the existential threat of climate change. How does that translate to SEC speak? As Ann just alluded to, company and fund disclosures. So it's not just an issuer, let's just say General Motors, and it's not just say public issuers, it may be private ones, and it's funds as well. So to what extent does a fund or a separate account in which say CalPERS may be invested, what are they disclosing? When you're buying things, it's not lost on anybody that saying something is quote unquote ESG is not defined terms under the federal securities laws. And it's also not lost on anybody that products that are branded as being climate conscious are able to command a premium in the marketplace, i.e. charge more. And so investment advisors have started to do that. And so what are the naming conventions? So the SEC is looking at things like the naming conventions for funds. What are the tools investment advisors? Are there policies and procedures that investment advisors are using to analyze on these and related factors? Moving, next slide, please. Another element of the Build Back Better is worker rights, worker pay, worker power, right? And that's where we start talking about how are you using your human capital? And this is something that's not just as a result of frankly, last summer and the horrific events of last summer and the protests related to that. It has everything to do with just right now, the decisions people are making. So if customers are making decisions on whether or not to buy Toyota cars based on Toyota's disclosures about how it's spending its money on politicians and supporting political campaigns, then investors in Toyota also have to think about what the impact of those decisions are. So it's not just whether or not disclosures and information will impact an investor's bottom line in terms of whether or not the investor cares or CalPERS cares, but it's the rest of the marketplace. To what extent, when CalPERS is investing in, let's just say, corporate debt, to what extent is that company putting itself at risk in ways that may not be transparent based on how they treat their employees? And we can all go back to the meat packing stories from last year and the plant stories from last year. And executive compensation disclosures, obviously an issue. Share buybacks, obviously these are issues that have been long concerns for CalPERS and other investors for quite some time. Move on to slide 6, please. So now let's talk about the other part. So as Anna alluded to, it's not just whether or not investors like CalPERS have information. It's what do people do with that information? It's the business decisions that come along with it. It's universal proxy ballot I put on there, maybe a term you've never heard of. It's the ability to fire directors. How easily can you hire and fire directors? One of the challenges is the federal securities laws make it actually exceedingly difficult for shareholders to replace an individual director of a publicly traded company. This has been an issue I knew CalPERS has been working on for many, many years. And it's one where the SEC actually proposed, and Council of Institutional Investors for that matter, and it's one the SEC proposed in 2016. It's on the agenda to be finalized, hopefully soon. The shareholder proposals, again, something where active engagement, to what extent can investors say, I look at this information and I want to change your behavior, or alternatively, I want more information than you're willing to provide me or are compelled to provide. So again, the SEC is looking at revising yet again, just recently revised rules on when and how shareholders can put forward proposals, and whether or not, frankly, even you would need, say, to win a shareholder proposal in order to effectuate reform. Perhaps you could say, look, if 20% of investors care about this in a particular company, shouldn't that be enough for the company to make that appropriate disclosure? We're talking about multi-billion-dollar companies. How much do you really need? And then talking about proxy advisor regulation and reliance. At what point can CalPERS say, look, we may not be deeply expert. We may not have someone who can assess hundreds of companies, thousands of companies, and the qualifications on this particular issue. Now, my full confession, having worked with James and Ann for quite some time now, there's a lot of built-up expertise within your organization. But there are times when it's actually really important to be able to rely on subject matter experts. And to what extent can you do that? And the Commission is trying to make that, frankly, easier after spending the last several years trying to make that harder. Moving right along, I want to be really cognizant of time here. All right, and then now let's talk about those are the sort of, I will call the Biden Build Back Better. Then there's the other known regulatory concerns, the things that are unique to the SEC, sort of not really big picture. But for example, the treasuries markets have had flash crashes. That's really concerning if you're worried about funding the government and from a big macroeconomic perspective. And fixed income trading got real significant transparency issues. So the SEC knew going in, hey, we are going to have to regulate that better. Going into January, Gary Gensler and the Commission knew that they were going to have to better regulate digital assets and cryptocurrencies. Frankly, from my perspective, they're often outside of all of the investor protections we normally put on what I would call regular assets, stocks, bonds, futures, commodities, those types of things. Cryptocurrencies sort of work outside of that regulatory apparatus. Special purpose acquisition companies, SPACs, blank check companies, those are areas where the Commission knew it had to address. And private offering exemptions, private equity. It used to be that the vast majority, well over 95% of offerings of securities in the US markets were registered public offerings. We're now less than half. What that means is when you say registered public offering, that's not a fancy term. All that means is the regulators don't require disclosure and information and rights for investors. And so maybe you would be able to negotiate it, but maybe not. And different investors have different expertise, different leverage, different information, different rights. And so to what extent do we want to standardize that, particularly in the climate aspect? 8, please. All right, other known regulatory risks, money market funds, index providers, rating agencies. These are things that people have been talking about for years, but I'm just going to use as an example. BlackRock just the other day decided to change its model portfolio weighting on its assets. And one of those things was to increase exposure to a particular commodity fund. And it was because that particular commodity fund had more energy and fossil fuel exposures, and they thought that was going to be well poised to take advantage of a short-term run-up for their retail customers. That's an interesting thing, but it's also somewhat in the opposite direction of other things that BlackRock has been doing. And so to what extent are the decisions made by various market participants, be it index providers or those who are providing model portfolios or credit ratings, to what extent are they taking these things into consideration? If you're looking at, let's just say, ExxonMobil debt, and you're talking about $1 billion debt offering that's not due till 2038, what do you know about that debt? What is Exxon's ability to pay back that debt? What can CalPERS assess if that's not publicly disclosed or disclosed to CalPERS? Other things like LIBOR, auditing, accounting, those are traditional areas of focus for the SEC. Moving on, if we can deny. And then we're going to get to what I will call the chaos of this year. That is the bogey that has flown into this. All of those were well-laid plans that the commission had in January and November as part of the transition team, and they thought these were the things they were going. And then life had a way of intervening, or GameStop did, or AMC. And so a bunch of other issues, what I will call traditional plumbing issues, have come, plumbing of the markets issues, and that's, for example, conflicted order routing payments. So this is an issue, for example, Don Ponce I've been working with for many years, and CalPERS has been working for many years. When you go and buy and sell stock, is your broker trying to get you the best prices, or are they just trying to maximize their own profits? That's an issue that the SEC has been looking at for over a decade and done nothing about. And Don actually led an effort by other pension funds and many, many investment advisors, got the SEC to propose reforms, then adopt reforms, and that got thrown out by the DC Circuit. So now you're back at square one. So what's going to happen there in the retail space as well as for large investors? Best execution, same idea. Are they getting you the best prices or are they not? Move on to slide 10, please. I'm going to wrap up here in just a moment. Not just GameStop issues, but Archegos. Are large investors trading in products that are creating massive macroeconomic risks, as well as just risks to themselves blowing up? So these are things like securities lending transparency, short selling rules, shortening the settlement cycle. These are all going to materially impact CalPERS' bottom line in what I will call the plumbing of trading. It's going to impact your returns. Shortening the settlement cycle will impact your returns. Holding disclosures will impact your returns. Short selling transparency. Those are things that your investment teams are going to have to better assess and understand. And we can move on to the last one. And with that, I want to turn it over to these folks, because the item that I put last here, or right at the top here, at the selected resources, the SEC's agenda. As I alluded to before, it's 49 items long. Not all items are considered equal. And one thing I will note is that this commission has got those three prongs all competing for space, but they're also different divisions, which means there's a lot of things that can be done at the same time. There's going to be those three themes are the Biden Build Back Better agenda, right? The things they sort of knew they had to deal with before coming in, money market fund regulation. And then what I would call the bogey, the Archegos and GameStop market plumbing issues. And on that first one, the Build Back Better agenda, it's really going to focus an awful lot on climate change and human capital. And that's where I know for a fact our regulators and policy folks on both sides of the aisle are looking to your team for help as to how to get that right. So CalPERS has the information you need to make better decisions. And frankly, using you as a proxy for a lot of other folks. And with that, I will turn it back to Anne and to the other smarter panelists behind me. Thanks.
Thank you very much, Ty. That was a tour de force, and you kept perfectly to time. So we appreciate that. It was a lot to cover. Let me turn now to our professor, Lisa Fairfax. And the way we're building this panel is really to take each of the three themes, financial, human, and physical capital, and then there'll be plenty of time for dialogue with the board, questions and answers. But if there's anything urgent, please do let me know. So it's a tremendous pleasure to have Professor.
And let me ask the question, do you want questions raised after each presentation, or do you want to wait till all three present?
I'd prefer, President Jones, if we could take questions at the end.
Okay, all right.
Because the pieces are quite closely linked.
Okay,
yeah.
Got it. Okay.
Thank you. Thanks. Thanks for your patience,
okay.
Everyone. So it's my real pleasure to introduce Professor Fairfax. You'll see in her biography that was circulated, it's already out of date. Professor Fairfax from the 1st of July this year, was appointed to the University of Pennsylvania. It was a wonderful institution, as Presidential Professor of Law at the Carey Law School. Many of you may also know Lisa's extensive research and publishing on the themes that we're talking about on this session. And she's also the author of 2 books, one of which is focusing on how boards of directors and shareholders interact. So it's a study on engagement. The reason for inviting Professor Fairfax today, though, is that we had the great honor to serve CalPERS and the professor to serve on the Investor Advisory Committee at the SEC together. And some of, I think, the most important work that we were able to do was on building out a framework for human capital management. Disclosure. This responded to a petition that the Human Capital Management Coalition, a group that CalPERS co-founded, that petition called on the SEC to develop a framework for reporting. And based on the research evidence at that point, and of course it's all patchy because we don't have the reporting at the moment, the recommendations were brought forward. Now, this was before the pandemic. The SEC, under the previous chair, Clayton, accepted the recommendations for in principle reporting, but of course they've not been the standards. So it hasn't led to an enormous amount of improved information. But Professor Fairfax was critical to that work and I think brought scholarship and brilliance to all the proceedings. And now the new chair is coming in with, I think, a very strong foundation, thinking through the investor protection and the capital formation aspects of what matters on human capital. This side of the pandemic, nobody can argue that this is not relevant to corporate performance at the micro level, at the firm level, but also obviously has wider market impact. So with that, really by way of background to Professor Fairfax's remarks, let me turn to her to take us through her thinking on what matters most to investors, what the recent developments have been over this past year since that work was done, and also give us her sense of what's ahead. We've provided the Human Capital Management Investor Advisory Committee recommendation because it was adopted by the SEC. That's there as background reading in the materials that you've got. But with that, Lisa, let me hand over to you. We're looking forward to your remarks very much.
Thank you so much, Anne, and thank you for everyone here on this call for giving me the opportunity to drill down on some of the issues that Ty eloquently framed up, and really, of course, to share my thoughts around human capital management disclosure. I also want to thank in advance Bob, because I know he's going to do a marvelous job of talking about some of the physical and climate issues. It was really just an honor to serve with Anne on the SEC's Investor Advisory Committee. And, you know, what she shared with you in the pre-read was really a collaboration of the committee's thoughts around human capital disclosure. And I hate to toot our own horn, but we were right. About the appropriate framework that needed to occur in terms of disclosure. You know, one of the things around which I think Anne and I were really aligned, and Anne really in her role as representative of CalPERS, was that issues related to human capital, social capital, you know, the environment, our physical capital, were really not outside of the purview of needed regulation and disclosure. And that's because those kinds of issues and effective management of those issues really drive value creation, and thus are really intimately linked with investor risk and return, and by extension, intimately linked with the company's financial performance and long-term health. So I'm agreeing here with Ty that we're at a turning our inflection point, because what we're seeing right now is this gradual recognition of that linkage, and what Anne talked about, this gradual recognition of the fact that these things are integrated. And so if you're really in the business of trying to promote capital formation and protect investors, then you have to give investors the tools they need to understand investment risk and return. And in order to do that appropriately, you have to give them accurate, reliable, and comparable information about human capital. So CalPERS really has been on the forefront of understanding that important linkage and integration, and more importantly, getting others to understand that link, particularly other key regulators. So what I want to talk about today is kind of where we are with regard to this issue. And I'll do that by focusing on 5 things. The first is I want to define for you human capital and human capital management. The second is I want to underscore why human capital management is vital to investors and investor protection. Third, I want to provide a little bit of the evolution of the human capital management disclosure. Fourth, I want to give you a window into the current human capital management disclosure trends. And finally, offer up some of my thoughts around the future of disclosure in this area. So first, what is human capital management? It's worth noting that in its most recent rulemaking, the SEC under the former Chair Clayton specifically refused to define human capital management based on the notion that the definition should be evolving and should be tailored to the needs of different companies and different industries. I'm, however, going to give you a definition so that we can be on the same page. Broadly speaking, human capital refers to the idea that there is economic value as well as costs associated with humans, i.e. the workers who engage with the company. Human capital management is concerned with the policies and practices that companies use to effectively manage the cost and value of human capital. That is, human capital management seeks to answer the question regarding what companies are doing to drive value and mitigate cost and risk with respect to the humans that impact their business and financial performance. So that, in a nutshell, is what we're talking about. Why is human capital management important to investors? The answer is really simple and straightforward. Increasingly, the most important driver of company value is their workforce. And investors, therefore, cannot understand how companies are managing their value without a sufficient understanding about how they're managing their human capital. So research shows that from the 1930s to the 1970s, 83% of a company's value was associated with physical assets, which is, of course, why the vast majority of required disclosure centered around these physical assets. But times have changed, and things have essentially flipped. Recent studies show that as of 2015, some 85% of a company's value is associated with its workforce and other tangible assets. Unfortunately, required disclosure has not caught up to this shift, which means that disclosure is essentially stuck in the 1930s, not the realities of the 21st century. Being stuck means that investors cannot effectively evaluate whether or not companies have the right resources, the right policies, the right practices to manage the human assets that everyone agrees is the primary driver of a company's value creation and cost. Of course, it goes without saying, as Ann mentioned, that 2020 and its aftermath dramatically demonstrated the relevance of human capital to investors, the corporation, and the broader markets, right? With respect to diversity on the one hand, the summer of 2020 and its aftermath highlighted the ways in which appropriate or inappropriate management of diversity-related issues could impact the company's health, its safety, and its welfare, both in the short and long term. Similarly, of course, COVID and the pandemic dramatically underscored the link between worker health and safety and the resiliency and sustainability of a company's business activities. Both of these things, therefore, highlight the importance of human capital and the importance of the types of disclosure projects that Ann and I were working on. So how has disclosure on human capital evolved? First, there was nothing. And then in around 1977, the SEC enacted Item 101 of Regulation SK, essentially a human capital rule with only one specific requirement: required disclosure of the number of persons employed by the company. Of course, growing recognition around the importance of human capital management led organizations like CalPERS and others to push for more meaningful human capital disclosure. That push ultimately led to August 2020 and the enactment of a human capital rule, which became effective in November of 2020. The 2020 rule amends Item 101 of Regulation SK, imposing essentially two things. First is a description of the number of persons employed by a company, which is basically just the same old rule. The second is a description of human capital measures or objectives that a company focuses on when managing its business. The rule also provides a very small example of what type of human capital resources you should think about disclosing. So the rule says, depending on the nature of a company's business and workforce, disclosure should cover measures that address development, attraction, and retention of personnel. In enacting the rule, the SEC made clear that disclosure should be linked to materiality, right? Companies should disclose measures or objectives that a reasonable investor would find important when making their investment decision. As you can see, hopefully, from what I just described, the rule was modest, to say the least, right? Here's what the rule did not do. It did not define human capital and human capital management. And that was a deliberate choice based on the notion that that definition may evolve and may need to be tailored to different companies and different industries. It also, despite the kind of soft ask around disclosure related to development, attraction, and retention, did not give any specific requirements, nor did it adopt any specific examples around what should be disclosed. And this too was done deliberately. As I mentioned at the outset, Ann and I were part of the Investor Advisory Committee that recommended not just a new rule in this area, but also that the rule include examples of the types of things that should be disclosed, like data on full and part-time workers, turnover, workforce safety, training, race and gender diversity, productivity, compensation, but none of these examples appeared in the 2020 rule. And again, that was a deliberate decision. Before discussing some of the trends associated with the new rule, let me give you my thoughts on that decision. On the one hand, I think there's good news about the rule. It is at least a step forward in the recognition of the centrality of human capital to a company's financial health and well-being, the centrality of this issue to investors and capital formation. Some also consider good news being that the SEC adopted what is referred to as principle-based disclosure, which steers clear of hard and fast rules and gives companies flexibility to make human capital disclosures tailored to their unique business needs. The bad news, at least from my perspective, is that the lack of specificity, even in terms of non-binding examples, creates the potential that a disclosure will not only be costly, but will fall far short of what investors really need. In other areas, for example, like board diversity or climate change, we have unfortunately found that when the SEC refuses to define what it's looking for or give examples about what it's looking for, the result tends to be disclosure that is A, less meaningful for investors because it's inconsistent, less robust, and less useful in terms of comparison, and disclosure that is ultimately more costly to investors because it takes more resources to understand, digest, and compare information across companies. So, okay, what's happening on the ground? What are we seeing in terms of disclosure? I mentioned that the rule went into effect in November of 2020. So we just have a little bit of data, but there have actually been several studies discussing what we know so far. So Ernst & Young, Equilar, Compensation Advisory Partners, Intelligence, to name a few, have all kind of looked at the data to date. I've also reviewed hundreds of proxy statements to try to understand what are companies doing? How are they meeting the new rule? What I can tell you is that companies are taking their obligations seriously, and that's what most of these other studies conclude, but they're also wrestling with confusion in at least 3 areas. The first is really how much to say, right? And the amount of disclosure varies widely, and it doesn't depend on the size of the company, and that's what the studies underscore, right? You get 300 to 500 words from Amazon, and then you get almost 7,000 words from Wells Fargo, right? The average is about a single page, but there's a wide variety in terms of amount. The second is companies are struggling over proper format. Do we do narrative, kind of qualitative discussions, or do we opt for quantitative in terms of hard numbers and charts? There's one study that indicates that close to 90% of companies choose a mix of both. I think, however, the reality is best captured by intelligence, which essentially says that few issuers are providing meaningful numbers around human capital, even when they have the numbers and could otherwise disclose them. What we're seeing is basically companies are narrating. And even when they provide numbers, they avoid historical or current numbers in favor of kind of aspirational goals or targets. So that's kind of what we're seeing in terms of format. And then third and finally, right, if you don't give companies examples or requirements, then they got to figure out what they need to discuss, right? So what topics are being discussed? Studies and reviews, and certainly my review, show that there are about 11 common themes. The first is workforce demographics. The vast majority of companies are, of course, giving information about their employees, geography, part-time, full-time, seasonal. So we're seeing that. Second, and this is consistent with the times, diversity, equity, and inclusion, right? Sometimes called DEI. These matters are getting a lot of prominence in disclosure. Things like employee identity, leadership roles, pay equity, inclusion efforts. Of note, though, much of the DEI information is qualitative. That is, less about numbers, less about metrics, more about narrations. However, it is very prominent, right? Usually not only in the proxy statement itself, but also in proxy summaries and some discussion in opening kind of board letters and CEO letters. So it's there, it's prominent, it's recognizable. Third is, of course, health and safety, consistent with, right, the pandemic and COVID. And some companies are rolling it into their discussion of the pandemic, and others are creating kind of separate headlines around it. But this is a very prominent discussion. The fourth is benefits, compensation, incentives. Almost every company discusses this issue. However, there's, again, wide variance on what and how they discuss it. Less, again, about hard numbers and more about discussion relating to compensation philosophy. Fifth is company culture and core values. Lots of focus on this issue. That should not be too surprising given the Business Roundtable statement on corporate purpose. You're also seeing a discussion of kind of employment engagement and satisfaction surveys wrapped into this notion of culture. 6 is around employee development and training, including sometimes cost associated with those things. 7th is around turnover, recruitment, hiring, retention policies. And most companies wrap in a discussion of this connected to diversity and what's happening with those issues as it relates to diversity. The 8th is around labor relations and collective bargaining. So that's receiving some discussion. The 9th is around workforce cost and productivity. And then the 10th thing is around community, charity, volunteer efforts, which is really a migration of kind of voluntary disclosure in this area into the proxy. And then finally, what we're seeing is some disclosure around governance and oversight of human capital management, usually discussion about the board's role or officer's role with respect to these issues. The interesting note is oftentimes you'll see some companies using the board matrix or charts on board skills to talk about human capital management and who has those levels of skills. Importantly, I'm talking about these skills, but you're not going to see them in all of the disclosure. These are common things, but there's such a wide variance in how they're presented, where they're presented, how much is presented, right? That really, it's a little bit of the wild, wild west. So collectively, you do see these things, but really because there weren't any particular guidance, you see these at different levels and in different places. So what's my crystal ball on what's next? I think you should think about that along three lines. First, investors like CalPERS are probably, hopefully, going to step up the pressure for more consistent, standardized disclosure, more robust data, including more relatable and more reliable charts and matrix. Then corporations are going to evolve as they learn what works and what matters, right? In fact, it's interesting, studies have shown that later filers have more robust, more refined, and more useful disclosure in this area. So there's already a learning curve that we're seeing with corporations and their evolution. And then, of course, Ty mentioned this is on the SEC's agenda. The new chair has already signaled that this is a top priority in terms of disclosure. And I'll say two things about that. First, of course, he's already talked about the fact that the staff is already working on a new rule, right, to update the 2020 rule. And the second thing that he's already signaled is that the new rule will include less about a principle-based approach and more in terms of direction and hard data around at least 3 things, or at least these are 6 things that he signaled: diversity, part-time versus full-time workers, employee turnover, development and training of employees, compensation and benefits, and finally, health and safety. So those issues, hopefully there'll be more direction, more guidance, and potentially more requirement about what needs to happen in those spaces. That is, of course, the hope. You never know. But I think ultimately what we're looking for is more reliable, more consistent, and more easily comparable data around this area. And that is, of course, what we talked about, what our project in 2018 at the Investor Advisory Committee was about. Too early to tell if we'll get that, but I think they're promising signs nonetheless. So thank you so much for your time and attention. I look forward to Bob's talk and to the conversation afterwards.
Thank you very much, Lisa. This is a ringing phrase that disclosure is stuck in the 1930s, and we need a disclosure framework for the 21st century. So with that, let's turn to Bob for our third speaker to address this idea that a critical part of understanding risk and return is understanding physical capital. In other words, not stuff so much, but the natural capital that actually underpins the economy and the functioning of wider society. Now, again, it's a tremendous pleasure to have Bob with us. CalPERS served on a very important committee that Bob chaired on behalf of the CFTC. This is the Commodities Futures Trading regulatory body, which reports into the SEC. And I think in terms of building out a bipartisan understanding of the issues, the timing of Bob's committee's report was extremely important. It came out last September before the election, and I think it shows the growing consensus across party lines that climate change is a financial risk and there is work for the regulatory community to do. Bob is probably one of the best placed people in the world to take us through this rather technical but incredibly important work that he was doing. We've given you the report itself as background reading. There's a very nice executive summary. So it's a pretty lengthy report, but the summary will give you a good feel for what the recommendations are. And those recommendations really do focus on this idea of information and also on incentives, both of which are absolutely critical to market efficiency. However, I would be remiss if I didn't say a little about Bob's own background. There's not many people in the world who end up with something named after them. But those of you who've been knocking around in the investment world for a long time will know the Black Litterman model. This is one of the standards of analytical work. It's a mathematical model, but it really is highly regarded. It's been incredibly influential. And essentially, it's a global asset allocation model and is named after you, named after you in part with your wonderful partner, Fisher, who developed that with you whilst you were at Goldman Sachs. So Bob was at Goldman Sachs for many years. More recently, he's the founder of CalPERS Capital. I had to go to a dictionary to just check what CalPERS actually meant. I was delighted to find this is the garden of Epicurus. So this is an image which is rather nice. This is Voltaire at the end of Candide on what is to be done. We must attend to the garden. So it's a lovely image. This report that you chaired really, I think, was groundbreaking analysis in the United States. And it really is setting an agenda, not just for the US, but something which has been very highly regarded internationally. And our former colleague, Divya Mankikar, was CalPERS representative for that good work. We're very grateful to her. And for the team, which provided so much support. Bob also sits on the board of Ceres, a board I know Betty Yee sits upon and which I've just joined. So we have many opportunities to exchange ideas, compare notes, and just wonder how we're going to get all of this stuff done, but we must get it done. So with that, Bob, over to you. I know you have some slides and you may not be able to have time to go through all of them, as we said. So please just let us know which ones you'd like to focus on for this session. So
Sure.
Bob, over to you.
Well, thank you so much for that generous introduction, Anne. It's certainly my pleasure to be able to be here and address the board on this very important topic of climate risk and what it means for investors. Investment boards such as yourselves are very familiar with making investment decisions that balance risk and return in the financial markets. And where I want to start is on slide 3 with 4 lessons from financial risk management, which have application in addressing climate change. Financial risk management is often highly technical with lots of Greek letters and so on, but the lessons I want to focus on are very simple and hopefully fairly obvious. The first one is just that risk management requires consideration of worst case scenarios. Now, in years past, many people kind of called people who worried about climate risk alarmists. Well, if you're in the business of risk management, you're not an alarmist. That's what your business is to think about what could go wrong. And these days, we're seeing lots of things going wrong with respect to climate. You've got the heat in California, the drought. We have similar, I'm in Colorado right now. There's wildfires all around here already. So, we're seeing these events more and more, and it's very clear that they're real. No one is denying them anymore. And the second point to make is that growing risk is an urgent priority. Time is a scarce resource, and time is of the essence when you're managing risk. We just saw this global pandemic and how when it got out of control because we didn't address it so quickly, you couldn't put it back in the bottle. And similarly with climate risk, we really have to address it urgently. And then the third point to make, this one is perhaps not as obvious, but the purpose of risk management is not to minimize risk. It's to price risk appropriately. And back when I was the head of risk management at Goldman Sachs, and by the way, Gary Gensler was head of controllers at the same time. So we've been managing risk together for 25 years. But when I was, the partners of Goldman Sachs did not want to minimize risk. What they wanted to do is to make sure that we were getting paid appropriately for the risks that we were taking. And that's really the fundamental mistake that we're all making now with respect to climate risk. We're not pricing it appropriately. We're not getting paid for the risk that we take. And I'll come back to that. But finally, risk is what we measure. We come up with metrics for risks. In investments, it's things like tracking error or volatility. With respect to climate, we try and measure things like the social cost of carbon. But these are all model-based, and we have to take them with a grain of salt. And sometimes economists make the distinction between risk and uncertainty. Uncertainty is what we manage in the real world. It doesn't come out of a model. It's much more complicated, and things can go wrong. Our models may be too simple. And so the implication of that as an investor is that when you are managing risk and managing uncertainty, I should say, you have to be cautious. You have to err on the side of caution. And clearly, we're not doing that with respect to climate. Now, if we can go to the next slide, I want to talk about the CFTC report that Anne mentioned. I think it was really quite groundbreaking, and I do want to give a lot of credit to the commissioner of the CFTC, Russ Benham, who sponsored this report. Russ is now the acting chair of the CFTC, and he did a really good job in establishing the subcommittee that he asked me to chair, and I was very honored to chair it, in picking the 35 members, including CalPERS, in asking us to come up with a consensus report, asking it to be high level, and to come up with as many specific recommendations as we could. And I must tell you, it was a very interesting exercise. Divya was a terrific representative from CalPERS, but Anne, you and Ben Meng, the former CEO, I guess, have been really helpful as we went through a difficult challenge in trying to reach consensus. So on the next slide, we list some of the topics that we addressed in this. Oh, I'm sorry, before we go to the next, this slide shows the folks who were on the committee, including CalPERS, but I wanted to focus here on the diversity of the representatives. You are obviously an asset owner representing asset owners. We had investors like Wellington and Vanguard. We had insurance companies like Allianz, banks, Citi, JP Morgan, Morgan Stanley. We also also had corporates such as ConocoPhillips and BP, ag companies. We also had a lot of academics and NGO representatives such as EDF, SASB, Ceres, the Nature Conservancy, and so on. And so we had an awful a lot of different views, and we wanted to get to consensus. Well, a lot of people thought that we were trying to boil the ocean, that we'd never get there. Actually, I think we accomplished a lot. And on the next slide, we do talk about what the topics were that we addressed and how we thought about this. So we broke up into work streams focused on climate risks, data and analysis, climate risk disclosure, the role of financial regulators, scenarios and stress tests, and perhaps the most important, financing the net zero transition. Because one of the things that basically everyone in the financial markets, and frankly the corporate as well, recognize is that we have to move quickly to a net zero economy. And the target of 2050 is now pretty much universally adopted, in China 2060. But in any case, this represents a very rapid transition. It's not business as usual. It's not continuation on the same path that we're on. Rather, it's a roadmap that requires a basic set of changes. We looked very closely into these. We set up these work streams and wrote this report with many recommendations. Now, if we go to the next slide, we'll start to talk about what are some of the things that we did agree on. And the first one is that we need appropriate incentives. I'm just quoting here from the report. Appropriate incentives are fundamental to the efficient allocation of capital. They are urgent, they are missing, and they need to be addressed. Financial markets today are not pricing climate risk. The financial markets cannot do that on their own. Until this fundamental flaw is fixed, capital will flow in the wrong direction. That's the context for, but not the focus of this report. But it was the unanimous and the most important recommendation. As you see in the bottom red box there, this is the single most important step to manage climate risk and drive the appropriate allocation of capital. That's a quote from the report. Now, in addition to price and climate risk, which we all agreed on, there were a number of other themes that we agreed on. On the next slide, we talk about some of these other themes. The need for collaboration with international efforts, that was throughout our report. The need for leadership by the financial regulators to guide an iterative process forward while leaving room for American financial innovation. A consensus about the need to move quickly to improve the quality of data, analytics, and understanding of the many dimensions of climate risk. Approaches to scenario analysis, stress testing, and standardization of definitions that will help move us forward in what will no doubt be a complex, iterative path toward the development of meaningful disclosure of material climate risk information, a goal toward which we all agree we must move more quickly. The next couple of slides I'll go through quickly. These go into a little bit more detail. If we can go to the next slide, central banks play a crucial role. I won't go through all of these, but we had specific recommendations for all of the financial regulators, including central banks, and in particular that they need to coordinate with central banks around the world. On the next slide, we also felt international coordination is essential. We mentioned the Network for Greening the Financial System, which is the group of central banks globally that is focusing on managing climate risk in the financial system. We mentioned that in the report 53 times. We talk about what the Fed should do. I would point out, though, and many people think that the Fed sits at the top of the regulatory framework. Actually, it's the Financial Stability Oversight Council. And FSOC is chaired by Treasury Secretary Yellen, but the Fed sits on it, the SEC sits on it, the CFTC sits on it, and all of the other financial regulators that sit on it. And I must say, the FSOC has met since our report has come out and really been very supportive of basically everything in the report. The financial regulators now are moving forward very quickly, all of them, to address the recommendations that we made in the report. And so I feel very positive about that. On the next slide, we talk about the fact that we need to finance, in terms of trillions of dollars, the transition to net zero. And what we say in that is there's a lot of things that the financial regulators can do, but the most important thing is we have to give the right incentives to the private sector. They don't have those incentives to reduce emissions now. We're not pricing carbon, and therefore the investments that are being made given the wrong set of incentives, and therefore those incentives are going in the wrong direction. We have to correct that. It's basically a bug in our financial system. It can't be addressed, though, by the participants themselves. It can't be addressed by the regulators. It's something that has to be done by Congress. And therefore, I personally am very thankful for the support that we have had from CalPERS and more generally from the financial system and from corporates in supporting putting a price on carbon. And it's something that you may know I'm co-chair of the Climate Leadership Council, which is the group that supports the Baker-Schultz Carbon Dividend Plan, the leading bipartisan approach to pricing carbon. It's something that's definitely being considered right now in Washington. And finally, fiscal policy. In addition to changing the tax code to give the right incentives to reduce emissions, there's many things that I'm sure you're very familiar with that the Biden administration is trying to accomplish now in terms of funding research, funding infrastructure building, getting the right incentives in place, and so on. So all of this is going on. I feel very positive about it. Now, I'd like to talk a little bit more on the next slide about the incentives that are in place to reduce emissions globally. And my firm, CalPERS, has created something we call the Carbon Barometer. If you look up Carbon Barometer on the internet, you'll find this website. And what we do there is we look at the incentives in a comprehensive fashion, not just carbon taxes, but cap and trade systems, gasoline taxes, other fossil fuel taxes and subsidies, renewable portfolio standards, feed-in tariffs, low carbon fuel standards. We have many types of incentives, particularly in California. I would say we have many of these incentives, and they're designed to, in most cases, reduce emissions. Now, if you have subsidies to fossil fuels, obviously those incentives go in the wrong direction. And what we did is we started looking at these comprehensive marginal incentives to reduce emissions over time and across countries. And what we found is something very interesting. On this slide, on the right-hand side, now, unfortunately, I'm not sure that you can read in the tiny print there the names of countries across the bottom. But what you see is a chart that shows different incentives to reduce emissions, ranging from a strong negative incentive in the country of Iran to a very strong positive incentive, over $100 a ton in France. So many people think we haven't really tried pricing carbon. Actually, around the world today, there's a diverse set of incentives to reduce emissions. Most of them, these countries on the right-hand side, are in Europe. The US is actually right here in the middle at $18 a ton. So it's ranging from minus 100 to plus 100. The global average is about $13 a ton, which is what it is in India, which is right next to the US. So you can see we're kind of in the middle ground where we're not really pricing emissions. And over here on the left-hand side, you can see represented by different colors. The US is kind of gray. We're not particularly strongly incentivizing reductions in emissions. Europe, you can see all the dark colors. Those have strong incentives to reduce emissions. And some of these countries have very weak incentives. And then the size of the circle, you can see here in China, has the largest emissions, then the US, then India, and the other countries. Now, if we go to the next slide, we can see some of the relationship between the carbon intensity of an economy and the incentive to reduce emissions. And so what you see here on the vertical axis is the carbon intensity measured in terms of purchasing kilograms of carbon per dollar of GDP. And it's very low in France, in the UK, and Germany. These are the European countries that have strong incentives to reduce emissions. They've already decarbonized their economy. The US is here kind of in the middle. And then obviously you see some of these other countries that have very carbon intensive economies. If we look at the next slide, we can also see how the incentive to reduce emissions drives the decarbonization itself. So here, what we're looking at on the horizontal axis is not the current incentive, but rather the incentive a decade ago to reduce emissions. And again, what you see on the vertical axis is the rate at which these countries have reduced emissions. So you see the European countries over here have had a decade ago strong incentives to reduce emissions, and they've decarbonized their economies significantly. Now, the US and China have also done a fair amount of decarbonization, although we didn't have as strong of an incentives. And then you can see again, the countries that don't have incentives to reduce emissions, that actually have incentives to go the wrong way, they've actually become more carbon intensive. Bottom line is incentives are critically important and they do work, and we need to impose them going forward. Now, finally, on the next slide, what I want to talk about is urgency. We talked about the fact that time is critical here, and we don't know how much time we have. Let me illustrate that by showing a long history here. This starts in 1900 on the horizontal axis, goes to 2100, so 2 centuries. And what you're looking at on the vertical axis is the excess CO2 in the atmosphere. Not emissions per se, but the stock of CO2 in the atmosphere. And I call it excess. You've probably heard that right today there's something like 415 parts per million of carbon dioxide in the atmosphere. Well, historically, it was about 280. But I like to look at the excess. So we had a very small excess back in 1900, 1950, when I was born, still pretty small. But you see how it's grown dramatically. Now, what this graph is designed to illustrate is the difference between starting to reduce emissions, to price emissions today. I often say what we need to do is slam on the brakes. We have to create those incentives to reduce emissions. Today, it's 2020. Here's where we are, 2021. And already we've got about 135 parts per million of excess CO2. Had we started reducing emissions, had we started pricing emissions back in 1980, when people started worrying about this almost 40 years ago, we would have already peaked in terms of CO2 in the atmosphere, and it would be coming down. We would have not only reduced emissions, but we would be now at essentially net zero or below, but we didn't start then. If we had started 10 years later, we'd be at approximately, here on the blue line. 10 years later, the green line. Where we are today, unfortunately, is in the orange line. If we were to price emissions today, this is the best we can do. And in terms of risk, you can think of the area under this curve, which is the amount of warming that goes on, as being the amount of risk. Compare the amount of risk had we started in 1980 versus where we are here in 2020. And look where we'll be in 2030. If we go to the next slide, we can see the implication of this delay. In terms of the maximum temperature that's going to be reached, it's going to be reached around 2070 or 2080 if we start today. Now, if we don't start today, it's going to peak maybe more than 10 years later. And you can see the difference in the peak. If we start today and slam on the brakes, jump to a globally harmonized, significant incentive to reduce emissions, we're probably going to end up somewhere between 1.5 and 2 degrees C. That's the best case. And you can see where we are today. So for the next 3 decades, basically things are going to get worse no matter what we do. That's baked into the cake, because it's the amount of CO2 in the atmosphere. The people often talk about the bathtub analogy. It's the level of water in the tub that matters, that creates the warming. And we're talking today about reducing the flow that's going in. So it takes a long time because of the lags in the system. And where we are today is just the tip of the iceberg in terms of the amount of damage that could be done because of these continuing warming over time. That's why it's so important that we get started today. And then I think the final slide is one coming back to what does it mean for investors? This is kind of interesting now. It's a graph of the World Wildlife Fund stranded asset return, total return swap, something that we put on when I was chairing the investment committee at the World Wildlife Fund over 7 years ago. So back in the beginning of 2014, we talked about divestment from fossil fuels because we wanted to align our portfolio with our mission. And we had a number of board members who felt very strongly that we shouldn't be supporting or investing in fossil fuels. Well, our advisors told us, that was going to be a very difficult task to get rid of. First of all, we had very small amounts, but they were spread throughout the portfolio, so it was going to be very expensive. And we said, well, we're the World Wildlife Fund. we're not worried about the expense. We're worried about the alignment of our portfolio. And they came up with something that in retrospect, I really think it was a great idea, in part because it was very inexpensive, in part it was just very clean and simple. And it was basically, we took our stranded assets, coal, tar sands, oil exploration and production in our portfolio. And rather than try and divest them, we simply put an overlay on the portfolio and sold their return to a counterparty. It was Deutsche Bank, who then paid us the total return on the S&P 500. One reason I like that is because it was a very simple bet, and you're seeing the result of this bet, the cumulative performance from the inception of that swap, and it was the best performing asset in our portfolio. Those stranded assets underperformed the market, the S&P 500, by 165% over a 7-year period. And you can, some of the important dates are kind of annotated there. For instance, Yale's David Swensen, one of the most respected investors, wrote a letter to his external managers back at the August 27th of 2014 saying climate change is important to all of our investments and we want you to take it into account. Well, that was a strong message to the investment management industry. But in any case, you can see if you have this kind of outperformance of the market relative to stranded assets, their valuations have collapsed. And that's basically what has happened over the last 7 years. If you had asked me at the time that we put this on, would this be a good investment? I would have said, well, I think it's probably a good bet. I had no idea that it would perform this well. I'm sure you've heard firms like ExxonMobil used to be the biggest company in the S&P 500 is now no longer there. That's because its valuation, has halved while the valuation of the S&P 500 has doubled. What's interesting, though, is, the markets are forward looking. So I would have to say, I think the stranded asset theme, if you will, is pretty much over. In fact, in the last year, certainly the last 9 months, energy has been one of the strongest, I think the strongest sector of the US economy. So stranded assets is no longer something that I would say you should focus on. And when I say focus on, when a big investment portfolio like yours, which is basically a universal owner, thinks about policies with respect to, say, climate, really, it's probably best to think about it in terms of the underlying benchmark. And maybe 7 years ago, you might have wanted to underweight fossil fuels. That might have been something you'd think about. It wasn't as obvious, certainly not obvious at all, by the way. I remember when we did this in 2014, one of my investment banking partners at Goldman who focused on energy companies said, Bob, you're shorting a coal is pretty risky. That coal sector is worth 50% of what it was just a few years ago. Well, 50% on the way to zero, and got recapitalized and went to zero essentially again. The biggest US coal company, Peabody, was worth something like $100 million a year ago. Today, it's over $1 billion. The point being, timing is everything. These stranded assets have already collapsed in value. I think today, what you want to focus on are the opportunities on, the other side of the balance sheet. That is to say, which companies are going to do well. And in the last year, when stranded assets have really outperformed, at the same time, investments in renewables, in battery companies, in electric vehicles, in all of the clean tech type sectors have been soaring. So I think you definitely want to focus much more broadly on the opportunity side of the equation, and also within sectors. So there's going to be winners and losers in the oil and gas industry, and I know that you'll want to try and understand which companies are going to do better, which are going to do worse. And that's why disclosure is so important when you think about companies and what is their plan to be aligned with a rapid transition to a net zero economy. Are they going to be able to succeed or not? And there'll be some companies in every industry that will do better than others. In part, it's because they're forward looking, they see where we're going, and they've adjusted their business plans that way as well. So to summarize, I would say what you need to think about in terms of incorporating climate risk into your portfolio is number one, how you invest, which companies are going to do well in this rapid transition. Number two, the policies that are necessary, both in terms of disclosure and also in terms of creating those incentives to reduce emissions. And then finally, your engagement with the underlying corporations, be it Exxon and other oil and gas companies, or electric vehicle companies, and so on. There's plenty of opportunities there, and plenty of opportunity for investors like yourselves to exert your governance responsibilities for these companies. And with that, I'll pause and take questions, or all of us will take questions. So thank you.
No, thank you. Thank you very much, Bob. That was absolutely fascinating. And I can really see the connectivity between all of these three presentations on our unifying theme of information and incentives. Both need to work together to get markets working efficiently. But let me hand back to President Jones. I can see in the chat that we have a couple of questions, but over to you, sir.
Yeah, thank you, Lisa, Ty, and Bob. That was a great presentation and so timely, because as you're probably aware, we're in the midst of our asset liability management process, and in an earlier presentation today, we talked about some of the things that you talked about, and we're going to be able to incorporate that type of thinking in our process going forward as we get into the next level of our asset liability management process. So thank you for the presentation. And I see we do have a question from Teresa, and I have a couple, but I'll wait for my colleagues to go first. Ms. Taylor.
Thank you, Mr. Jones. You sure? You can go.
Oh, okay. Well, I just do a protocol, But okay, but I'll go for it. Go ahead and go. It's just, well, first of all, again, as I said, that this is so timely, and I think, Bob, your focus was internationally, which is great because we're a global investor, and our public equities are probably 50% U.S. and 50% in other countries. So that's so important. So my question goes back to, I guess this is Ty, but the SEC, when it promulgate regulations, it doesn't go beyond the water's edge, does it? So that's one question, is whether or not those decisions or policy changes at SEC, does it go beyond the water's edge? Because as I said, we have investments all over the world, and how do we then engage other governmental agencies in other countries to recognize some of these risks? And I know that we do it through a number of partnerships, and your company, Bob, included, through ICGN, CII, and a number of TRI, and all those companies. But what about the government part of it? How do we influence the government? And also, Ty, I did look at some of your links on your report, and I saw a lot of absent dates on next steps in terms of the SEC. For example, diversity, I looked at that one and it didn't have a date. It just, I guess it was just blank about what were the next steps. So there were a number of items that were listed there that didn't have a date for next steps, I guess you will. So that's a question I have for you also. Okay.
Thank you. I really appreciate it, the opportunity. So I'll start with the first question first, which is sort of coordination and the international framework in which the SEC is existing. This is, again, a little bit of a change for the commission, because the commission has, in 2010, they put forward a little bit of guidance that said companies have to disclose some material climate risks, and then sort of let it be the companies that figure out what is material. And it's a little bit like saying, well, it's only material if I, an executive, determine it's material, and I might not be incentivized to disclose the thing that might be materially bad, right? And so that disclosure prompt didn't lead to a lot of change. And so that's really the only thing that changed from 2010 until, frankly, the beginning of this year. And so now what's happened in the interim is the rest of the world changed, and particularly Europe changed. And so they have moved so much further beyond, frankly, beyond even where we are talking about things in the US, in terms of mandatory disclosures that are not just for publicly traded companies, but what we would think of as private ones as well. The disclosure regime in Europe is based and largely based on the size of the company and the impact of the company. It's irrelevant whether or not they raised capital in this particular method or that particular method. And so one thing that we now have in the US is we have the ability, and the SEC will have the ability to say, we know you are disclosing this stuff over there, right? So a lot of, when we think of the S&P 500, much like CalPERS with your investment portfolio being international, they're also largely international as well. So when we think of the largest multinational companies, they are already making a ton of disclosures in other parts of the world. And frankly, a ton of disclosures in the US, sometimes to state regulators, sometimes to federal regulators, but not to the public. So the EPA has required disclosures. The Department of Labor has required disclosures. Those are not necessarily things that ever see the light of day for someone like CalPERS to make your investment decisions based upon. So one of the things that the commission is really going to be focused on is not just what's happening abroad, but also the other types of disclosures that are available and made here, but not necessarily made available to public market participants, or instead just made available to regulators for things like equal opportunity, right? Employment issues and those types of things. So I say that if you ask me what I think we're going to see out of the SEC, it's really simple. I think we're going to see a rule proposal that says, on climate change, that says we're going to do TCFD, task force and climate-related financial disclosures. We're going to see that, which are sort of principles-based. Explain to us what these risks are, and basically 11 different buckets. And that's going to be helpful, I think, very much to your investment teams. But at the same time, there's a lot of pros. There's a lot of things that are hard to compare there. So we're also going to see required line item disclosures. I think the commission is also looking at those types of things, numbers that are easy to compare. So you can put them in a spreadsheet and someone can say, all right, well, this company has this number and this company has a very different number. So I think those are the types of things that the commission is going to focus on. And again, drawing not just on what's happening largely in Europe, but also here. So it's also not just water's edge. We also have to recognize that a huge number of foreign issuers, large companies based in China and other parts of the world, list on the US stock exchanges. We are the largest markets in the world. We are the deepest markets in the world. And so if you're a big company that wants to raise a bunch of money, you want to come list in the US. And so historically, and that's still the case today. So when the SEC sets its rules, in some respects, it actually is going to be helping to dictate the rules of the rest of the world. And right now, we're really taking what the rest of the world, and largely Europe, is already ahead of us on, and going to be incorporating that. So it's a tick-tock. It's a ebb and flow. Who's leading, who's following. Right now, we're following. I suspect by the end of the year, we're going to have a rule proposal that would take us immediately to leading some of that discussion.
Okay,
Can I just, Ty, before you go on, specifically on stopping at the water's edge, that's all very helpful. The US has its own accounting system, US GAAP. The rest of the world has something called IFRS, International Financial Reporting Standards, that covers Europe, as Ty says. It also covers China, Japan, Sub-Saharan Africa, the Middle East, Latin America, the big markets where we invest. And the same forces that are driving the SEC into rulemaking have also been at work through investors, through government, through the science being brought to bear. And the IFRS has agreed to set up a new body called the International Sustainability Standards Board, which will cover all of those markets. They're starting with climate risk, but they will be picking up these other topics in sustainability, which will include, for example, some of the comments that Lisa was making earlier on human capital. So the trick now is going to be to make sure that the SEC is well coordinated with the work that's going on through IFRS, and this will also then anchor it into the financials. And Marcy just reminded me, we have got the third round of our Sustainable Investment Research Initiative out, and we are ready to appoint our partner, having scrutinized many proposals. And this will be on two themes. One, human capital management, what matters to investors, when, where, and how, so that we can better articulate around issues like racial equity audits, diversity, equity, and inclusion more broadly, and also on the capital allocation piece on climate change. So apologies for interrupting. Back to you.
Absolutely, all of that. The one thing I'll note is the commission is historically very bad at deferring to what the rest of the world is doing. You don't become a US regulator or frankly, a very good member of Congress if you say, we're going to do what they're doing over there. So what we have to do is say, what they're doing over there makes a lot of sense, and here's why. So we have to internalize that as a US regulator, as US members of Congress. And that's what's actually happening. So we have to independently come to the same judgment, recognizing there are going to be as many similarities as we can possibly imagine, but there's also going to be some distinct differences. But the corporate world, as those standards become adopted elsewhere, are going to want us to largely follow suit. And so the last thing I'll note is you raised a question on timeline. It's a really important thing. So this was that 49 item agenda that I referenced at the beginning that you looked up. It's a wish list. It's what the chair of the SEC wants to do. He is going to get the wrath of Congress and frankly, press and trade associations and whatever, if he doesn't put on the list things that people want to see on the list. So it's over-inclusive by its nature. It's meant to be aggressive. The question here is one of who the chairman is. The chair, Gensler, is someone who has to-do lists and likes to check things off. It's a personal risk to him to put things on the list that don't get done, because to put frankly, anybody who's ever watched Elizabeth Warren in a Senate hearing doesn't want to be on the other side of that moment. And so I think he is acutely sensitive to that is his checklist of things to do. He has put that on his things to do during his tenure. Pragmatically, from my perspective, given where we are in politics and how quickly things can flip, I believe this commission is operating on a 2.5-year time frame. Either they have proposed and finalized the rules they need to propose and finalize, by the way, not just related to climate and human capital, but also what I call the market plumbing issues. Again, the CalPERS has been deeply engaged on. So Don Ponce meeting with the SEC officials and suggesting, hey, this is how we need to do it, or James Andrus meeting with folks, or Ann and others. Those relationships that are now many, many years in the making now's the time. We basically have 2.5 years from my perspective that those 49 items have to go from either the drawing board or the proposed rule or the final rule stage to done, or we have to consider them likely to not be done. And so there's not a time horizon on any of those things that's a sort of concrete, but I think that's the agenda timeline that the chair of the SEC is thinking, and that he will have, for lack of a better phrase, a lot of explaining to do if he doesn't.
Yeah, Henry, if I could make a point as well. So, being involved in recent conversations on the topics of climate and human capital, I think what we are seeing, as was just pointed out, that there is this sense of urgency in this 2.5-year time frame, that we get away from this why, right? The why case of why these matters are really important to investors. And we're getting very quickly into what matters. So I think our last conversations were more, let's move away from talking about why it's important and start giving us examples and metrics that we can start building into these rules. So that has been very promising. And that was a recent conversation within the last 2 weeks.
Yeah, I would be I feel better if I start to see some timelines if I look at that report next time. Okay, rather than blanks. Okay. Okay, Teresa?
Thank you, Henry. I agree, because we really are against the clock here, and there's not, and even say we get some of this passed, there's no telling whether or not somebody doesn't get in and try to reverse it. So this is why I think we are so far behind when it comes to doing these kinds of things compared to Europe, for sure, because ours is very politicized when it comes to climate change and other ESG factors. I just want to thank all three of you. These were fantastic presentations. I was furiously taking notes. Dr. Fairfax, I think that I love all the stuff that you were covering and that you would like to see covered in reporting. And I wanted to add one thing, and I don't know if anybody thought about this, but as we're asking for reporting on human capital management, and we're getting these reports from the companies, how do we know that this is actually correct? And I've been thinking about, and I know I've talked to Ann about it before, can we include making sure that employees have a voice in that reporting some way or another, whether that's a unionized shop that gets to have that, but also employees get surveyed, so that if the employer is saying, oh yeah, we're doing great on DE&I, and the employees are coming back and saying, oh no, not so much. I mean, I think that's really important. That's just one question, by the way.
No,
Yeah.
Teresa, thank you so much. I mean, that you're absolutely right, that it's really, if you're going to talk about the workplace culture, climate, trying to get workers at the table, trying to get your human capital involved in the conversations, I think is critical. And I do think the way that is manifesting is in when companies are reporting on culture, they do, to the extent they have them, report on employee satisfaction surveys, and there's also some reporting on the extent to which employees have a seat at the table, right? When you think about kind of different inclusion efforts, et cetera. So you are seeing some of that. And I think you're right. I was getting ready to say, but I'll put it this way. I think you're right that when we get, hopefully, disclosure and we start directing around specifics, one of the specific asks is, can we ensure that companies are in fact surveying their employees around what they feel about culture and workforce balance and health and safety, et cetera. I think what we see now as a potential gap is that the companies that are doing well are reporting.
Right.
i.e., I've been named the 100 best company for, whatever. So you do see that. What we're missing is the companies that aren't being, touted, aren't otherwise having reporting on surveys, and therefore not being pressured to actually disclose to us how you are determining what your workers have to say about the things that you're implementing. And I will say, Teresa, this is so important. We saw this in the context of race and ethnicity, right? That you have companies implementing all of these programs, policies, et cetera, and spending a lot of money on it, but then forgetting to ask their employees whether or not they thought it made a difference. And now it turns out many of them, if asked, would say it's not. And that's an important understanding of risk.
Well, and that goes for sexual harassment as well, because
all of those important.
Yeah, and non-disclosure agreements around discrimination claims or sexual harassment claims. I think that's another big part of the disclosure. How many of those do you have?
Yeah.
And if you do, why do you have non-disclosure agreements? Why aren't you, allowing these people to come forward and tell their story? And, I just think that's really important. But everything else you're asking for, I want to see for sure.
Yeah. No, I think it's an important piece of the puzzle.
One thing I might add as an assurance point that I know the commission is actually also focused on is to the extent that we get information, obviously the most important thing is also not just being that you get it, it's also that it's reliable and it's comparable and those types of things. And so, as I mentioned before, it's not just whether or not you get pros, but do you get hard numbers and those types of things. One area on that is the extent to which the commission, going back to auditors and accountants, but particularly auditors, what are the processes, both internally and externally, to make sure that those numbers are accurate reflections of reality. So one is, you could imagine that the auditor process is in fact going back and checking with the employees. So it's not an obligation that you're necessarily could be imposing on the company, which would be valuable, true. But another way to also approach that is to ensure that there's testing, auditor testing and assurances related to that, and executive assurances related to that too, which is something that the commission is sort of much more familiar with because they deal with that in other areas as well.
That's really good. Thank you.
And I will just add this on the surveys too. You know, what I have found in my work on surveys and reporting of surveys is the data can obscure as much as it can bring clarity, right? So you'll get these numbers that will say something like 70% of the people surveyed, and then it turns out that that's like 3 people, right? So gaps in who you're actually surveying, who's showing up in the information and reporting is actually something else that you have to be mindful of, you know, when you're talking, you know, Ty, you're absolutely right about the accuracy of the things that are being disclosed and making sure we have a lens on that.
Okay, we still have a couple more questions. Ms. Paquin?
Actually, wasn't done, Henry. Sorry.
Oh, okay. I'm sorry.
I just had a quick question. I'll drop my other question. While I was doing while we were talking about all of this, human capital management, it came to my mind that last month we asked as direction for staff to look into Aries, and I understand, Anne, can you help us with that? Was there anything you can help us with on Aries management?
Yes, thank you, Ms. Taylor. I'm glad to provide an update. Following your direction at the last board meeting, of course, we followed up with Aries. I'm very glad to report that the company has been extremely responsive, and we've had an in-depth discussion on a wide range of issues. We provided members from my team and from Samiso and Zima's team in global equity. And we were very appreciative that Aries really provided all the senior people with a role in considering these issues. Of course, CalPERS policy is that engagement is confidential. We can't be sitting in a goldfish bowl while we're talking about sensitive issues. But I think just as a sign of the seriousness of the ongoing dialogue, we're planning 2 further meetings next month on particular elements of this broad topic of human capital management. So there's been a very engaged company response from Aries, which we appreciate.
Thank you very much.
Okay, Ms. Paquin.
Thank you, Mr. President. Thank you so much to everybody on the panel. This is a very fascinating conversation. I really appreciate it. And I think just to go back to the topic of human capital management, Controller Yee has been working on legislation that would require companies of a certain size here in California to report metrics, which would include hiring and firing, retention, equity and compensation, leadership, safety, benefits, pay, diversity, all kinds of metrics. And so, you know, although it doesn't solve the issue of covering the full domestic companies that CalPERS invest in, just curious to see if these are the types of things that the rule could be expanded to and what the timeline would be. And then my other question, maybe it's to Professor Fairfax, have you heard of any other statewide efforts to do something like this elsewhere?
So I'm sorry, was the first question to me as well?
Yes, please, yes.
It's a great question. I haven't taken an in-depth look at what the California legislation, nor do I have a window into what other states are doing granularly around human capital disclosure. I've done a lot of research around kind of diversity disclosure. And as you know, California has led the way there, and that's been followed by other states who are thinking about and implementing changes. And so I think even though you're right, it doesn't apply across the board. What the lessons we've learned is, this kind of state action and momentum does have an impact, right? Companies will begin, right, voluntarily disclosure, even if there's some challenge afoot. Most companies will begin to comply, and that compliance and disclosure will have an impact on the broader market. So, my first answer with regard to the impact of something that happens at the state level, especially in a state like California, where there are many, many public companies, is that in fact it can have a ripple effect in the broader market. So, I'm always let 1,000 flowers bloom and let's see what happens. So I think that's important. And the second thing I would say, and again, it's a good question. Now you've given me an additional research project. Is it is often the case that once one state begins working on things like this, other states start doing so as well. And I don't know, Ty, if you've seen something at the state level in this area.
I appreciate it. No, thanks. I think what I would say is actually the state impact on federal mandates is also very significant. Mm-hmm. So much when we talk about the international efforts impacting the SEC, so do state efforts. So to the extent that California continues to lead here, the rest of the country will get a lesson, and they will say, look, we don't want 50 different sets of state action here, or 15 different sets of state action and sets of disclosure. We actually would prefer federal securities law preemption. And so different state actions actually drive not only other states to act, but that actually has a significant effect on the federal action. Thanks. And thanks for my counting as well. Sorry.
Thank you both. I appreciate it. And hopefully the SEC will be taking action soon as well too. So thank you again.
Mr. Miller?
Yeah, again, thank you, all three presenters. Just wonderful, really thought-provoking. I had a couple comments and then kind of a question. As I've been a regulator for over 30 years, mostly focused on environmental, but what I've learned is if someone is non-compliant when it comes to hazardous waste, they're probably also non-compliant with air emissions, with water. They're probably also wage thieves. They're probably also don't have human capital at the top of their list, and they're not even wage and hour and health and safety in their workplace. All those things that you pull on any one of those threads, you start getting to the others. And so one of the things that really kind of stood out was when Mr. Gelash mentioned, there's reporting that's going on in great detail about a lot of these things to government agencies, whether state. In California, we're more stringent than the feds on almost everything that isn't preempted by, federal having the exclusive jurisdiction over things. And so a lot of that information is there, it's available, but I've not really seen, any kind of integrated way of pulling that all together to either validate what they're reporting elsewhere, or to be able to have a sense of, as an investor, where there are risks that maybe have not been really looked into, and are you aware of any kind of efforts to do that kind of work? And that's for any of the panelists who feel like sharing a thought or two.
I'm still making my way through an extensive comment file. One of the things we realize is the perspectives offered in the thousands and thousands of comment letters that came in, including, from various organizations we're all part of. One of the things that I think is really interesting is that's probably the best collection of what's out there on almost every one of these issues right now. So we're still making our way through it. And as I think you alluded to, look, there tend to be knockoff effects. If a company is good at one area, they tend to be good at a lot. And if they're really bad in one area, they tend to be bad in other places. For lack of a better phrase, I say this as someone who once investigated Enron. And one of the things I think that's really important to keep in mind is that the SEC in particular, but no state have that consolidated resource. So there are some, I'm aware of a few academic efforts to try to pull some of that together, but I would say to you folks, and frankly to everyone who's engaged and interested on the topic, the single best resource right now is a public comment file posted on the SEC's website. Unfortunately, it's several thousand comments deep. So we're relying on other people. And I know, by the way, CalPERS, James Andrus, I know is part of an effort to review those comments for exactly what you just raised, to try to say what's done at other places.
Thank you.
I see no additional questions from board members. So I will now go to the public who has signed up and requested to speak. Mrs. Figueroa, I think, is the key person that's going to help us to call on our public members to help them line up to speak, and each one will be provided 3 minutes. Ms. Figueroa?
Correct. First, can you hear me?
Yes.
Our first speaker is Sandy Emerson, speaking on behalf of Fossil Free California. Sandy, your mic is open.
And let them know they have three minutes.
Hi. Right. Hello, can you hear me?
Yes, we can.
Okay, thanks. This has been a fascinating afternoon. Thank you so much. I wanted to talk to you about the real world impact of a fossil fuel project. In response to clear evidence of human rights violations and intense grassroots pressure, CalPERS engaged with project companies and with banks that funded the Dakota Access Pipeline, but it did not change its investments. In Minnesota at this moment, Enbridge and the state of Minnesota are perpetrating similar assaults on peaceful protesters who are resisting the Line 3 pipeline. Line 3 is an expansion project. Enbridge plans to send almost 915,000 barrels a day of tar sands oil from Alberta down through the headwaters of the Mississippi River to the shore of Lake Superior. This pipeline further has the emissions equivalent of 50 new coal-fired power plants. Just in this territory alone, the pipeline crosses over 800 wetlands, 200 water bodies, and 22 rivers. That's what's at stake. The guardians of this wild, remote, and beautiful place are women elders and younger women and youth. They have no resources other than their bodies and their hearts. The state of Minnesota is using hired militarized personnel to forcibly remove protesters so that pipeline construction can continue. As activist Tara Hauska says, we are standing up for what's right. We have done so at enormous self-risk and enormous personal cost, but we do so because it's what's right. We are standing with the sacred, and we are willing to risk everything to do it. CalPERS has been supporting Enbridge for a long time. Around 2019, CalPERS made Enbridge an $85 million interest-free loan, in effect, which was revealed when it cashed in nearly $85 million in zero-coupon bonds. CalPERS' bond position has since been slimmed down to one $13 million bond. CalPERS equity investment in Enbridge grew to $147 million in 2020, despite the stock's plunge into negative territory during the first months of the pandemic. CalPERS may argue that its equity investments are passively managed and that it therefore has no power to change them. But CalPERS does have the power to divest, as witnessed by previous divestments, by placing companies on an exclusion list. If the CalPERS board votes to exclude Enbridge on the grounds of financial and reputational risk, it has the power to do so. Divestment from Enbridge would be one small step toward the urgent management of climate risk, and it is the right thing to do. Thank you.
Okay, thank you very much. Okay, and I apologize, Mr. Figueroa. The next person, please.
Yes, next caller is Sheila Thorne from Fossil Free California.
Okay. And,
hello,
okay.
I'm from Fossil Free. Hello.
Yeah, go ahead. We can hear you. You have 3 minutes.
Okay, my name is Sheila Thorne, and I'm a member of CalPERS too. I'm a beneficiary of CalPERS, and it seems to me that the CalPERS investments in Enbridge violates every single ESG principle. Not only Pipeline 3 will create the same amount of emissions as 50 coal plants being operated for 50 years, as was just mentioned, but the social principles are ignored by the violations of the 1855 treaty rights of the Anishinaabe people, and by threatening the water safety and water supply of those people, which is a racist treatment of the Anishinaabe people in the area. And lastly, the pipeline's record of a spill every 20 days since 2002 is hardly an example of good governance. I used to spend my summers on Lake Superior, and I know how beautiful that area is, and it's heartbreaking to think of the spills that could occur there. I think that Enbridge is really one of the bad actors that it's necessary for CalPERS to divest from. Thank you.
Thank you for your comments. Okay, Mr. Figueroa, the next person to speak.
Yes, the next caller is Sarah Thies.
Yeah, hi. The timer hasn't been reset as far as I can see from where I am. Anyway, I am Sarah. I am.
Proceed.
Well, I'll just go ahead and speak, but I'm at. Okay, thank you. So I'm going to follow up on some of those comments and relate some information to line 3. I'm Sarah Thies. I'm a CalPERS retiree. I am a member of Fossil Free California. I very much appreciate all the work CalPERS and the presenters are doing to reduce emissions, including Mr. Litterman's focus on the urgency presented by the climate disaster. However, as I and others have said at prior meetings, the planet does not have enough time to rely on letting the reporting scenarios described today play out. As the 2018 IPCC report found, we need to reduce emissions by 45% by 2030. Here are some signals and signs of the times regarding the risks presented by the speed and ferocity of climate change. So just weather-wise, I know you all know about what happened in the Northwest. Portland had to stop its streetcar service because the searing temperatures melted the line's power cables. After the Texas cold wave or freezing wave last winter, water and heating infrastructure all over the state was damaged. And in 2019, flooding in Texas closed oil refineries. Atmospheric carbon is the highest it's been in over 4 million years, when the sea level was about 78 feet higher than today. And the next 5 years, temperatures will spike beyond 1.5 degrees Celsius. As I reported at the last meeting, the International Energy Agency issued a report stating that as of the time of its publication last May, investment in new oil and natural gas projects must stop. And at a press conference last Friday, Senator Chuck Schumer of New York took a stand against a proposed gas peaker plant, saying there is an imperative, not just an option, to stop this plant and to stop all of the expansion of coal, oil, and gas throughout our country and frankly throughout the world. Then he joined the Democratic Socialists of America and others in the chant, hey, hey, ho, ho, fossil fuels have got to go. Now to the Enbridge Line 3 expansion. Over its lifetime, it will create 5 times as much greenhouse gas annually as the Minnesota transportation sector produced in 2016, and 5 times as much greenhouse gas as Minnesota plans to emit in total in the year 2050. Expanding Line 3 would also have the equivalent impact on the climate of 38 million additional gasoline vehicles on our road. These impacts appear contrary to CalPERS' efforts to lower emissions in its portfolio. And given the utmost existential and urgent need to lower emissions and the decline of the energy sector as described by Mr. Litterman, why is CalPERS invested in Enbridge Line 3? Thank you.
Okay, thank you very much for your comments. Mr. Figueroa, do we have any additional members that wish to speak?
Yes, we have one more caller, Alyssa Giacchino from the Private Equity Stakeholder Project.
Okay. Welcome.
Good afternoon. Thank you. Alyssa Giacchino with the Private Equity Stakeholder Project. I want to thank the Investment Committee Chair for the question she asked a few minutes ago related to Ares management and residential evictions. I'm going to provide a brief update. I do want to just express appreciation to Anne and her team and the Global Equity team's work on this issue with the ongoing engagement with the manager. As you all recall, we previously reported to this board that Ares Management and its single-family rental firm, Front Yard Residential, have been filing for eviction at numerous properties. Since our comment last month, I can report that in June alone, Ares Front Yard Residential filed more than 60 additional eviction actions, including more than 30 filings in majority Black DeKalb and Clayton counties in Georgia. Since the beginning of the year, Ares Front Yard Residential sought to evict over 20% of its residents in these 2 majority Black counties. A number of these filings have resulted in residents being evicted. I've shared examples with staff of residents being evicted in Clayton County in June, and Front Yard Residential has received writs of possession to evict tenants in dozens of more cases. Both Ares and Front Yard have sought to ignore the fact that disproportionately high rates of eviction filings are happening in majority Black counties, responding that the company does not collect racial composition data. We first notified Ares of Front Yard's disproportionate impacts in majority Black counties months ago. Bloomberg reported on it in April, yet the same pattern has continued. Ares Management has also said that Front Yard Residential is following the CDC eviction moratorium. Yet we have noticed multiple cases where they have sought to circumvent the moratorium by not renewing leases of residents who filed CDC hardship declarations and then seeking to evict the residents based on the non-renewal. For example, in Palm Beach County, Florida, a resident who had filed a CDC hardship declaration told the judge, quote, "I have asked the courts to give me some time to be able to move before becoming homeless. I have an elderly mother who has Alzheimer's and my 3-year-old granddaughter who I take care of as well," unquote. Front Yard Residential proceeded in court with the writ of possession to evict that resident in late June. Ares' partner in owning Front Yard Residential, Pretium Partners, has also faced growing scrutiny from members of Congress. Last month, U.S. Senate Banking Committee Chair Sherrod Brown sent a letter expressing concerns about disproportionate impacts in majority Black counties. This month, Chair of the House Committee on Financial Services, Maxine Waters, sent a letter to Pretium Partners urging the company to work with tenants to inform them of their rights and connect with emergency rental assistance. The CDC moratorium will expire on July 31st. There are hundreds of pending eviction cases for Front Yard Residential and Ares, and dozens of writs of possession, meaning that residents could face eviction in the coming weeks and Black renters could be hit especially hard. Ares Management failure to resolve these concerns represent a significant management failure and appears to directly contradict Ares Management's ESG policies. Ares is in the process of raising several funds and may soon come back to CalPERS seeking additional capital. We believe CalPERS should halt new investments with Aries until the firm adequately addresses its home rental firm's eviction actions and its disproportionate filings in majority Black counties. Thank you.
Okay, thank you for your comments. And Mr. Benvenu, would you follow up on that issue? I think that issue was raised once before, but I'll ask you to follow up on that and provide some updated information.
Henry, I think Ann just gave us a report on that kind of high level that she's engaging.
Okay, well then if you could reach out to that person who spoke and let them know what that is. Okay. All right, thank you. Okay, so Mr. Figueroa, I guess that's it for the public request to speak, right?
That is correct. That concludes public comment.
Okay, thank you very much. Well, that completes day one of our virtual offsite meeting. We'll reconvene tomorrow at 9 a.m. Stakeholders and members of the public are welcome to join us again by webcast. So I would just say to everyone, have a wonderful afternoon. Thank you, and this meeting is adjourned.